Hello.
Welcome back to Worldwide Exchange. Elon Musk reportedly making a direct appeal to President Trump to reverse course around his tariffs. This according to the Washington Post, which says the plea came this weekend and was ultimately unsuccessful. The reported plea by Musk marks the highest profile disagreement between he and the president. Musk has previously said the impact of the president's auto tariffs on Tesla is quote unquote significant. Sticking with the president's tariffs and what could be a canary in the coal mine for legal challenges, the new Civil Liberties Alliance, a nonprofit group with ties to Charles Koch and conservative legal activist Leonard Leo, is suing the federal government. The group arguing the use of the International Emergency Economic Powers Act, the law the president is using to justify his tariffs, is unlawful. The alliance is taking this action on behalf of one small business, Simplify, a Florida-based home goods company whose business relies heavily on imports from China. The White House has not responded to a request for comment. Joining me now with much more is the founder and CEO of Simplified, Emily Lay. Emily, good morning. Thanks for joining us.
Good morning. Thanks for having me.
All right, so let's start off with this. You're basically caught in the middle. It's a nonprofit with some very high-profile backers in the conservative community. Your company's being impacted by the tariffs. What is your ultimate goal?
My ultimate goal is to be a voice for the hundreds of thousands of small businesses across the United States who are impacted so devastatingly by these tariffs. Since 2017, my company has paid nearly $1.2 million in tariffs to the United States government. And that is after making our initial products here in the United States back in 2012. In 2012, it cost me $38 to make one of these planners you see here. And we sold them for $50 and had no profit that year. So truly, it's my hope that the illegality of this comes out and that these tariffs and the way that they've been implemented is shot down.
Do you have a sense of why this nonprofit decided to take on your case in particular? I'm sure there's a lot of people with a similar gripe. Why take your case to court? And also, have you been in contact with Leonard Leo or Charles Koch? Have you actually spoken to them directly?
No, not at all. I'm absolutely thrilled to partner with an organization that believes in the Constitution and in the checks and balances that it sets forth. And I am truly hopeful that what we will find at the end of this is that the way that these tariffs were implemented was, I had no opportunity to speak up. No small business owner had any opportunity to speak up to our representatives, to have this put forth before Congress, to have that, go to any sort of vote. It was done without any of what it's supposed to be done with. And so at the end of the day, I hope that the truth of all of this comes out and that these businesses that we have all fought for and built from the ground up really prevail.
Okay. Emily, can I ask you very quickly, what are your political leanings? Are you aware of some of the political nature of this? And also, why not sue Congress? If you read anything about this, Congress seems to have ceded a lot of its powers over tariffs to the White House. Why not sue them to take action and do more to control tariffs?
Well, I think the law speaks for itself, and that the president decided not to involve Congress in this. And so, truthfully, at the end of the day, it lies with him.
All right, Emily Lay, we got to leave the conversation there. Thank you so much for joining us, Emily Lay, the CEO of Simplify.
Thank you for having me.
And for much more on the pushback on President Trump's tariffs from some billionaires, Ken Langone becoming the latest to blast the trade plan in an expletive-filled interview with the FT, saying he just doesn't understand the formula used by the administration and calling the raid on China too aggressive too soon. The Home Depot co-founder saying he believes the president has been poorly advised by his advisors about this trade situation. Langone joins Ken Fisher, who called the tariffs stupid, and Leon Cooperman, who said we're headed towards a recession. Those remarks follow Bill Ackman and Jamie Dimon's criticisms just yesterday. All right, coming up here on Worldwide Exchange, breaking down what's been a rough few days of trading for Apple And there are reports of new plans to avoid the worst of the tariffs. Take a look at Apple shares. Actually, a bit of a bounce back, up about 1.5%. But over the last 3 days, having their worst 3-day stretch since 2001. The company losing about $680 billion in market cap. But first, quick programming note. Today is the CNBC Changemaker Summit out in LA. You're going to hear from the women who are pushing boundaries, leading in new ways, and finding solutions to some of the world's biggest challenges. To learn more, scan the QR code on your screen or go to cnbcevents.com/changemakers. And we're back right after this.
I have a great relationship with President Xi. I hope it's going to stay that way. I have great respect for China, but they can't do this. We're going to have one shot at this, and no other president's going to do this, what I'm doing. And I'll tell you what, it's an honor to do it.
That was President Trump yesterday refusing to back down in his growing trade war with China, now threatening to raise tariffs on Chinese goods to more than 100% if Beijing doesn't back down in the standoff. But China actually pushing back on that threat this morning. Welcome back to Worldwide Exchange. I'm Frank Holland. Coming up, much more on the rising trade standoff between the two superpowers, and where our next guest says, despite all the rhetoric, he actually believes that Beijing wants to find a solution. A lot more on that coming up. But first, let's get you ready for the trading day ahead. We begin with U.S. stocks really coming off a roller coaster ride yesterday, briefly rallying on hopes of a tariff pause before the administration pushed back on that whole idea. Take a look right here. The Dow, wild swings, moving 2,900 points from its highs to its lows, its biggest one-day swing ever. The S&P also closing on a 3-day losing streak. We can see some really wild swings when it comes to the S&P as well. Down as much as 4.7%, up as much as almost 3.5%. Closing fractionally lower. Take a look at futures this morning. This is the action that we're seeing in the green across the board. A bit of a bounce back right now. Looks like the Dow would open up about 700 points higher. The S&P up about 1.33%. The Nasdaq up over 1.5%. We're going to take a look at the Nasdaq 100 pre-market leaders right now. Taking a look, AppLovin right here at the top of the list, shares up almost 4%, followed by ARM, Marvell, Broadcom, and NVIDIA. You see a lot of chip names here on the list. We also want to just continue to look at some of the action in the markets. Investors, they just continue to search for a bottom And they're also trying to digest the president really emphasizing his commitment to tariffs.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs. There'll be fair deals.
And this morning, taking a look at the VIX, you can see a lot of anxiety on Wall Street. Big spike yesterday, but actually pulling back from those levels this morning. Right now, the VIX at about 43, pulling back, I should say, just about 10 points. China, of course, in focus this morning is the trade tensions with the U.S. They continue. Again, we're going to talk to Educator McNeil about the trade and tariff dispute very shortly. But taking a look at the ETFs that track some of the countries in tariff negotiations, right here at the top of the list, we see the MCHI, the Chinese ETF, up over 2%. The KWEB also up 1.75%. Take a look at this. The Chinese technology ETF from Invesco up over 3.5%. But down here, the Chinese multi-sector ETF pulling back more than 9%. So some varying views and sentiment. That's actually where it closed yesterday. We're also looking at metals this morning. The metals complex also coming off a very wild day. Gold falling 2%, copper falling nearly 5%. This morning, another big bounce back across the board. Gold up nearly 1.5%, copper up over 2% this morning. We're also looking at energy this morning. Oil sitting at just about a 4-year low right now. Taking a look. WTI, the U.S. benchmark, coming off a 52-week low yesterday, just fractionally higher right now. Brent crude right now actually pulling back fractionally. Natural gas down just about 0.5%. And some big moves in treasuries as well. The 10-year with its biggest move, its biggest one-day move in about 3 years. You can see here it's back above 4% right now, sitting at 4.16%. Okay, that is your setup now. We're going to go back to one of our top stories this morning. China vowing to fight to the end and not bow to pressure from President Trump and his sweeping tariffs as tensions between the world's two biggest economies, they just continue to escalate. These latest comments coming as the president threatens to ratchet up tariffs on Chinese imports to more than 100% if Beijing doesn't pull back by tomorrow from its decision to match the reciprocal tariffs he announced last week. In a statement, China's Commerce Ministry saying the U.S. threat to escalate tariffs is a mistake on top of a mistake, once again exposing the American side's blackmailing nature. China also allowing the yuan to weaken today to levels not seen since 2023. The market's interpreting this as an attempt to counteract the trade tensions and support the country's stock markets. Let's discuss all this now with Educator McNeil, Senior Policy Analyst at Longview Global, and of course, a CNBC contributor. Educator, good morning. Always good to see you.
Good morning, Frank. How are you?
All right, let's start off with those comments. Really the headline here, the idea that China says they're going to fight to the end. Doesn't sound like they're very diplomatic or really looking to make a deal. When they say they want to fight to the end, what's your interpretation? Is that fight to the end when we're talking about tariffs over 100% or just the increase in tariffs altogether?
I think China is prepared, Frank, to really go a couple of more rounds here. They've been hoping that this would not be the case, but they've been preparing for this outcome for quite some time. As you've heard me say, Frank, I think the Chinese would have preferred to try and go back to something like the Phase 1 trade deal and purchase more goods from the U.S., perhaps semiconductors, even as we know there's some need for some advanced chips. But of course, that would require getting rid of the Biden export controls. But that doesn't seem to be the path that the Trump administration is taking. And so this is a situation, Frank, where the pace and the severity right now is being led by the U.S., but China is prepared, at least in the short term, to go tit for tat, round for round with the U.S. here in this trade war.
All right, so you're saying at least in the short term, but at the same time, you think that China wants to make a deal. We've also just heard from the president saying he has a great relationship with President Xi. Can you parse that for us? Is that true? Do President Trump and Chinese President Xi, do they have a good working relationship at least? And is some of this bluster, or are they really going to stay resolute?
Well, I think it's fair. It's hard for me to really know, but I can tell you what I believe, and that is he does, in fact, have great respect for Xi, at least for the power that Xi has with respect to his own country. I think he covets some of that own power. In terms of a great working relationship, I'm not so sure I would go that far, but if the president says it, then I'll accept that.
All right, how big of a threat is the idea of devaluing the yuan? Looking right here, since the election, the U.S. dollar has risen about 3.25% against the yuan. Where do you see the potential for the yuan to be devalued to, and how do you think the administration will respond?
Well, as you noted, Frank, in the opening here, the yuan has already moved a little bit below that 7.2 mid-rate. I don't think we're going to see much more action with respect to devaluing the yuan. It is a part of the toolkit, without question, but I think you run the risk here of capital flight for sure. You run the risk of actually triggering more ire from Trump and being accused of being a currency manipulator. So I don't see much more room to move in terms of devaluing the yuan. But it is certainly a part of a fuller menu of things that the Chinese will use to try and shield themselves from this tariff war.
Dvorak, one last question before we let you go. We were hearing from the president of the European Commission, I should say, earlier today, a lot of tough talk coming from the EU, whether it be Germany yesterday or just the EU Commission president today. How big of a threat is it that Europe and other parts of the world, they actually gravitate or move more towards China and away from the U.S. in a very serious economic way?
I think you will see some attempts, Frank, at hedging a little bit. I think for Europe, it may be difficult to really believe that China provides for them all the answers given some of their own internal dynamics. But I also think you're going to see China really try to warm up and peel off some of the U.S. allies with respect to this trade war. So I think you're going to see some diplomacy in this space. I'm not sure how well it will work for the EU. They will try. And certainly China will try to really engage more of the U.S. allies.
All right, Dvorak McNeil, always great to see you. Thank you for your time and for your insight.
Thank you, Frank.
All right, Treasury Secretary Scott Bessent, he's going to have much more on the administration's tariff strategy that's coming up right here on CNBC on Squawk Box at 7:10 a.m. Eastern Time. Coming up here on Worldwide Exchange, finding a bright spot in the tech wreck, details on what has shares of Broadcom jumping ahead of the open. Those shares up over 3%. Stay with us. Much more coming up. Welcome back to Worldwide Exchange. Turn our attention now to tech with the NASDAQ and the NASDAQ 100, both more than 20% from their all-time highs, but both sharply higher this morning. Among the leaders, we got Broadcom. Shares are higher after announcing plans to buy back as many as $10 billion worth of shares. This morning's gains by the Apple supplier coming on top of yesterday's 5% jump. Taking a look at Broadcom shares right now. Again, they're up over 3%. Speaking of Apple right now, the Wall Street Journal is reporting the company plans to source more of its iPhones from India to offset the cost of Chinese tariffs. Apple shares, they're higher in the pre-market as well. after falling more than 3.5% yesterday. Since Thursday, Apple shares have shed nearly 19%, wiping out nearly $640 billion in market cap. Joining me now is Joel Kalina, Managing Director and Head of Tech and Media Trading at Wedbush Securities. Joel, good morning. Good to see you.
Frank, how you doing?
So just going back to Apple really quick, Apple actually having its worst three-day stretch since all the way back in 2001. What is your take on Apple, the declines, and do you think that maybe we've seen a bottom when it comes to Apple? It seems to be bouncing with the rest of the market. Also maybe some hope on news of moving more production to India?
Yeah, I'd say Apple. Typically within the mega cap, complex, sentiment here has been probably the most negative that, amongst them all for years now. Stock was down 15% off its highs, even before, kind of Trump's tariff announcement last week. So Apple's been a funding short for the hedge fund community, what feels like forever. Long-only community has been perpetually underweight the stock, and I think for right reasons. Mostly due to slowing innovation, especially around the product side of things. We know the services part of the business has really kind of been the big driver of the multiple in the story over the past 5 to 10 years. And then kind of just, again, there's just really, they've been, AI intelligence, Apple Intelligence has just been a dud. That kind of unveiled details last June, never just have gained any traction with that product as well. So there's just been continued frustration, both from the hedge fund community and long-only community, and there's just been, reality is just more attractive stories within big cap tech.
All right, fair enough. One thing I want to bounce off of you yesterday, I'm getting this from State Street. The SPY ETF saw $127 billion traded, busiest day in its entire history. Obviously, there's a great concentration of mega cap tech when it comes to that ETF. If we continue to see investors investing in those ETFs and things like the triple Qs, whether you want to call it buying the dip or whatever else, isn't that going to create a natural floor when we're looking at tech?
Potentially. I think there's been a lot of, crossing currents that have been ongoing the past, 3 to 4 days. And obviously when the market falls 2% in 2 days, it's sort of unprecedented, right? We've seen these type of pullbacks over much longer periods of time. And I think the heavy usage of ETFs is probably going to remain here for at least the near term as uncertainty remains high. So yeah, maybe we get some sort of floor, but I know, macro firms especially have been heavily using ETFs to kind of, better hedge their books and kind of take not really take bets, really just kind of protect performance in the overall. So maybe pretend, there's some sort of near-term bottom. But again, name like Apple, I think there's just a lot of hair on it, and then until China's tariff situation kind of removes to the background, I think there's just better stories with a lot less hair on within tech.
Clearly a lot of uncertainty. Let's get to some areas of the market that you're actually more certain on, Joel. You like cybersecurity, you also like video games. We might be facing a recession, a lot of fears about that. So are you saying that cybersecurity won't be as impacted by an economic slowdown?
Yeah, I think just looking at all the CIO surveys that the sell side has been putting out there over the past several months, you're seeing, spending revisions, are heading lower, but the one standout remains cyber. And that's one area that people just can't afford to cut. And so within our coverage universe here, I see CyberArk, one of the cleanest stories in the space. Name like Rubrik, that had very good earnings just 3 weeks ago, yet has gotten massively caught up in the unwind out of tech. And these are names that are going to benefit from continued product innovations and shift to Gen AI workloads are just going to, again, drive product momentum. And especially Rubrik, they're showing a lot of good momentum with some of their larger customers as well. So I think these are kind of, secular growth stories and just a lot less exposed to a lot of the tariff noise out there. And I think investors, touching on video games as well, are just looking for names that are just a little bit more simplistic. Keep it simple. Don't don't be a hero in this tape, because it's going to be ugly in the sense that we're going to see a lot of volatility in the coming weeks. So I love Take Two.
Just to clarify, you like Take Two? It's just simply on Grand Theft Auto. You think Grand Theft Auto is like a blockbuster essentially?
Yeah, it's going to be the biggest game that comes out in at least the past decade. I think Grand Theft Auto 5 was launched in 2013. We know the anticipation for the gaming community is just massive. And again, it's just a simplistic, it's a nice catalyst, fundamental driven story. And unfortunately in tech, there's not too many of those right now. And it's had a decent pullback off its highs, but it's been a relative outperformer. And I think you want to stick with the names that haven't gotten,
we're going to stick with those names. Joe Kalina from Wedbush, great to see you. Thank you very much.
Take care, Frank.
All right, coming up here on Worldwide Exchange, the race to advance President Trump's agenda, facing some pushback from some Republicans. We got the details when Worldwide Exchange returns. Stay with us.
a CFP.
Welcome back. Turning now to Washington, House Republicans pushing forward with a bill advancing President Trump's agenda, including making his 2017 tax cuts permanent. But now the caucus is facing some pushback from members of its own party. Emily Wilkins joins us now with much more. Emily, good morning.
Good morning, Frank. Well, yeah, lawmakers are trying to thread a bit of a needle here because businesses, many lawmakers, and Trump himself, they really want to make sure that when these 2017 tax packages re-upped, everything is made permanent. The problem is that under the process that Republicans are using for this, anything that's permanent must be fully paid for. So extending the tax package, it's estimated to cost $4.6 trillion, according to the nonpartisan Congressional Budget Office. But it's going to be really difficult to find $4.6 trillion in cuts to offset that. The House has only approved $1.5 trillion in cuts, and even that is hitting headwinds in terms of what's going to be on the chopping block. But Republicans are moving forward with what some are labeling as a budgeting gimmick. Most of the tax cuts passed in 2017 are still in place, and it would cost about $3.8 trillion to extend them. Much like you might already be paying $10 a month for a streaming service, and if you want to renew that subscription, it would still cost you $10 a month. The top congressional leaders basically want to say, you know, we've already factored this monthly $10 into our budget for a while, so it doesn't really cost us anything to keep going. So the $10 a month becomes zero for continuing streaming, and then the cost of extending that tax package drops by roughly $3.8 trillion. Now, different groups have some different estimates here, but even if you assume that there's still $800 billion needed to cover things like 2017 tax cuts that have since expired, it's much easier for lawmakers to find that $800 billion in pay-fors to offset that cost, and it also leaves more room for Republicans to do other things that Trump wants, like no tax on tips and raising the SALT cap. Now, some Republicans are nervous about calculating the cost this way. It's never been done before when it comes to taxes, and it could add additional trillions to the deficit. It's one of the big reasons Trump's tax agenda is in trouble this week in the House. A number of fiscal hawks have come out saying that they cannot support the bill, and it's not clear yet that it's going to have the votes to pass. Speaker Mike Johnson wants to put it on the floor tomorrow. Frank?
So we're also seeing some other pushback on the Trump agenda there in the House. Some congressional leaders actually trying to put forward a bill to limit the president's tariff powers. What's the latest on that?
So at this point, you are seeing a number of Republicans, both in the House and in the Senate, put forward this piece of legislation. But at this point, the main thing that we've heard from Johnson is that he wants to give Trump time. He doesn't think that Congress's role on tariffs is right now. He wants to give him a little leeway to negotiate, see what he does with some of these other countries. Frank, what I'm actually going to be watching for, not this week, not the next 2 weeks after that, because Congress is out of town, but when they come back, late April, early May, what is the political climate at this point? How much pushback are the American people giving on their representatives? And are they at a point where some of these measures might have a little more momentum than they do right now?
Our Emily Wilkins, live in D.C. Emily, great to see you. All right, coming up here on Worldwide Exchange, where our next guest is looking for protection during the recent market turbulence. We'll be right back after this break. As we close in on the 6 a.m. hour, check a few stories that we're tracking this morning. The SEC giving Michael Novograd's Galaxy Digital permission for a direct listing on the NASDAQ stock exchange. Galaxy shareholders and the TSX still need to sign off on that deal. Bloomberg reporting Xi'an is facing pushback from the Chinese government over plans to shift some of its production elsewhere in an effort to avoid U.S. import tariffs. This coming as China says it will fight to the end in the face of even more tariffs from the U.S. Shares of U.S. and Nippon Steel rising after President Trump ordered a fresh review of the pair's proposed merger. The president calling for a national security panel to look at whether further action is appropriate. Shares of Marvell Technology also rising ahead of the open. The chipmaker agreeing to sell an auto networking unit to Infineon Technologies for about $2.5 billion. And Warren Buffett not feeling the market pain like many of his wealthy counterparts, actually seeing his wealth rise during the tariff-fueled sell-off. Buffett's wealth has risen by more than $11 billion over the last few days, while others like Elon Musk, whose net worth is now below $300 billion, have obviously been taking some considerable losses. All right, turn our attention back to the U.S. markets and some signs of relief in the ongoing tariff-fueled sell-off. Taking a look at futures, you can see we're actually in the green across the board. The Dow looking like it would open about 700 points higher. For much more on the trading day ahead, let's bring in Chris Ferrone, Chief Market Strategist at Strategist Research Partners. Chris, thanks for being here.
Great to be here.
All right, why don't we start with your word of the day? A lot going on in the global markets and the economy. Pushback from China, pushback from the EU. What is your word of the day?
It's asymmetry. And why asymmetry here? Because I think we've done enough on the downside for now. The longer term questions we can discuss here in a minute, but we look for really three conditions to come together at any really high climactic moment. We look for indiscriminate selling. I think we certainly had that on Friday. It's 72% of the S&P with a -2 standard deviation move on that day. That is like a 2020, 2008 type reading. We look for sentiment extremes as well. Put-call ratios are now finally starting to spike. They had been dormant for weeks. That was a spot of concern for us. Those are now starting to show some stress. And then third, we look for very capitulative price action. You got a surge in new lows on Friday and into yesterday morning. So I think, at least in the near term, those conditions present a very asymmetrical backdrop where downside probably capped from here. And those first rallies out of these levels can be a 10 to 15% move. That gets you to like 5,400 on the S&P.
So you mentioned the calls. What about the puts? Have you seen the ratios change there at all?
Yeah, so put-call ratios, so looking at puts divided by calls, have really started to surge. So put volume is very, very active here. You see it with VIX as well. I think we touched 60 yesterday, but more importantly for us, if you look at the VIX curve, so the shape of the term structure, spot VIX is trading something like 25 points above the future contracts. Very unusual environment to be protecting the present at the expense of the future. That's generally a pretty bullish condition, at least in the near term.
What do you make of some of the action that we saw yesterday? SPY saying its biggest trading day ever. Retail investors putting about $125 billion in the market as well. What do you make of that?
Well, I think it's all reflective of when we talk about sentiment, watch what they do and watch what they say. People have been talking bearishly for weeks, but we never really saw it in the price action until the last couple days. I think the volume data certainly reflects fear. It reflects stress. You did 125 billion plus on SPY yesterday. Also, if you look at the inverse ETFs, so the product where you can short S&P or short triple Qs, volumes in there set records yesterday. So I think it reflects, again, this broader sentiment package that has moved more into the constructive camp.
All right, we're talking about equities, but your pick's actually in the bond market.
Yeah. I like the 2-year note long here. I know yields bounced yesterday. I think that's short-lived. I think that was some sell what you can type mentality out there. But ultimately, we think the Fed has to go here and it has to go more than I think people will ultimately expect. 2 years lower. I think 2 to 3% is not out of the question here. They trade 375 right now.
Chris Ferrone from Strategist. Great to see you.
Great
Thank
to be
you very
here.
much. Have a great day.
Sure.
All right, before we let you go, we want to take a look at some of the action right now in the markets, and we're right now away from a fresh look at the state of small business with the latest NFIB survey. Cal-Maine Foods also is going to report its earnings. We're also going to hear from San Francisco Fed President Mary Daly this afternoon, and you don't want to miss a First on CNBC conversation on the market turmoil with Bridgewater Associates Ray Dalio. That's coming up at 8:10 a.m. Eastern Time on Squawk Box right here on CNBC. One more quick look at futures. We've been talking about it all morning long. In the green across the board. The Dow off of its highs, looking like it would open about 650 points higher. The S&P and the NASDAQ, however, both firmly in the green right now. That does it for Worldwide Exchange. Squawk Box starts right now.
Good morning. Futures pointing to a bounce for stocks following days of tariff-related selling. The NASDAQ did make a stand yesterday and close higher. There's more uncertainty ahead. Stop the presses, yeah. You know that. President Trump saying he's going to hit China with more charges today if the country doesn't back down from its tariff retaliation. China is vowing a drawn-out fight. We're going to talk all about the latest negotiations and the tariff impact on the markets, the economy, and life in general with Treasury Secretary Scott Bessent. It's Tuesday, April 8th, 2025, and Squawk Box begins right now.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick along with Joe Kernan and Andrew Ross Sorkin. And if you've been afraid of waking up and seeing what the markets look like today after the last 3 days of action, well, guess what? The sun is rising today. And the markets are actually in the green pretty substantially. The Dow futures are indicated up by about 650 points. S&P futures indicated up by just over 60 points. The NASDAQ indicated up by 153 points. Of course, this comes after a head-spinning day on Wall Street yesterday. The U.S. markets saw their highest volume day in at least 18 years, trading more than 28 billion shares yesterday. Well, through all of it, it was a pretty wild ride. You saw some ups and downs, and the biggest moves that we have seen since 2015, intraday moves to the upside, to the downside. There was about 2,500 points that you covered over the course of that period of the day. Again, where we stand right now, the Dow futures up by 625, the S&P futures up by 60, the NASDAQ up by 136. Treasury yields this morning, let's take a look at where they stand. The 2-year, 10-year spread has widened. It was more than 40 basis points. This morning you see the 10-year at 415, the 2-year at 373, and of course the 30-year all the way at 4.6%. Watching these very closely, Treasury yields came down pretty substantially and then rebounded through the course of the day rather substantially as well, too.
Meantime, let's talk about what's going on with China, because they are now vowing a strong response to President Trump's latest threat to escalate tariffs. According to CNBC's translation, the country's Commerce Ministry calling that a, quote, mistake on top of a mistake. The ministry saying if the U.S. insists on its own way, China will fight to the end. Now, the comments coming after President Trump said he'd hit China with an additional 50% tariff if China doesn't cancel its retaliatory 34% tariffs on American products. Take a look at President Trump in the Oval Office yesterday talking all about it.
Would you be open to a pause in tariffs to allow for negotiations?
Well, we're not looking at that. We have many countries that are coming to negotiate deals with us, and they're going to be fair deals. And in certain cases, they're going to be paying substantial tariffs. They'll be fair deals.
That's your first. Now, on the subject of the talks, the president said there can be permanent tariffs and there can also be negotiations. We're going to talk a lot more about all of this, tariffs and everything else, at 7 a.m. Eastern Time with the man in the middle, the Treasury Secretary Scott Bessent. He's going to join us right here on Squawk Box Live, so lots of questions for him this morning.
You know, yesterday we spoke with Peter Navarro, and his take was that this was not a negotiation. Right. We weren't going to see that within a matter of hours. You heard that the Treasury Secretary was going to be negotiating with Japan at least, and we will hear from him where these things stand. But that's been the biggest confusion point on Wall Street is, are these real and permanent? Are they a negotiating tactic? And where do we get there? Depending on the day, depending on which
I think there's different camps. I think there's the Navarro camp and the Lutnick camp on one side. I think there's the Bessent and maybe even Elon Musk camp on another, which is say negotiations, and the goal is to try to get the rates down to as low as possible. The camp that I think we all don't know about is exactly which one President Trump is in, because he's talked about this being a negotiation, and then he's also talked about them being permanent forever.
I was going to actually talk about this, but I see it's in the, we actually have it's scripted, but then we'll talk after. But speaking of Scott Bessent, the Treasury Secretary, Politico is reporting that he flew down to Florida over the weekend to encourage President Trump to hone his message on negotiating trade deals, or else he would risk a further fall in the financial markets, and the operative term there is negotiations. Elon Musk also reportedly reached out to President Trump. Washington Post says Musk made direct appeals to the president to reverse course on his widespread new tariffs, but proved unsuccessful. In another development, Senate Majority Leader John Thune told reporters he doesn't see a future for a bipartisan bill introduced last week that would limit presidential power to impose tariffs. Senator Rand Paul has some very pointed remarks. He's going to be on later today, and we can talk to him after we talk to Scott Bessent, and we'll see whether he is very forthcoming about what he told the president in Florida, or, with President Trump, it's best to, if you're going to, I'm not saying disagree with him, but if you're going to point out to him there are some nuances to what he's doing, it's best to do it in a fairly conciliatory way. But we'll see. I think he went down and said, listen, Mr. President, no one wants a permanent tariff structure in the United States. And the whole reason you're doing this, and really I think the reason that they settled on that weird reverse engineered formula, which makes everything look worse, so their opening bid could be much higher than it would have normally been thought to have been, and it leaves room for negotiation. That's what everybody...
An anchoring technique is what he likes to call it.
Anchoring technique, but, listening again, Navarro made the rounds everywhere yesterday, and he was basically saying, we don't care if it's 0-0, that there's so many other impediments to free trade in all these places. So I don't know what if the end game is zero trade deficits with every country in the world, that's never going to happen because it doesn't work that way. But I don't, that's...
There are implications about what that means. The trade deficit that we run with countries, they often reinvest in the United States through that, whether it's buying treasuries or sending investments here from some other perspective, too.
And you saw Larry Lindsay yesterday, the whole idea of comparative advantage, it's a real thing. And it's what, it's... Globalization, it has had some unintended horrible consequences, admittedly, but we're never going to make certain things here. Even if you got zero tariffs, how are we going to pay workers here $2 an hour? There's going to be places in the world where things are going to be made that we import.
And Navarro's point yesterday was they should get rid of things like the VAT,
right.
the value-added tax, but that's a tax that doesn't put us at a comparative disadvantage because everyone there pays it as well. It's basically a consumption tax
and it's different.
It's like a sales tax.
Different in every place.
State, yeah.
So you could spend how long talking to the EU about what they do? You spend 6 months doing that. You could spend the same amount of time, talking to the UK.
Right.
You could spend the same amount of time talking to India. Japan. And then you take
Vietnam.
China. You could spend. And we're doing it all at once, and we're doing this brinkmanship with China, which is not going to end well, I don't think. President Xi, you can't push him around like that. Everybody's got to, especially when, that culture of saving face. I mean, so I don't know how you do it all at once.
It's not the only place that's saving
We need
face.
more time for, bring Scott on now and go right to
9 o'clock, exactly.
But I want to hear Rand Paul and Ray Dalio and everything else. Pretty interesting lineup.
It is. In the meantime, Apple is planning to temporarily source more iPhones from India to send to the United States in a bid to offset the impact of President Trump's tariffs on China. That's according to a Wall Street Journal report that says Apple is hoping to win an exemption from Trump's Chinese tariffs and currently views the state of play between the United States and China as too uncertain to make drastic changes to its supply chain. Bank of America analyst Wamsi Mohan told the Journal that Apple could meet about half of this year's U.S. demand for the iPhone if it directed all India-made phones to the United States. By the way, Apple lost another 3% yesterday. It is down close to 19% over the last 3 days, which Goldman Sachs says is its worst 3-day stretch since 2001.
Just 2 points on this, because I think it's like illustrative of the situation. It's not that Apple is going to ultimately move its manufacturing back to the United States. It's just going to choose whether it's going to do it in China or whether it's going to do it in India or whether it's going to do it somewhere else. And then the second piece is the game of chicken we've all been talking about, which is if you're Tim Cook and you don't know whether this is going to go on for 6 months, a year, 2 years, you don't know whether the courts are going to get involved and say that the president doesn't have the power to do this. You don't know whether Congress is going to turn around and ultimately say, we don't like this. You don't know if after the midterms, somebody else is going to turn around and say, we're not doing it this way. And so if you were going to make the bet to bring your business back here, or even to take it from China to India or whatever it's going to be, there's so many sort of uncertain decisions. There's no decision you would make today. You would wait this out and say, you know what, if it costs me marginally over the next 2 years, it's a better bet to wait to figure out what's going to happen, even if I'm wrong, than necessarily anything else. And that unto itself is a form of paralysis. A form of paralysis is not good.
The whole question: why would zero tariffs on our side and our trading partner side? Why would that cause everything to be built here?
And the answer is it wouldn't.
That's what I mean.
Yeah.
So if that's the end result, and not only that, it's 1 year, 2 year, 3 year, 4. I don't know how long it takes to do that, change supply chains and retrofit factories and everything that they want to do.
Oh,
but just
something like this for an Apple to come here is something would be 3 to 5 years.
Yeah, but just 0
doesn't get you there.
There'd be no. You'd still build it over there. You'd just be able to sell it. It might even make it easier to build it over there. And what is your point, that the labor cost would never be?
I'm saying
here.
It's not
why would Apple
bring it
not?
here.
Why would Apple
the labor
never
cost
bring
here
it?
There's not even the labor market at this point.
Right.
So
there's
now they're saying that the laid off federal workers are going to be the manufacturing workers.
Right, because they have tooling precision skills. Exactly. So all I'm suggesting is
why wouldn't Apple? What's your point on why Apple wouldn't move manufacturing back here?
Well, because
labor.
Because of labor is one of the costs.
What
but
else?
The other thing is I'm saying it's a 5-year bet. No matter what you're doing.
But they're not moving here. You said they'll move to India.
They'll move to India or these other places.
Why not here?
Because the costs here are too high.
Because of labor.
That's a huge,
saying the same thing. Well,
huge,
what else?
huge component part.
If you could do it here, you would, but you can't pay people what you pay
But
the hourly
they already
rate.
have some operations in India that
They've already right. They've already invested in
Yeah, but what is it per hour in India? The fraction.
But there's also just the cost of actually building the factory.
But which, by the
That
way,
too.
is why.
But if you're going to build it in India or
UAW
build it in here, the cost would be.
But that's why the UAW was so excited about this, because labor costs, they have been the ones who have borne the brunt of it. If it's $70 an hour on average here versus $8 an hour.
Well, they get it,
in Mexico.
Get it coming one way, and they get hit going the other way with all the parts. That's one of the lead stories in the Journal is how badly Detroit is going to get hit by what presumably was meant to help them. Coming up, the latest market take. This will be good, from Tom Lee. He's going to join us after the break. And here are the stocks leading the Dow higher this morning. United Health jumping on the Trump administration's plan to raise the Medicare payment rate by 5%. Among other things, stay tuned. You're watching Squawk Box on CNBC. There's a futures still up over 600. A new note to investors. Fundstrat head of research Tom Lee saying we want to apologize as the terms of the tariff liberation day were far worse than we expected. Tom Lee is a CNBC contributor and he joins us now. But Tom, when you try and do direction and duration in the same time, we always go, I don't know how you expect to do that. So in this point, at this time, you didn't really anticipate that formula, I think, that was going to be used to arrive at such high tariffs, kind of maybe got blindsided by that to some extent. But with that in mind, you still think we're starting to see signs of a Trump put as of yesterday. Maybe the NASDAQ closing higher is an indication.
Yes, that's right. Markets are stretched to the downside because we lost, almost 13 percentage points in 2 trading days. As you know, it's almost like the stock market and the economy was delivered a heart attack from the terms of those tariffs. So I think that there is a bounce underway. Mark Newton, our head of technical strategy, views this as a technical rally. I think something that can take us, to recover towards 5,500 or something like that. But I do think that there is the challenge is going to be, we don't have a fundamental clarity and sort of the all clear enough for us to say that that's going to push us back towards new highs. So I do think we're kind of stuck in the near term, but yeah, I think markets overreacted to the downside. And yesterday, it does look like the messaging has switched. The president has moved towards to letting people know they're negotiating. And I think that's a return or a quiet return of the Trump put, because I don't think they want markets to continue to have this heart attack.
So you many times talk about your technical analysts, and a lot of times it doesn't involve trying to gauge what's going to happen with fundamentals or certainly not policies. But in this case, you got blindsided a little bit by something totally unexpected in your view for the size of the tariffs or the level of the tariffs. Why do you feel confident that we're in negotiation phase now and tomorrow we might be back out of negotiation phase? You could get blindsided again. I mean, that would throw off your 5,500 target, wouldn't it?
Joe, that's right. One of the things, we spent a lot of time talking to investors between Wednesday, Liberation Day, and over the weekend. And, it's clear to us investors feel that not only were these tariff levels absurd in the sense that it was very difficult for people to understand the calculation, but it really did break a covenant with capitalism. The idea that businesses need stable and predictable regulations. Many companies moved their supply chains in 2018 because of the need to move away from China, and now they have potentially trillions of dollars of stranded capital again because of these tariffs. So I think that's the seismic shock that's very tough for markets and the trust that's been broken. It doesn't mean that we can't see a level of clarity that helps restore that trust. And so markets, after this waterfall decline, one scenario is a V-shaped bounce that takes us back to the previous levels. But the reality is it's going to, I don't know what that sort of clarity that's required for that is. So I think it does feel like this will take some time. And one very good friend of mine is Tom DeMark, and he says this reminds him of 2011. I think that's not a bad way to look at it, that it's going to take a little time for markets to regain some trust.
But we did see, Tom, that huge roar back yesterday on the false rumor that suggested that they were going to pause, the administration would pause for 90 days while doing this. So the market may have broken trust, but it's very eager and really hoping, it sounds like, for some relief to come from this.
Yeah, I think so. I think that there maybe were some, that's almost, if that was a trial balloon, it worked. It showed that if there was conciliatory actions that were sort of friendly to businesses, that the market could have a massive, massive move. The idea of like an exporter tax credit, these things really can restore confidence, because at the end of the day, the entity caught in the middle of this has been companies, and the capital that they've invested, they need to earn a return. That hurts shareholders, but it also hurts all the employees that work at these businesses. So I do think that the ripple effects, looking back, it does make sense why the market had a heart attack. But of course, this also means parts of this is very fixable, but it does mean that there is, a bit of time involved.
I don't think the administration really planned that trial balloon the way that it kind of worked, but there's no doubt that they were paying attention. I would think it's like, wow, look what can happen in 5 minutes to go from down 800. Let me just ask one other thing, Tom. So we negotiate with the 70 countries and we'll ask Scott Dustin about it. What if China becomes, it's called a trade war, and the language we're hearing on both sides, it actually sounds like it could be headed for a war. So if we're, if the Trump put involves the idea that we're negotiating with a lot of places and things just get worse with China, would that change your calculus on the Trump put?
Well, 7 countries represent about 70% of that trade deficit. Outside of China, I think the EU and Japan, Korea, Vietnam, Canada, Mexico, I think we're heading, it looks like we're heading towards something that's acceptable to both sides, and really that leaves the U.S. in a better position. I think there's a possibility that we don't ever resolve this with China, so there's going to be an attempt to maybe build the supply chain or isolate China. I think that's acceptable for markets as long as that's actually what's.
So we don't need China to say, okay, whatever you want, Mr. President. Andrew?
I was going to ask him a totally different question, because we always are talking about crypto and Bitcoin and gold and all sorts of other things that are supposed to represent where we really are. Tom, you have a take on the Bitcoin story, the gold story, what that even says now about this moment, what it says about crypto or anything else about being a, quote, safe haven or not?
Well, I think this episode's really highlighted the value of being diversified, because gold has done really well. Bitcoin had been doing well until Monday, but Bitcoin is a good source of diversification in the sense that it isn't subject to tariffs. The drivers of Bitcoin from here don't have to be correlated to how the trade war resolves itself, but it does require, liquidity to return to normal. I think there were so many margin calls over the weekend. It did cause Bitcoin to have a temporary blip. So we're still quite constructive on Bitcoin. I think the move for Bitcoin from here back towards over 100,000 is actually easier than it is for the S&P to get back to the old-time highs.
Well, 5,500 on the S&P. It'd be like, what was all that about then? And all the recession fears and the end of the world fears. Maybe the economy at that point shows maybe some shakiness, but certainly you would see Goldman Sachs and others take their recession forecast back down. At this point, it's been a market phenomenon, hasn't it?
Yes, I mean, yeah, I agree. I mean, companies are really resilient. So if the resolution is quicker, I think markets can stage a big rebound. Plus, as you know, because of the tariff risks, and over the weekend, it's kind of pulled forward activity. So companies probably have more cash on their hands now than they expected because of these tariff worries.
Okay. All right, Tom Lee, thanks. Appreciate you coming on this morning and just going over what's been a crazy couple of weeks for everyone. Appreciate it. Thanks.
Tom, has it been so crazy? Is that why you're not here today? Because you've been working so hard over the last few days?
I'm actually out in Arizona for a conference. Otherwise, I'd be glad to be there.
Well, we appreciate you getting up extra early for us. It's great to see you. Thank you.
Thank you.
When we come back, Shopify making a push to infuse AI throughout the company. It's essentially saying, see if AI can do it first before asking for more resources. We have that story and much more coming right after this break.
CNBC.
E-commerce company Shopify changing its approach to hiring in the age of artificial intelligence. In a memo to employees, the company's CEO said that before asking for more headcount and resources, workers will be expected to prove why they can't get done what they want by using AI. He laid out a thought experiment for staffers. What would this area look like if autonomous AI agents were already part of the team? He said asking that question, in his words, can lead to really fun discussions and projects. According to the memos, Shopify will also factor AI usage into peer performance reviews. So here's the work you have to get done. You can't get it done by yourself? Tell us why you can't just use AI for it, because that would be a really fun thought experiment.
Wow. Meantime, we have some news just out from Meta. It's launching teen accounts for Facebook and Messenger that follows the launch of teen accounts on Instagram that took place last fall. The accounts will have guardrails in place to prevent teens under a certain age from, quote, going live, and will have a feature that blurs images in direct messages that are suspected to contain nudity. So some new features that hopefully will make things a little bit better. Kind of wish they had these features a long
From the
time
beginning.
ago.
Yeah, from the beginning. And by the way, it's going to be half the pictures you ever see. Half the pictures you ever see, because some of them they're posting themselves with far too little clothing on.
I hate when that happens. Blurred. Coming up, a weaker small business.
It's good when it's teens.
Right. I'm a long way from teen. I like 16. Business data. New numbers just out. Steve Leeson's going to join us with those. And another reminder, make sure to catch our interview with Treasury Secretary Scott Bessent just after 7 a.m. Eastern Time as we look to head to break. Here's a look at yesterday's S&P 500. Winners and losers. 60.
up today.
Good morning, everybody. Welcome back to Squawk Box. We're live from the NASDAQ market site in Times Square. Take a look at the futures this morning. Dow futures are actually up by more than 700 points right now. S&P futures matching that. They're up by about 74 points. And then you've got the NASDAQ up by over 200 points. It does come after an incredibly volatile session yesterday. But the NASDAQ actually ended in green yesterday, which was pretty shocking given where you'd seen the futures throughout the course of the day. VIX is obviously elevated, and we'll watch that today, too.
Definitely the most, I don't know whether it's oversold, but definitely the one that's taken it the toughest of the big three, the NASDAQ. We have a new look at how small businesses are faring in this economy. Senior economics reporter Steve Leisman joins us with the latest NFIB survey. Hey, Steve.
Morning, Joe. Yeah, the NFIB Small Business Optimism Index falling for the third straight month, giving back most of the initial gains from the election of President Trump. You can see here the National Federation of Independent Business saying their optimism index dropping 3.3 points to 97.4. That's the biggest monthly decline since June 2022. The index remains above where it was in October, but well below its December peak. 7 of the 10 components falling, most notably the job creation plans. That's one we have to watch out for. The expectations for higher real sales declining. Plans to raise prices did go up, and minus 16 or down a net percent of 21% who expect the economy to improve. That's the third consecutive monthly decline, the largest since December 2020. We're watching these employment numbers. Plans increase employment dropping to its lowest level since April 2024. That could reflect how a decline in sentiment might show up in the real economy with less hiring. It may also reflect difficulty in finding workers. There are now multiple business surveys looking like they did either at the start of the pandemic or before the Fed launched its big rate hikes in 2022 to cool the economy. So that seems how businesses processing all these tariffs is a pretty massive break of uncertainty and a break on economic activity, at least until the situation is more clear. Joe, just to note, these are Trump's people, this NFIB crowd who does these things. They didn't like Biden at all. They shot up when Trump was elected. The other thing is, I wonder if there's a miscalculation here on his part, because these small businesses can't do what Tim Cook's doing. They can't look around and go from like, oh, I was in China, oh, now I'll go to India. They don't have that option in the small business.
But since the beginning of time, I don't think you could say that the tariffs were necessarily what these people would like. You know what I mean? We shouldn't really use these people, but I see what you're saying. You know what I mean? Usually the other side that like tariffs. So I don't think it's really it's not hard to understand. I don't know who's really 100% behind tariffs. Well, it's hard to find business owners. I mean, Milton Friedman, Ronald Reagan. I mean, I got the quotes.
Warren, she was talking about how terrible these tariffs are.
Well, I figured she'd like them. She's wrong about everything else, but
apparently,
you know what I mean?
Apparently,
yeah.
you're from the far left if you don't like tariffs. Look, I mean, I get it. I get that there needs to be somehow to address these places where
that's no longer true. Who do you think? Why do you think these things are getting written now? Wall Street, in public and private, the biggest names in high finance are trying to get a message to President Trump.
That's fair.
Stop the markets. Those aren't
that's fair.
Far left.
No, that's right. I agree.
Yeah.
You know, Joe,
it's on the cover of every paper today.
Yeah. The funniest thing I saw was, and this gets to how do you value companies in this world? JP Morgan, it was such a shock, such a fast shock. JP Morgan put out a worksheet for its investors to use to value companies with the new tariffs because nobody's had time to do it. So it said, folks, we couldn't do this in all this time. You can do this at home, though. And it gave this whole spreadsheet where you could plug in the numbers for each company. And that's where we're at right now, is this interesting discovery process.
Thank God. Formula as we saw for the tariff.
That's where they got that on AI, supposedly. That's the rumor. But thank God AI came along just in time to negotiate, to take Japan's average tariff rate of 4.3% and get to 46 is not easy. You got to do some reverse engineering to do that. All right, Leisman, see you later.
Coming up, as we've been mentioning all morning, we have the interview of the morning, and it's coming up in just a moment. Treasury Secretary Scott Bessent, he's going to join us in the 7 o'clock hour. An interview you cannot afford to miss. So many questions for him about tariffs and so much more as we head to a break. Check out shares of CVS Health, company just announcing a transition plan for its CFO and providing a financial update as well. It expects financial results to meet or exceed now its previously issued guidance for the full year of 2025. The stock already higher, right after the Trump administration announced much higher private Medicare payment rates than had been expected for 2026. We're coming right back after this. Welcome back to Squawk. President Trump saying he's going to hit China with an additional 50% tariff if the country doesn't stand down from its 34% retaliatory tariff now on the U.S. Investors trying to figure out what comes next. Joining us right now, one of those people trying to figure out what comes next. Libby Cantrell. She's PIMCO's managing director and head of public policy. So what does come next, and what do you make of the market move this morning?
Yeah, we were just talking about that. Maybe a little bit of optimism that one, this is not going to be as sort of bad as people expected, that maybe there is going to be some room for negotiation. And that's been our view all along. We sort of characterize this glibly as kind of transaction man and tariff man, and there will be sort of tension between the two. And then, B, I think there probably is maybe some optimism that he doesn't go through with these more punitive tariffs tomorrow. My own view, I don't think that's warranted. I think he is absolutely determined on putting these higher levels on these individualized countries, and we can argue about kind of the tariff rate that he is using, but I think what I have found is our clients sort of dismiss or maybe underestimate just the deep-seated ideology that underpins these threats. I mean, President Trump was believe us. He said this in the Oval Office yesterday. We've been talking to the clients.
Okay, so if you're right, though, if we're all sitting together in 6 months from now, what does this all look like to you?
Yes, I think that is what we are trying to guide our clients to. What is sort of the ultimate destination? It may not be 6 months. It may be 2 years, but in terms of the ultimate destination, we think the baseline tariff, the 10% baseline tariff is here to stay. That is something that President Trump ran on. He believes on. It is also, if you really do want to kind of rebalance trade, a universal tariff arguably is a more effective way of doing that if that is your ultimate goal. And then these sort of sectoral tariffs, the 232 tariffs on autos, on aluminum, on pharma, on chips, we think those are likely here to stay. And then all of this thing around the edges, which I know are big around the edges, will be subject to negotiation. The higher tariffs on China are likely to stay as well. So the end game is going to be a much higher tariff rate, effective tariff rate.
But let's walk through a different issue, which is you're a business leader today, watching this broadcast, trying to figure out, you manufacture goods or do business internationally, and you're saying to yourself, okay, these new rates are here, 10% is here forever, and maybe I'm in pharma or I'm in something else that actually is going to be tariffed in a more meaningful way. Are you saying to yourself, I'm bringing this business back to the U.S. and I'm going to invest here? Are you saying I'm going to move it from China to India because at least the rate may be lower and I don't need to worry about? Or are you going to say, you know what, I'm going to watch all this play out. I'm going to see what happens with all of this. I don't know if the courts are going to stop this from happening. I don't know if Congress is going to. I don't know if the midterms are going to stop this from happening. I don't know if 3 years from now there'll be a new president and they're just going to get. Do you say I'll just, I'm just going to sit here and get my popcorn out and if it costs me a little bit of money over the next couple of years and I'm wrong, maybe that's a better bet. I don't know.
Let's go sort of 4 years and 3 years. I know wistfully you're running down, but it's only
I would say, Andrew, I would say all of the above.
Yeah, you'll know who the next. Maybe you won't know who the next president is. But
I may say all of the above.
It's going to be Trump.
I think just, and I'm not going to sort of speak for business leaders because we're not in that sort of unenviable position.
But a little bit of it has to be a bet on what they do, because if they sit on their hands for the next 3 years and basically say, no mas, I'm not doing anything, I'm just going to watch and wait.
I don't think it's 3 years, right?
That unto itself is a problem.
No, I think, it sounds so trite, but I think it's the uncertainty around this that has been, I think, the most sort of deleterious from a investor perspective, from a business perspective. And so if we can get some more rules of the road, just in terms of direction of travel, and I think we're going to get more of that over the next maybe few weeks, few months, but I don't think it's going to maybe come as quickly as people.
If everything is a negotiation, then keeping everybody guessing is part of the plan, and maybe that never changes. Maybe that is the rules of the road are look out, there's a lot of potholes.
Yeah, and from an investor perspective, maybe you just start pricing in that risk premium sort of going forward. Yeah. So there's going to always be this sort of uncertainty, trade policy, premium sort of price the market.
Anything.
Yeah, well, exactly. And so maybe this just becomes sort of part of a risk premium just in general. And I think the markets can all digest that. It's just
by the way, I should say there have been some real things that Trump has won through those tactics with negotiation. But the downside is this lack of certainty for businesses. And what does that mean from an investment perspective?
Yeah, well, I think that's exactly what they're trying to digest. So, our clients are looking for any sort of signals, if you will. I think the USTR director, head Ambassador Greer, is going to be testifying today at 10 a.m. on Senate Finance. This will probably be the most watched Senate Finance USTR committee hearing ever, because I think the markets are really looking for, again, kind of guardrails, and he likely will try to provide some framework. But again, I think there is going to be a lot of uncertainty regardless. It's just a question of sort of degrees, and again, trying to get some sort of framework around that uncertainty.
Libby, thank you so much.
Thanks.
Still uncertain, but a little more certain. A little more certain about the uncertainty. How about that?
That's probably a true statement. We're more certain about the uncertain.
Yeah.
Progress.
All right, when we come back, shares of Levi Strauss surging on new results. The CEO also sharing her views on tariffs. What the retailer said right after this break. She spoke to Jim Cramer last night. You can see that stock up by close to 13% this morning. Squawk Box, we'll be right back. Shares of jean maker Levi Strauss up in the pre-market, that company affirming its annual earnings and revenue forecast, excluding the impact of tariffs. The CEO, Michelle Goss, joined Mad Money last night and spoke about those tariffs.
The tariff issue is an industry issue. And you talked about our suppliers. We do source, we have a very diversified supply chain, 28 suppliers manufacture around the world, but 98% of apparel manufacturing is happening overseas. So we're not in the manufacturing business. If that was available here in the US, we'd be open to it. It would take years.
Goss did say that the company has levers that it can pull as it better understands the current tariff situation. That probably means moving from one country to another, just like you've heard Tim Cook suggesting they would do with Apple products. This morning, JP Morgan upgraded Levi's to overweight, and you can see that stock is up by about 13%. But interesting what she said, it would take years to adjust and figure out how to move all those things. They do have options, but it's going to take some time.
Coming up, former EY CEO Mark Weinberger is going to join us, and how CEOs are gauging President Trump's tariffs and the market impacts. Talk Box. We'll be right back.
CEOs and other executives are trying to figure out if they need to recalibrate their strategies to navigate President Trump's new tariffs or if the current uncertainty will be short-lived. Joining us right now is Mark Weinberger. He's the former CEO of EY and former Assistant Treasury Secretary under President George W. Bush. Mark, you say that CEOs are still broadly supportive of the general direction of this administration's moves when it comes to policies, but you say there's a really big but that comes with that. You want to explain?
Sure, Becky. Good to see you.
You too.
Yeah, listen, the direction of travel of the administration on fairer trading system, more efficient government, lower taxes, more rational regulatory policy, certainly relative to the past administration's approaches, is something the business community has supported. But the speed of action and the methods of executing the policies have caused great concern and destruction of value. And it creates a duration risk, like having a long-term bond that is out there, and the short-term spike in interest rates causes the reduction in the value of the long-term bond. You have to meet those short-term needs of new liquidity, new changes in directions. Your margins are hit, but you just can't do it quickly. That long-term supply chain and the long-term operations of companies are difficult to readjust in this time period, which means that businesses will have to pass on in some manner the costs of these higher. You don't want to think of a tariff as a tax. It's a higher cost on business that has to be borne by somebody, and they're figuring out how to try and do that.
You sit on the board of 4 publicly traded companies: J.P. Morgan, Johnson & Johnson, Aramco, and MetLife. What are members of directors on these boards thinking at this point? What are they asking? What do you expect to hear from managements? What can you possibly do as we wait and see how serious this is?
Yeah, Becky, we look at, what you could control in this environment. And what you need to do is you need to increase cash for the uncertainty. You need to slow down your decision making and understand the variables that are going into what a long-term investment would cost and how to unwind it so your scenario planning expands. Some investments being paused. You can cut back on CapEx. You're reevaluating your supply chains, but you can't change quickly. Clearly, we're looking at J&J just announced a massive new investment in the United States, $55 billion over the next 4 years above what they were doing. So lots of that, but really also, Becky, talking to our overseas partners, there's contracts that are being canceled left and right because if there is an alternative to a U.S. company right now that can officially provide a service or a product, those foreign counterparties are looking for alternatives because of the scenario dealing with the United States and the uncertainty here. So making sure, remember, most companies, or at least the largest companies, more than 50% of their revenues comes from overseas, and that's still a very important market for us. And we don't know where that retaliation is going to be. The last point would be we're trying to just convey to the administration factually what will happen with these higher costs and what it will mean to us and how we're going to have to change our behavior. So it doesn't become an ideological issue. Factually, they'll understand what the implications of these are.
Mark, the jobs report that we got last week was actually a pretty good number. It was a month ago, so it's backward looking. Are the companies that you know of, are they stopping or freezing or slowing down on their hiring plans? Is this going to show up in the jobs market?
Good question. I think it really depends on the company, but I would say absolutely. You're looking at all your costs and trying to make sure that going into this really uncertain and turbulent environment where we're going to see slower growth and we're going to see higher costs, you can't just keep adding costs, and that will happen. The earnings reports, Becky, as you well know, for the first quarter are backward looking, so they're going to look pretty good, I think. The economy is still strong. Really haven't seen the reduction in job growth or even consumer confidence up to this point. We're now just starting to see a tip in both business and consumer confidence.
But
the guidance for the next quarter is going to be hard.
Yeah, that's what will the guidance tell us anything, or is it basically going to be like, we just don't have any clarity?
Yeah, the guidance is going to have to be more general. The guidance is going to have to be dependent on externalities that businesses can't control, and I think analysts are going to have to understand that. So directionally, I think they're going to have to talk about what steps are you taking as a company to adjust to the current policies and where you expect them to go. What are you slowing down? I mean, in big financial institutions, the M&A and the products are changing that we thought would be coming to market, and the assumptions we're making about the unemployment rate, the assumptions we're making about the growth rate are changing. That will affect outlook. But I don't think you're going to see a lot of prediction of specific earnings per share and revenue guidance because it's going to be very hard to do that.
Mark Weinberger. Mark, thank you. It's good talking to you today.
As always, thanks, Beck.
It is just after 7 a.m., 7:02 to be exact, right here on the East Coast. You're watching Squawk Box on CNBC. I'm Andrew Ross Sorkin along with Joe Kernan and Becky Quick. And boy, do we have a lot going on this morning, including the Treasury Secretary is going to be joining us in just moments. Among today's top stories, China now vowing a strong response to President Trump's latest threat to escalate tariffs. The country's Commerce Ministry calling that, quote, a mistake on top of a mistake. And you ready for this? They're now saying, quote, China will fight to the end, unquote. Comments coming after President Trump saying he's going to hit China with an additional 50% tariff if China doesn't cancel its retaliatory 34% tariff. So we're going to be talking, of course, to the Treasury Secretary about that and so many other things. The futures right now, though, sharply higher this morning. The first time we've seen some green on the screen in several days prior to the market open. The Dow looks like it would open up higher, about 726 points higher. The NASDAQ about 230 points. The S&P 500 about 80 points right now. Let's flip the board around and show you what's going on in Europe because green also on the screen and that may be spilling over to what's happening here. The FTSE up close to 2%. You're looking at the CAC up about 1.5%. Everything else in similar territory. Then take a look at this. Overnight in Asia, Japan leading the way higher. The Nikkei up 6%. That, I think, a little bit on the back of news that potentially there is some kind of negotiation going on with the Japanese, and that up 6%. You look at the Taiwan weighted, though, still down 4% for the morning. Meantime, let's get over to Dom Chu. He's got a look at this morning's pre-market movers. What's on the list?
A lot of them, especially those Mag 7 type names. We'll get there in just a second, Andrew, Joe, Becky. But we're going to talk about healthcare first because that industry moving higher after the federal government announced an estimated $25 billion increase to payments to insurers that offer more Medicare Advantage plans to seniors. Payments will increase by about 5% in 2026. That's more than double the previously proposed bump. Companies, as you can see, like CVS Health, also United Health, Humana, Elevance, that offer some of these types of plans are all up roughly 5% to up about 11.5% for Humana. So keep an eye on those health insurers, everybody else out there in that health ecosystem. Now, as part of the rebound pre-market, the bank stocks are making a bit of a comeback. They also outperformed yesterday. The biggest U.S. lenders like J.P. Morgan Chase, also Bank of America, Wells Fargo are moving higher, as you can see here, by 2.5% to 3%. They were down about 10% in the past week, more than 20% off its 52-week highs as well. We'll be watching some of these names later on this week when J.P. Morgan, Wells Fargo, and Morgan Stanley are set to report their quarterly earnings results before the opening bell. So keep an eye on those big banks. Outperformers yesterday. We'll see if that continues today. And we're going to finish on the big tech side of things. All of the names in the Mag 7 are higher pre-market and helping to kind of drive the rebound in the stock market overall. Apple has been the hardest hit of this group, with shares down about 19% over the course of the last 3 trading days alone. Those shares are up fractionally right now. Tesla and Meta were also hit hard with pullbacks of 17% and 11% respectively. Since the close, though, on Wednesday, before the tariff turmoil, the total market cap wipeout for the Mag 7 in total comes to roughly $1.8 trillion. And Andrew, just for some perspective, that's like in just the Mag 7 losing an entire alphabet in market cap for those 7 names across just those 3 days. So it's something to keep in mind as we talk about some of these big tech movers so far in trading today. We'll see if that sticks. I'll send things back over to you, Andrew.
Okay. Dom, thank you for that. We got a big interview coming up, right, Joe?
Coming up, Treasury Secretary Scott Bessent on tariffs, negotiations, market reaction, taxes. Should be able to cover all these things. Hopefully that interview's next. Squawk Box. We'll be right back. Well, don't look away, because on any given moment, things could change, and we're joined now. I'm very happy to say by Treasury Secretary Scott Bessent this morning. Mr. Secretary, it's a pleasure to have you on. It's been a while. It's good to see you.
Good morning, Joe.
Market is trading higher today, and we did see what was welcomed yesterday, and that is a bounce from some of the lows and even a higher close on the NASDAQ. One of our guests, Mr. Secretary, earlier mentioned the resumption of the trade put, and not coincidentally, it coincided with your trip to Florida over the weekend, where reportedly you were stressing that the market needed to hear that negotiations about these tariffs were in play. Lo and behold, we did see a bounce. Is that a fair assessment? Do you think that's what happened?
Well, it's not a fair assessment of what happened over the weekend. I went down to see President Trump, as I do many weekends, and I can tell you, it's all President Trump's decision, and he had a view on after Liberation Day that we should go into quiet mode and let our partners think about the kind of the shock and awe that he presented. And over those following few days from April 2nd, we had I think we're up to 70 countries contact the White House for how to come and negotiate. So, I would say that the negotiations are the result of the massive inflow of inbound calls to come and negotiate. Had nothing to do with the market.
I think the market took some solace, though, in kind of a change in the perspective. Just last week, we were hearing no negotiations. Now, we're talking about, you mentioned 70 different countries. We're approaching, Japan, I guess, was early in terms of placing a call to the White House. And now, in earnest, you and the U.S. Trade Representative are going to begin negotiations with Japan. I think that some of the stability in the markets, there's no doubt that's what I think helped massage the markets to some extent.
Well, look, Joe, my advice on April 2nd to our trading partners was not to panic, don't escalate, and then we will see where President Trump is after a period of days or weeks. The response was overwhelming, so it was after a period of days, and he decided that it would be a good time to begin negotiating. The Japanese were very good actors. The president had a very good call yesterday with the Japanese Prime Minister that led to these negotiations. And look, the Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied.
Mr. Secretary, we spoke yesterday with Peter Navarro, and he described his view on these things as it's not enough to get to zero tariffs. You have to take down all the non-tariff barriers that exist as well. His proposal, as he's written about today, is to get rid of the VAT, the value-added tax, on top of a lot of other things. That is what it would take for us to reach any sort of a settlement with Europe. Are you in the same frame of mind as Peter Navarro is when it comes to that?
Becky, I think everything's on the table. So they're tariffs. The academic literature shows that it's actually the non-tariff barriers, which are both harder to quantify and harder to, they're more insidious because they're hidden, they're obfuscated. So tariffs, non-tariff barriers, currency manipulation, and then subsidies to both labor and industry. So everything's on the table, Becky.
Meaning that it would take all of those things for us to reach any agreement that would make any sense. I mean, the value-added tax isn't directed at us. It's a tax that every manufacturer, including those that are based in Europe, pay as well. It's more the equivalent of a sales tax like we impose here.
Well, again, I think there's going to be a lot of back and forth. President Trump is going to be personally involved in the negotiations, and we will see what our trading partners offer. For instance, there is talk of a big energy deal in Alaska where the Japanese and perhaps the Koreans, perhaps the Taiwanese would provide, would take a lot of the offtake and provide financing for the deal. So, that could be an alternative for them to come forward with that, because not only would that provide a lot of American jobs, but it would narrow the trade deficit. So, Becky, everything's on the table.
Mr. Secretary, though, help us just understand this, and maybe it's a very nuanced answer because there's sort of different component parts to this. So the president said yesterday with Netanyahu, quote, that these tariffs can be permanent tariffs and there can also be negotiations. We also had Peter Navarro, as Becky mentioned, and you just talked about, saying that the whole goal of this is to bring manufacturing back to the U.S., and then there's been the discussion of trying to raise revenue as a function of the tariffs. All of those different ideas, to some degree, oddly enough, are at odds with each other. Meaning, if you're successful at creating revenue from the tariffs, you're not bringing jobs back to America necessarily, though that could be an offshoot of what happens. I'm trying to understand from your perspective whether these really are negotiations, they're not negotiations, what success at the end of the day actually looks like.
Well, Andrew, that lot to unpack there, and let's just go through it piece by piece. That if we put up a tariff wall, the ultimate goal would be to bring jobs back to the U.S., but in the meantime, we will be collecting substantial tariffs. As I've said, I believe on this show that if we're successful, tariffs would be a melting ice cube in a way, because you're taking in the revenues as the manufacturing facilities are built in the U.S., and there should be some level of symmetry between the taxes we begin taking in with the new industry from the payroll taxes as the tariffs decline.
Mm-hmm. Let me ask you a separate question, and maybe you can speak directly to the CEOs and business leaders who are watching this broadcast, along with perhaps policy leaders and others who are frankly running other countries. I've talked to a number of them who say, you know what, I'm going to sit back and just watch all of this play out. I'm not going to make any decisions about whether I'm going to bring manufacturing back to the U.S. or frankly, how much I need to negotiate with this administration, this is now other countries, just yet, because depending on how the markets play out, depending on what you think is going to happen in Congress, depending on what you think is going to happen with the courts, all sorts of other things could happen first before I would need to make an actual decision as to either negotiating over the tariffs themselves, or if I'm a business, investing back in the U.S., because who knows what's going to happen, not just in 6 months from now, but in 2, 3, or 5 years from now, when maybe my plant would actually come on board or online.
So Andrew, that I think that may be what some of the countries are saying in public, but I can tell you I've seen the call list at the White House, and it's substantial. We were having a discussion last night about which countries to prioritize, and I think you are going to see some very large countries with large trade deficits come forward very quickly. I think we can, if they come to the table with solid proposals, I think we can end up with some good deals. And part of the calculus on that may be that some part of the tariffs stay on. And I actually think, as I said, that over the weekend, President Trump has maximum negotiating leverage right here, right now. And I think it would be a mistake for anyone to think otherwise. And as I said, many of our trading partners, they have queued up, and they have kept their cool, they have not escalated, and they will get priority in the queue. I think it was a big mistake, this Chinese escalation, because they're playing with a pair of traditionally, if you look at the history of the trade negotiations, we are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
What about the business leaders who are watching right now, who are thinking to themselves, am I supposed to actually make a commitment right now to bring manufacturing back to the U.S., or should I let this ride and watch all of this play out first before I make any kind of decision?
Well, and Andrew, as you know, unlike we financial market operators, business leaders, they have substantial lead times. So I am sure that they are putting together plans for what they would like to do when we finish these negotiations. So I think, again, they're not going to snap their fingers, find a greenfield site and build a factory, but I am sure that the planning has already started in boardrooms, because I spent the weekend talking to CEOs and investment bankers, and that's exactly what's happening.
Mr. Secretary, the actual tariff rate on Japan is 4.3%. The number that President Trump's chart used was 46%. There has been a lot of conversation about how some of the numbers were arrived at, and using that formula, which puts a lot of weight on trade deficits to try to take into account all of the other protectionist policies. But there was kind of a lot of blowback on that formula. Do you think that accurately represents what we're talking about, or was it an actual intentional effort to make things look worse in terms of the protectionism, so that the United States, so President Trump could start at a much higher level for the retaliatory tariff?
Well, Joe, a couple of things. I think if you look at the actual numbers, President Trump cut those in half. So if we wanted to create a canard to have a large negotiator, a non-credible, or the very extended negotiating position, we would have started from the actual number. And I believe that by cutting it in half, then we have shown some willingness. President Trump believes in trade. He wants to have fair trade for the U.S. I wasn't involved in the calculations of the numbers, but what I can tell you is that we can see from these huge surpluses that some of these countries have, they've accumulated these gigantic surpluses over the years. That has to tell all of us that there are imbalances. And again, whether those imbalances are from the actual tariffs or non-tariff barriers, currency manipulation, or the state-favored funding, it's very difficult to disentangle, but those big surpluses tell me that there is a large imbalance, and President Trump is committed for the American worker to fixing those imbalances.
We're going to let you go, Mr. Secretary. I just wanted to shift a little bit to the notion that maybe in trying to extend the tax cuts from the 2017 bill, that maybe the top rate, that there's some openness with Republicans to raising that, letting that go back to over 39 or even 40%. And I don't know whether the president has signed off on that, or whether he's amenable to it. I don't know whether you would be amenable to that, because it would raise the taxes on all kinds of small to medium-sized corporations if it went back there. Is that being considered?
Joe, what I will tell you is I along with NEC Chair Hassett, they have the pen for the administration. We're in contact with President Trump. We have seen remarkable unity led by the president with the Republican leaders, with Leader Thune, Speaker Johnson, Senator Crapo, and Chairman Jason Smith on this bill, and it's moving very quickly. So I think the underreported story here is the Republican unity that President Trump has. I think we will see the shapes and contours of the bill in the coming weeks and days, but I have been very impressed by how quickly this is moving forward, and this will be the certainty on this. If we go back, everyone wants to talk about, the tariffs are causing uncertainty. The thing I can tell you is getting this tax bill done quickly will give industry and American households incredible certainty.
It just seems anathema to the whole intent of the original bill back in 2017. I mean, tariffs are like taxes to some extent, Mr. Secretary. So raising taxes there and then raising taxes the top rate. So you won't dismiss that. You won't say that that's not on the table. That is possibly on the table, raising the top rate.
I'm saying that we are negotiating. The House and the Senate are moving very, very, very quickly on everything.
Okay, Mr. Secretary, thanks for your time this morning. We'll let you go, and we appreciate it.
Good, thanks, Joe.
Okay.
Still to come this morning, Congressman Ro Khanna of California. He will tell us about the early tariff impact on the major tech names in his Silicon Valley district. You can add up the losses in the stock market, although this morning markets have turned around and they're looking very strong. Dow futures now up more than 800 points. NASDAQ futures up by about 260 and the S&P up by 90. Also, Senator Rand Paul speaking out against the tariffs. He will join us at 8:30 a.m. Eastern Time. Squawk Box will be right back.
NBC.
All right, Walgreens just reporting, company coming in with earnings of 63 cents a share. That beat expectations of just 53 cents. The revenue also beating expectations. The company, though, does say it's withdrawing its full-year guidance, citing its agreement last month to be taken private by Sycamore Partners in a $10 billion deal. That transaction expected to close in the fourth quarter of this year. You can see the stock right now up by about 2.7%.
Meantime, Bridgewater Associates founder Ray Dalio, one of the latest Wall Street titans to weigh in on the President Trump's tariff plan. Dalio posted on LinkedIn under the headline, "Don't make the mistake of thinking that what's happening is mostly about tariffs." Dalio writes that while President Trump's announcements are important developments, people aren't paying enough attention to why Trump was elected in the first place and went ahead with large tariffs. He says it's more important to focus on the idea that, quote, we are seeing a classic breakdown of the major monetary, political, and geopolitical orders. This sort of breakdown occurs only about once in a lifetime, but they have happened many times in history when similar unsustainable conditions were in place. He asked readers to study what policymakers did in similar past situations. And we're going to talk a lot more about this with him at 8:10 Eastern Time. Ray Dalio will join us in a First on Squawk Box interview. You don't want to miss it.
This is fascinating. The idea of a lot of things that he thinks were unsustainable anyway.
Yep.
Income inequality. This is always been in revenue versus spending.
Right, and the debts
And
that
who
we've
pays
racked
it?
up in this country and where it comes from.
Squawk Box coming back with Ray Dalio in just about a half an hour from now.
Welcome back to Squawk Box Market. Picking up a little steam just in the last 15, 20 minutes, up 865 points now. Good gain seen in the NASDAQ now, 285, and almost a 100-point gain in the S&P 500. Treasuries, as you might imagine, the yield moving back a little bit at this point, actually significantly back to 4.2. We were under 4, we had a 3 handle for a while. Take a quick look at gold, which has set a series of new highs in recent sessions, but had a tough month. It was at the lows for the last 30 days, anyway, 3,000 now. Bitcoin getting a little bit of interest this morning, up 1.5%, almost back now to 80,000, just under that. And then crude, you would imagine, also reversing some of the recent weakness, back above $60. Actually, that's about where it was. I don't know. I think it's great, cheap gas, but I worry about the producers because at 60, it shuts down.
It shuts down production.
Shale
Which
at
leads to
65.
higher production, higher cost down the road, unless there's a deep recession.
the recession's gone again. We're back. We're okay again.
Coming up, the tariffs and all of this market volatility, we're going to focus on how the EU potentially could retaliate and the impact of the global on the global economy with former IMF chief economist Simon Johnson. Those markets, we should mention, rebounding slightly this morning, up about 2%. And then, as we mentioned earlier, investing legend Ray Dalio. He's going to give us a history lesson. He's going to join us at 8:10 Eastern Time this morning with his big take on tariffs, recession risks, and reshaping the world order. All of that coming up as Squawk Box rolls on right after this. Now for a look at the recent economic and market volatility in Europe and around the globe in response to U.S. tariffs. I want to bring in to our conversation this morning former IMF chief economist Simon Johnson. He's now a professor with MIT's Sloan School of Management and also a 2024 Nobel Prize laureate in economic sciences. And we are thrilled to have him here. As you're watching this all play out, and really I think we want to understand how you think the EU is going to respond to all of this. If you were to sort of map out the possible permutations, what does it look like?
Well, the EU is obviously thinking pretty long and hard about this, Andrew. They are not going to roll over. I don't think they're going to, want to seem meek or entirely compliant. They have offered a 0 for 0 deal on industrial tariffs, kind of a nice strong offer. I think they put that on the table before Liberation Day, and I think it's probably still on the table. And they could go as far as their so-called anti-coercion instrument, which will allow them to take countermeasures against U.S. exports of services. That would be pretty dramatic. But I think there's some countries within the bloc, including Ireland, for example, that are going to want them to tread carefully. So they'll try to negotiate. Just as Secretary Besant said on your show a little bit earlier, negotiations are open. It takes a long time. It's messy. But I think the EU will try to be constructive and positive about this.
Simon, the question is, to the extent that we're talking about that, tax. I mean, part of this is the tariff piece, and then part of it is going to be VAT and all sorts of other component parts to this, and each country is doing a different thing. And so I'm trying to understand how they would be able to do it as a block.
Well, the EU can do a lot of things as a bloc. That's not a problem, Andrew. It's slow and tedious and a little bit boring from an American perspective, sure, but that they can do. The value-added tax is a massive red herring, or worse than a red herring. Value-added tax is not discriminatory against imports. It's nothing to do with trade.
Simon, I don't disagree with you. I'm just suggesting if you speak to the Treasury Secretary or you speak to Peter Navarro, they would argue to you that the VAT is a component part of their problem with what's happening inside the EU.
Well, Peter Navarro definitely says that. And I listened very carefully to what the Treasury Secretary was saying on your show a little while ago, and he was not saying that, Andrew. So that the administration, once again, needs to get on the same page. And the VAT is going to be a very important sticking issue with the EU. They're not going to get the EU to roll back or withdraw VAT. It's a massive, very important source of revenue. Is how they structure their entire public finances. That's a non-starter. And so the question, Andrew, is, are we really in a good faith negotiation? 0 for 0 would be a pretty good deal, actually. And there's other things you could get from the Europeans, other things we could give them. Or are the negotiations entirely fictitious and it's just going to be a shouting match? In which case, I think we're back to a lot of problems for the world economy.
What do you make, though, of the politics inside of Europe as it relates to how they feel about the U.S. and how they feel about how this could all play out and how much leverage that would give the EU or not to make a deal?
Well, that's a great question, Andrew. Obviously, all of this is seen in the broader context of Russia, Ukraine, what's happening to NATO. Traditionally, the Europeans have been obviously very pro-American, very inclined to cut slack to an American president who might be facing various political pressures. But Mr. Trump is making these aggressive moves on Greenland, for example. They are not happy at all with his attitude towards Ukraine. They regard Mr. Trump as being something, I'm afraid to say, a bit of a patsy with regard to Mr. Putin, because the Europeans woke up some time ago to what Mr. Putin's true intentions are and why he doesn't actually want peace right now in Ukraine under current conditions. So this is a difficult starting point for the Trump administration, but the EU doesn't want a trade war. The EU will definitely do a 0 for 0 deal if that's on the table. That will be a pretty straightforward negotiation. That would bring a lot more confidence and calm, I think, to financial markets. And I think the ball is really in the administration's court to demonstrate that they're willing to negotiate in good faith with the EU. And then, of course, we come on to China, which is going to be much more difficult.
There's a piece in the Journal today, Simon. The president's foreign policy is doing irreversible damage to the greatest geopolitical brand ever created. Is the die already been cast? I'm not convinced that we're past the point of no return on that. And it was also pointed out to me yesterday that I think U.S. GDP's doubled in the last decade or something. Europe is flat. Who's getting screwed? I mean, who's taking advantage of whom? There's a lot of reasons why Europe is sort of mired in the muck, but that's the bottom line. Is we're doing pretty well globally as a country.
Look, Joe, we're doing great globally as a country. The headline numbers are very strong compared to any reasonable comparison, right? Some people have been left behind, absolutely. We need to do more for them. That's a totally reasonable issue. But the EU has got deep structural problems, which is what you're alluding to here. And they have not been ripping us off on trade. That's not one of the hot button issues. They need to invest more. They need to build more science and technology. They need to get stronger in various structural parts of their economy. We can help with that, but we can help by trading with them more, not by pulling them into a massive trade war. That's going to be bad for them and bad for us.
So then what's this? Why then, Simon? A campaign promise or I've thought, think if it was deregulation, close the border, cut taxes and shrink the size of the federal government, you didn't even have to do this necessarily. And in the midterms, you'd probably gain seats. The whole thing is confounding.
But Simon, one of the things, I don't know, if you were listening to that interview with Besson, one of the things that I found so fascinating was whatever these negotiations are, they may ultimately, in a way, not actually be about tariffs at all. Which is to say, but if you were listening very specifically, he talked, for example, about could there be some kind of energy deal among some of the Asian countries, South Korea and Japan, for example, in Alaska, and whether you could create jobs in Alaska. And that has nothing to do with tariffs.
It might all be negotiated.
But the point is, it might be this sort of patchwork of deals, and maybe this is just some way to try to create leverage over the globe. Now, I don't know if that ultimately works, because I do wonder politically whether other countries start to look at this as some other kind of scheme, and I just don't understand it.
Well, look, Andrew, I think Joe's exactly right. That you can make this kind of deal already. Before Liberation Day, you could do energy deals. The global demand for American LNG, for example, is very high and rising. So we can be a stable partner. We can export a lot of energy. We can have a ton of investment in our country in energy resources or in manufacturing. And this was already happening before the massive tariffs were slapped on. So I agree with Joe. I think the tariffs are not just unnecessary, they're massively counterproductive. Best case scenario is we have some long, tedious, drawn-out negotiations, which end us back with stuff we could have had anyway. And the worst case is that we destabilize other countries, their financial sectors. There are spillover effects to us. What's the point of that?
Simon, you're a very smart man. Thank you for joining us this morning.
Hence the Nobel Prize.
Hence the Nobel. But he gets told he's smart all the time, probably, at this point.
It just rolls off his back. I think he probably knew.
Can you do that part already?
Yeah, before we go to break, check out the futures. I'm trying to figure out whether whether Treasury Secretary, their negotiation. That's the word of the day. Anybody that didn't give Frank Holland negotiation as the word of the day was not on the right track. And I don't think we heard anything from the Treasury Secretary.
We started the morning at 6 a.m.
600.
About 650.
Yeah.
Now you're looking at better than 1,000 for the Dow.
And the NASDAQ.
And the
also.
NASDAQ's
That's
up pretty
significant.
significantly. S&P's up by 2.3%. So you're looking at some gains. The same thing was happening if you were watching Treasuries. The yields started picking up too. I don't know which came first, which was the chicken or the egg here.
I'm saying it's unreasonable. Squawk Box.
folks, check out Netflix this morning, up by about 2.7%. Morgan Stanley naming the streaming giant as its new top media pick and its new top pick in media and entertainment. It's calling that recent pullback a buying opportunity. Morgan expects the company to demonstrate relative resilience in a weaker global economy. And a quick check on Harley-Davidson as well. The company's CEO announcing plans to retire this year. A search is underway for his successor. That stock right now up by about 1.5%. When we come back, Silicon Valley is home to some of the world's largest technology companies, and it has felt some pain this week. It's Congressman Ro Khanna's district as well. He will join us next with his reaction to the tariffs and much more. Right now, though, as we head to a break, check out some of the mega tech names, all of them rebounding sharply this morning. Well, actually, up by 1.6% for Apple.
Becky's standing up.
By 4%.
Becky's standing up.
I'm standing up.
I want to try that.
I mean,
I know. I
it
want
was
to
good to
try
stand
that.
at the desk for a while.
Have you done that?
There have been massive declines in these stocks over this week. Apple down 19% over the last 3 days before we headed into these gains this morning. We're going to talk about that with Ro Khanna. Squawk Box will be right back. We're all going to stand at the desk.
Stand
It feels
up.
better. All right, welcome back, everybody. Apple is shifting part of its iPhone production to India after President Trump threatened an additional 50% tariff on Chinese goods if Beijing doesn't roll back its own 34% increase. Joining us right now is Congressman Ro Khanna, whose district sits in the heart of Silicon Valley. Congressman, welcome. Thank you for being with us this morning. We've been talking about the losses that have been felt in the stock market over the last 3 days. Obviously, we're looking quite a bit better today. But for companies in your district, it's been severe. Apple, for one, has lost 19% over the last 3 trading sessions. That's a decline of about $638 billion because of these tariffs. What are you hearing from your constituents? What are you thinking about these things?
Well, I'm hearing that these are some of the most self-destructive, wealth-destroying policies that any modern president has had. Look, a lot of people in my district who voted for Trump don't understand what he's doing. Some of the reason they voted for him is they thought they would be able to do more mergers, they'd be able to IPO, and all of that has been put on hold. But it's not, as you know, just hurting the tech companies. I mean, this is hurting manufacturers, it's hurting small businesses. It across the board has hurt the country without actually incentivizing new manufacturing to come here.
Do you get the sense that these are permanent tariffs, or do you think that this is a negotiation to try and get a better deal for America with all of these other countries?
The truth is, I don't know, and no one in the country knows, and that's part of the problem. If you're Mary Barr, are you going to go to your board and say, let me build new factories here, or are you going to think, well, Trump himself is saying that this may change in 2 months. His Secretary of Treasury is saying it may change by June. And then the problem is, even if they fix this, even if they take away the blanket tariffs, how confident are you going to be that they don't wake up in September and impose them again? And so there is permanent damage done because he has shaken the confidence and trust of the business community. By the way, many of them who gave him the benefit of the doubt. I campaigned for Kamala Harris. Many of them voted for Trump, and now they're shaken.
That's something we heard from Tom Lee this morning, just this idea of shaking confidence. What would it take to change people's minds? I mean, I think especially if the concern is that business leaders are not going to move forward with plans, they're not going to spend capital or commit capital, they may not be hiring as a result. What does it take to get them a little more confident to try and prevent a downturn in the economy?
Honestly, one, I think he needs a reset on his economic team. I mean, it just brings someone in who may share his view of restoring manufacturing, may believe that you need smart strategic tariffs in certain places, but will assure everyone that you're not going to have blanket tariffs again, you're not going to be tariffing allies. Bring in new people on an economic team, assure the country you're never going to do blanket tariffs again, that was a mistake, and that you're going to look at things sector by sector and not have these kind of policies.
You mean kick out Peter Navarro and Howard Lutnick, who are seen as the two people who are most in favor of tariffs? What are you suggesting, Rob?
Well, Lutnick would be a good first step. I mean, you know, Lutnick, I don't like picking on people, but he was on TV on Sunday saying that by having these tariffs, we're going to be doing more screwing and assembling of screws of the iPhone. And today, I'd love Howard Lutnick to come to my district because, look, the screws and the assemblies of screws are like 0.3% of the iPhone's cost. You have the display, you have RAM memory, you have the camera, and I know Lutnick loves 19th century policies, but he should understand 21st century production. So he'd be a great start. And putting someone, there are a lot of people, they're Republicans, but Kernan would be good. I don't know, I'm sure Joe isn't for all these tariffs. And so bring someone in who's going to have some common sense.
Congressman, I don't think the administration is going to necessarily be listening to you or any Democrats. What do you hear in Congress from your Republican counterparts? How do they feel about all of this?
You know, Don Bacon has been terrific. He's a Republican from Nebraska. He and I serve on the Armed Services Committee together. He's bringing forth bipartisan legislation to reassert Congress's right over the tariffs. We already have a few Republicans on board. I think it's going to get Republican support. I mean, this is something that affects farmers. It affects small businesses that rely on inputs. It affects manufacturers because they need a lot of the products that are coming into the country to produce things. Those have gone up. So I think this is the first time, actually, I've seen Republicans criticize the president.
You have your own bill that you've brought forward. You're calling it the Drain the Swamp Act. It brings back White House ethics rules that were gotten rid of. It's an interesting point, but I can't imagine that's going anywhere in Congress given the leadership structure right now.
Look, even some of the MAGA folks were for this, and it says that any president, not just this one, but going forward, that the White House officials should not get gifts from lobbyists. It used to be the rule. There was an executive order that was repealed. Let's just make it permanent. No gifts from lobbyists to White House officials. But right now, beyond that, I mean, obviously that's an issue of transparency. I just want an issue of competency. I don't care if they're Republicans. Just find people who've understood basic economics and understand that when you have blanket tariffs and start a trade war, that's bad for the United States and the global economy.
You're from California, Ro. I mean, I love you, but preaching competence and great government and knowing what you're doing, knowing what you're doing economically, it's just rich. But that's my only comment. Just I don't know what you say about me. They might listen to me if I said it. If I did sort of say it about tariffs, I don't know why you don't just do deregulation, keep taxes low, do DOGE, close the border. There's all these things. You'd be at 70% probably. I don't know. I'm not sure what the end game here is necessarily, Ro.
Well, Joe, I appreciate you calling balls and strikes on it, because even Reagan was very eloquent against these kind of blanket tariffs.
Right, I know.
And so, and I think Musk is having doubts about it from some of his Twitter feed. But look, the reality is I share the president's goal, and I know you do, of building us into a manufacturing superpower, having advanced manufacturing. But you need to develop the workforce for that. You need government finance for that. That's how Silicon Valley was built. NASA said, if you build semiconductor chips, Intel, Fairchild will buy them. And he hasn't come with a comprehensive policy of how we're going to do this. Instead, he spooked all these manufacturers, and they are not investing in building new factories. If that's the goal, the policy isn't working.
Like the whole idea, Ro, that if you build it here, you won't be tariffed. What happens if we get to 0-0 with everyone? Then you don't need to build it here. I don't get it.
That's the other piece of it. Even if you have the 10% piece, it's not clear that you still build it here. Even if you have a across-the-board 10% piece.
Right.
If you're Tim Cook, I'm not sure if you have a choice between India and here that you necessarily go here, Ro. What do you say to that?
Well, this is why I think you need financing incentives that the CHIPS Act did. Look, China, and I don't think we should imitate them, but they're literally pouring trillions of dollars into industrial lending. And they're giving their companies money to go build new factories, new AI. It's not just the tariffs that are going to help our companies here. We've got to say, if you build it here, the government will buy it, at least in the beginning, to help it scale. We're going to help you finance. We're going to help you get the plumbers and electricians, the workforce that you need. We're going to help you get the technologists that you need.
But the conundrum is there's a labor cost. It's not just the talent. Look, there's a skills issue, no question. But then there's just the labor cost unto itself, which is to say that at least for the foreseeable future, it will be cheaper to hire folks in India than it will be to hire folks in the U.S. The question is, what's the delta between those two? But I would argue to you, I would imagine, at least over the next decade, if not longer, 2 decades, that the delta will be high enough that the marginal cost, even if you had a 10% tariff in place across the board, that you still might make the choice to effectively manufacture elsewhere and import.
Andrew, you're absolutely right about the delta on labor costs, but the one issue is productivity. I mean, labor is usually 7-10% of some of these high technology products, and even the modern steel. And so if you have factories that have more robots, that have more automation, we can compete with productivity if they have financing.
By the way, you're raising a very important point, Ro. Because the truth is, and I've heard a lot about this from technology leaders in the past week, if in fact they do decide to manufacture more in the United States, it's not clear that it's going to necessarily help the job picture so much. Because the truth is that most of it, or at least a lot of it, will be done by robots. And that's a whole separate map to think about.
I think it's completely right. I don't think we can be dishonest to say somehow there's going to be this massive spike of manufacturing employment. But what it can do, if you even have 500 people in a factory as opposed to the 5,000 you used to, is bring wealth. And it can bring wealth into communities like Johnstown, Pennsylvania, Galesburg, Illinois, Warren, Ohio. Yes, you're not going to have a 4,000 person plant, but now you have a 500 person plant, and people are looking after the machines, they're programming the machines, they're working if it breaks down, they're doing quality control, and we're bringing modern wealth and modern national security into the country. That would be a thoughtful thing. That's what I was hoping the president would do. I would have worked bipartisan to help on that, but blanket tariffs aren't the way to get there.
Congressman Khanna, thank you for your time, for joining us this morning, and we hope to talk to you again soon.
Thank you for having me.
It is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. The futures this morning have been pushing steadily higher. You're now looking at the Dow futures up by about 1,075 points. S&P futures up by 130. The NASDAQ up by 420. It does come after a complicated whipsaw of a day yesterday, and some major losses over the last 3 sessions, but you are, again, watching some pretty strong activity to the upside this morning. It's coming as we are watching Treasury yields rise as well. The 10-year is now back above 4.2%, 421. The 2-year is at 379. Oh, also let's check on the volatility index at this hour. It's down by 13%, back to 40, which is still very elevated from where we were just a week and a half ago.
We would have thought 1,000 points is pretty good.
Yeah.
If we didn't know the market could go down 2,500 points.
Right.
Twice. Right. Earlier on the show this morning, Treasury Secretary Scott Bessent joined us and had this to say on where the U.S. stands on tariff negotiations.
President Trump has maximum negotiating leverage right here, right now. And I think it would be a mistake for anyone to think otherwise. And as I said, many of our trading partners, they have queued up and they have kept their cool. They have not escalated, and they will get priority in the queue. I think it was a big mistake, this Chinese escalation, because they're playing with a pair of twos.
We will be speaking to legendary investor Ray Dalio. That's coming up in just a few minutes. We'll get his reaction to those comments and much more. Right now, though, we want to get over to Dom Chu. He's been taking a look at this morning's pre-market movers. And Dom, what's been driving the way for these additional gains we've seen this morning?
It's certainly the Mag 7 overall, but there are other key sectors that are in focus right now, Becky, to your point. One of those is actually healthcare, and most of those stocks are moving higher. And this is all after the federal government announced an estimated $25 billion increase in the payments made to insurers that offer Medicare Advantage or Part C plans to senior citizens. Payments will increase by about 5% in 2026. That's more than double the previously proposed bump up. So you got companies like CVS Health, also United Health, Elevance, some of those names that offer some of those Medicare Type C plans are all higher. Humana's, by the way, up by about 14% right now. So keep an eye on that health insurance side of things. Now let's check on the chip stocks, a big part of the story, also higher as part of today's rebound. NVIDIA climbed 3.5% yesterday. It's up another, call it 4.25% this morning. Other names, Broadcom, Taiwan Semiconductor, also ARM Holdings, also climbing. Now, the direct import of chips to the U.S. are exempt from Trump's latest tariffs, but most chip imports are, packaged and inserted into electronics overseas and then sold back across borders, meaning those electronics are still subject to the duties. But President Trump did speak to reporters last week and said that some kind of action on chips could be coming at some time in the future, so keep an eye on those computer chip stocks. And then the big banks, also a big part of the story, they also made a comeback yesterday. The largest U.S. lenders like JP Morgan Chase, Bank of America, Wells Fargo are all higher, but those shares are still down about 10% in the past week and more than 20% off their 52-week highs. We'll be watching a lot of these names later on next week when JP Morgan Chase, Wells Fargo, and Morgan Stanley all report their results before the bell. So Andrew, keep it on the big banks, the chip stocks, and healthcare. I'll send things back over to you guys.
Okay, thank you for that. We're watching prices of crypto right now. The U.S. Justice Department disbanding its National Cryptocurrency Enforcement Team. In a memo that was viewed by Reuters, the DOJ now saying it's going to largely stop targeting virtual currency exchanges and offline wallets. Will instead order prosecutors to focus on cryptocurrency cases with ties to cartels and terrorism. We'll keep our eyes on that. Coming up on the other side of this break, you don't want to miss it. Legendary investor Ray Dalio is going to join us for a first on CNBC interview. Since the market downturn and tariff turmoil, we've got a lot to talk to him about. And then Senator Rand Paul's going to spend some time with us. He said, quote, tariffs and taxes and Americans are paying the price. He's here to explain what he means. As we head to a break, headline for you. Reuters reporting that Micron will impose a surcharge on U.S. customers starting tomorrow to account for President Trump's new tariffs. Squawk Box coming right back.
Insurance.
Welcome back to Squawk Box. Bridgewater Associates founder Ray Dalio posting on LinkedIn and weighing in on tariffs. He says it's more important to focus on the idea that, quote, we're seeing a classic breakdown of the major monetary, political, and geopolitical orders. This sort of breakdown occurs only about once in a lifetime, but they have happened many times in history when similar unsustainable conditions were in place. Joining us right now, first on CNBC, is Bridgewater founder Ray Dalio, and we're thrilled to have you here on a morning when we're still trying to make sense of what all these tariffs mean, Ray, and frankly, how all of this plays out. So to the extent that you can help us with the history, or at least a history lesson, if you think there are parallels, how does this play out?
Good to see you, Joe. Andrew, Joe, and Becky. I think that we don't understand how the cycle goes because it comes along about once a lifetime. But there are orders, you know, there are systems, and the systems break down for certain reasons, and it creates cycles. For example, there's a monetary system, and then there's a debt cycle. And so as a result, we now have, you know, one man's debts, another man's assets. And when you build these up and you get to a point where you can't sustain that, you have a debt issue. We have a debt issue. We can get into that. But there's a monetary cycle. There's a internal political order cycle that takes us from one political order to another political order, in which there's then classically great turbulence between the left and the right. And because of disorder, particularly in democracies, there's a lot of fighting because there needs to be cooperation, compromise, and so on. And we're in the process of changing that order. In addition, we have the international world order. International world order began in 1945. There's a war. You win a war. The dominant powers get to set the rules. That was a series of multilateralism, things like the United Nations, World Trade Organization, World This and World That. And that multilateralism is then breaking down for unilateralism for the same reasons. So there are these three orders related to too much debt. Debt is money. Second, internal order. How does our system work? Who's going to get control of this problem? And then number three, in addition of the five main forces, there's also throughout history climate, acts of nature. Droughts, floods, and pandemics have killed more people and toppled more orders. And then there's also throughout history, man's inventiveness and new technologies, which is creating this transformative result.
Right.
The interactions of these is what's going on. So if we look at tariffs represent a dealing with the imbalances. The imbalance means we have a tremendous capital imbalance and a tremendous trade imbalance, which is unsustainable. And so that's the backdrop of this. Related to that is also the international conflict. How do you have dependency, mutual dependency? How can the United States be a safe country and not manufacture things and have to import them for China? Or how can China be safe in terms of having capital, an American capital? Those connections are breaking down. So that's the essence of the backtrack. When we get into the tariffs, I'm sure we'll get into it.
Well,
but that's
Ray, that's a great backdrop to understand the way you're thinking about it contextually. But let's go straight to the tariffs, which is to say, how do you think, therefore, they play out? Is there, given the history that you talk about, is there the political appeal, either here in the U.S. or elsewhere, for these tariffs ultimately? And from an economic perspective, as we're all watching the market today, it's gotten a little bit better, but obviously, folks have lost 10%. Someone said to me last week, this is like a wealth tax, except that nobody gets the money. In that, 10% of a lot of folks' wealth vanished overnight as a function of at least this discussion thus far. So what happens?
Well, mechanistically, it raises costs. It lowers revenues for companies. I mean, what does it mean for a company? It means costs are going to go up, revenue is going to go down, and capital is going to be harder to come by. And so, and then we're trying to replace manufacturing. I mean, I agree with the problems, okay, about the fact that we don't manufacture and that there is a problem with that. But there's a structural problem of whether we can manufacture. We have a population that basically 3 million people, 1% of the population, is incredibly brilliant. I mean, they go to the best schools, they come out, they make the unicorns, inventiveness. Half of which, by the way, are foreigners. And at the same time, they are making the unicorns. At the same time, what we have is 10% of the population around them that's doing very well. The 60% of the population has below a 6th grade reading level. And it's tough to be productive. So when we agree with the problem, too much debt, Secretary Bessent and others agree we should get it down to 3%. We have to get the budget deficits down to 3% of GDP. This is not, we all agree on the problem. The question is, what do we do about it? How do you create that self-sufficiency? And so from a practical point of view, that manufacturing is very difficult under this sort of circumstances to create within the United States, yet it's needed.
So therefore, you agree with the president? You disagree with the president? I'm trying to understand what the conclusion is here. If the president is watching you right now, if Scott Bessent is watching you right now, you're telling him what? This is a good idea? You're telling him abandon this idea? What are you saying?
I agree with the problem, okay? I am very concerned about the solution, okay? The practicality of the solution. In other words, I think that this is going to create not only the problem, the capital markets problem that I'm talking about related to prices going up, costs going up, prices, revenue going down, and capital problem. But I also think that this is going to create great sand in the gears of production worldwide. At the same time, I do agree that this interdependency, this issue of productivity in the world in which we have to be competitive and productive, and we're not competitive in producing things, is a longer term problem, not an easy one. And I do expect that it is going to have political consequences. This is the nature of the cycle. It is coming also at the same time as we have a budget issue. Now, the budget issue is a comparably important issue. So as we look ahead in the months ahead, we have to get the budget deficit down to 3% of GDP. I worry about that at the same time as this is happening. These are not easy problems to solve, I'm concerned, because the bigger problems exist. The debt exists. You can't get around the debt. The overspending exists. You still have that. You still have that competitiveness issue. These have repeated throughout history. We're in a period that's very much like the 1930s.
You know, Ray, I think if China didn't exist, I'm not even sure we'd be in this place in terms of public sentiment for tariffs. Not very many people disagree that we need to do something, even with tariffs, to try to deal with China. And I know in the past you've talked about China, and there's been times where I thought you were kind of I don't know, not pro-China, but less hawkish towards China than a lot of people that we have on. But this is going to be the most, just look at the rhetoric in the last couple of days. This might be the most intractable part of this whole tariff, whatever this is that we're in right now, the age of the tariffs. But I don't know how you finally resolve things with China. I don't see an end.
I'm not ideological. I'm like a mechanic. And so when we're talking about this, I'm saying that China, now, I'm agreeing with you. China now manufactures more than the United States, Germany, and Japan combined. It's a dominant competitive manufacturer in the world. And we have lost manufacturing. And we are then creating, we're the biggest consumers in the world. And so through this, we're financing that consumption with a lot of debt. So we have a very, very difficult situation.
Hey, Ray, what does this mean for, let's say, our purchases of our treasuries by foreign investors in the near term?
The supply, foreign investors as a group have large exposures in their portfolios, outsized exposures to debt in general, and to have too much in terms of U.S. debt. The quantity that we have to sell them, which is about 6.5% of GDP, is an amount that they don't want to buy, partially because they have too much, partially because also now this is a risky world for various reasons. Worries about sanctions. This all happened in the 30s, you know, the conflict between Japan and the United States and freezing assets, sanctions and such things enter into it. So there's a supply-demand imbalance, the quantity that exists of debt and the quantity that has to be sold of debt. That's just the supply-demand imbalance. As a result, we have to deal with that supply-demand imbalance.
But do you think that leads to higher yields? Because part of the Trump administration's plans seems to be trying to get lower interest rates so that you can lower things like the service for debt that we paid last year to the tune of $1 trillion. I mean, it seems to be, and that's something Scott Bessent, the Treasury Secretary, has even said in the past, it'd be nicer to have lower interest rates, not just to lower our interest costs, but to also help the bottom 50% of Americans who have a lot of debt relative to their pay. Are we going to get to that point?
Exactly. But there are two ways you lower interest rates. You lower interest rates by improving the supply-demand balance, or you lower interest rates by forcing them down and printing a lot of money. Those are the two ways, right? So there are three parts of the balance that we should think of. There's spending, there's taxes, and then there's interest cost. And if they were to lower achieve a better balance, and I'm not saying which way to do it, that's political, that's up to them. But if they were to improve the supply-demand balance, that would lower interest rates in a fundamentally sound way, and that would make the deficit. Right. So there are three ways that you can achieve that 3% of GDP target that I believe needs to be shot at. But you just can't make interest rates go down. It's not healthy to make interest rates, force them down by creating unnaturally low interest rates and printing a lot of money.
Right.
So that's key.
So Ray, let me ask you just the very direct question that I imagine everybody who's watching this right now wants to know. Inside Ray Dalio's brain, as you're watching these markets play out, do you say to yourself that the markets are overpriced, fairly priced, underpriced? Is this a falling knife that you want to catch? Is this a great bargain that you want to buy? How should the public think about this in this moment?
The public, I don't want to come on your show and market time and say buy, sell, and something. Here's what I want to tell the public, and so on. You have to have a balanced, well-diversified program and a game plan that you carry through over time. In my period of time of being an investment manager, I've seen the World Trade Center go down. I've seen 2008. I've been through all of those. The most important thing is to be able to have a well-balanced, diversified portfolio that you know exists. And how to do that is a subject. I just put out a course. I won't get into it. But how to diversify. Also understand what you don't know. By understanding that you can't time the market, you're not going to be successful. You're going to react emotionally. So what you should do, what I started to do when I was, didn't have the financial resources, I think, how much money do I have saved if I didn't get any money coming in? How many months could I live on the money that I have? How many months? And then how many years could I live on the money that I have? And then I divide it in half if it goes down 50%. Once you're in that position where you can establish your safety in terms of a diversified portfolio, that diversified portfolio means don't think cash is safe, because cash is the worst investment that you can make over a period of time. And you have to look at your buying power in inflation adjusted terms. And so, for example, if the Federal Reserve drives down the price of cash and prints money, you're going to lose buying power, as you have recently lost buying power as a result of doing that. So have a well-diversified portfolio and also be very concerned about the debt issue.
Ray, want to thank you. It's great to see you, and I hope you come on back as we're all trying to figure out where this all heads. Thanks.
Thank you all.
All right, still to come, two healthcare-related stocks moving in the pre-market. We're going to tell you what's going on after the break. Then, Senator Rand Paul was one of the first Republican senators to speak out against tariffs. If you had to pick someone that might do that. You might have thought it'd be Senator Paul. Trying to figure out what is iconoclast, what is he, a rebel, a freethinker?
He's unique.
He is unique. He's going to join us shortly. We'll be right back. Earnings just out from Walgreens, Boots Alliance. 60, it was earlier, these were actually reported, 63 cents. Beat estimates of 53, revenue also above expectations. Company withdrawing a full year guidance, citing its agreement last month to be taken private by Sycamore Partners. That was a $10 billion deal. That transaction is expected to close in the fourth quarter.
All right, we have been watching shares of CVS Health in the meantime as well. The company announcing a transition plan for its CFO and providing a financial update. CVS says that it expects financial results to meet or exceed its previously issued guidance for the full year of 2025. That stock was already higher after the Trump administration announced much higher private Medicare payment rates than expected for 2026. And you can see that stock this morning up by about 10.5%. Up next, Republican Senator Rand Paul has said that tariffs are a terrible mistake. He will join us to explain it next. Right now, though, as we head to a break, let's take a check on oil prices this morning. They're up by about 1%, or 0.9%, 61.24 for WTI. Brent up by 0.7% to 64.67 a barrel. Squawk Box will be right back.
Welcome back. Someone once said this. The truth is, tariffs are taxes. They don't punish foreign governments. They punish American families. When we tax imports, we raise the price of everything, from groceries to smartphones, washing machines, and every other conceivable product. It is time that we save the American people from high prices and prevent the Democrats' restoration of power. It's time to terminate the tariffs. Our next guest, that's who, Republican Senator Rand Paul from Kentucky. How did we get here? How did the Republican Party get here, Senator?
How did we all get here? I mean, the whole debate is so fundamentally backwards and upside down. It's based on a fallacy. And the fallacy is this, that somehow in a trade, someone must lose. That somehow when you trade with someone, there's a loser and someone's taking advantage of you and China's ripping you off or Japan's ripping you off. It's absolutely a fallacy. Every trade that occurs in the marketplace is mutually beneficial. If you have a free society and I trade with you, if you want to sell me your coat and I give you $200 for it, we both agree to it and we're both happy with the trade. No American consumer trades with China. They trade with Walmart, or they may buy something from China, but they individually buy something they want and they make a decision. The trade is always a win-win. Now, you could artificially do this accounting between countries and say, oh, trade deficit, look at this trade deficit. But I have a trade deficit with my grocery store. The people who employ me, if I work for Corvette and they employ me, they have a trade deficit with my labor. They buy my labor and I never buy their cars. So you can have this artificial accounting and it makes it look like a bad thing, but you have to ask yourself, is trade good or bad? And if you look at the trade deficit, in times of a recession, the trade deficit goes down. So if the tariffs push us into a recession, we could reduce the trade deficit because we're all buying less stuff. We have to get back to the fundamentals of, is trade good or is trade bad?
Senator, you are maybe getting some support and some praise from Democrats, but the support and praise from Republicans, you're saying that you're getting it, but these are individuals that you don't even want to be on the record for saying that. Is that fair to say?
It's a quiet whisper, and people come up to me in the hall. You know how in Atlas Shrugged, they would come up and say, who is John Galt? They whisper in my ear, free trade is good, keep going, keep going. But they don't want to say it because of the politics of it. And look, when I put free trade articles on my Twitter account, I get mobbed. I mean, I get what they call ratioed. I get more comments than likes, which they say isn't good. But we have to have this debate, and people have to understand that trade is between individuals, not countries, and it's a false accounting. So I'm committed to this. I'll keep talking about it. And there's one graph, if you look at it, and it has trade. Trade for the last 70 years went up exponentially, international trade, but so did GDP per capita. We get wealthy with trade, not without trade. It's such a fundamental debate that it's worth having.
And I get all that. So it's almost like it was almost like a creep. Okay, what about some targeted tariffs? Okay, well, let's do it this way. Well, what about China? And then there's fentanyl, and you can sort of see the creep, right. Mission creep, or whatever you call it. Now we're at across-the-board tariffs, and even Republicans that in the past would have called themselves Reagan Republicans are kind of going along with it. How does it end?
Tariffs, like sanctions, are good until they're applied. Once they're applied, they're of no value and they're a detriment to the economy. But if you threaten tariffs and you get other people to lower their tariffs, you can say, oh, this is wonderful. If you threaten sanctions and you can get a country to change their behavior, that's wonderful. If you have them in place, they're only of value if you can remove them. So if you can remove tariffs and lower tariffs and get more equal tariffs, that's good. But we have to start from talking about the truth. One of the things they say with Canada is, oh, there's a 270% tariff on dairy products going from the U.S. into Canada. Well, you know what the real tariff is? 0. That's a big difference between what the truth is. So there's a certain amount of goods, dairy goods, that go to Canada every year, and they go at 0%.
If we exceeded a certain amount, there's this ridiculous 270% tariff, but we've never encountered it, and the USMC renegotiated it and raised the level that's under zero. Trump should be congratulated for USMC raising the amount of dairy that goes in at zero, but we have to have an honest debate. We can't go around saying that there's a 270% tariff when that's not really the truth.
Senator, we had Ray Dalio on talking about how he understands why we got to this point. There are sections of the country that have gotten hollowed out by free trade, people who lost their jobs, industries that left towns upended. What could and should we do to help those who have been hurt by free trade if it's not tariffs?
The middle class, if and when they've been hollowed out, have been hollowed out by free spending, by debt and inflation. So the last 4 years were difficult for the middle class, and they lost ground, and the average family income went down because they lost purchasing power. Their wages didn't keep up with inflation. Inflation comes from debt. It's nothing to do with free trade. Trade is proportional to wealth.
What happened, Senator, over the last 50 years, losing 60,000 factories? What should we have done about that? You can see where the president's coming from.
Yes and no. If you look at the last 60 or 70 years of household income, the lower class under 50,000 shrunk slightly, the middle class shrunk slightly, and you know where they all went? To the upper class. Over $100,000 category tripled in constant dollars over the last 70 years. The truth, it's just, we have to discuss the truth. The middle class shrunk slightly, but they became richer. So, you know, there's so many good facts on this. Steven Pinker's written about it. HumanProgress.org has written about this. We have to work on facts, and it's the job really to point out fallacies. It is a fallacy that people have gotten poor. The world is richer than it's ever been. 100,000 people leave poverty every day. I mean, it's extraordinary, the phenomenon of capitalism, but trade is an integral part of capitalism. Yeah. Trade is just voluntary association. It is part of capitalism.
We learned all this. Pencil. I mean, what would the world look like without comparative advantage and everything else? Are we rewriting the rules of capitalism? It's crazy.
Well, that's why we can't give up on this. This isn't me versus Donald Trump. I like Donald Trump. I've supported most of his cabinet. I'm a chairman of a committee. I've pushed his people through. Will continue to do so. I want to cut spending. I want to balance the budget. I support so many things, but I can't support a fallacy that is going to make us lose our wealth. I have a retirement account too. I want my retirement account to stay there, and I think tariffs is going to decimate it.
Okay, so Senator, I got maybe a difficult question. If you were to advise the leaders of foreign countries that now have to negotiate with the president, what would you tell them to do? Would you tell them to ratchet things up? Because ultimately you think these tariffs are a bad thing, and maybe that would force the president to stand down? Do you think the president looks at the market and says that he has less leverage, more leverage? How would you think about it in that context? And then separately, I'll ask you later what you think the CEO community that's thinking about where they're supposed to invest and what they're supposed to do in this moment are supposed to do.
Right. You know, I'm fundamentally an American. It's hard for me to take the side of another country, but like a CFO has to do that. So if you're a CFO or a Treasury Secretary of a country, you have to do it. When you argue for a trade war is based on emotions, not facts. So the trade war won't make them richer. The trade war will say, damn it, we're going to get even. We'll get even with those SOBs, but it doesn't make the foreign country richer either. The smartest thing actually would just be to keep your tariffs low and let the U.S. founder in their problems. But the thing is, that's not what typically happens. Emotions take over, and right now is ratcheting up. But I can tell you this, if people care about the freedom of those people in Taiwan, they shouldn't want to cut off all trade with China. Okay. At the moment there is no trade with China, that is the moment that Taiwan will be taken by force.
Senator,
the main thing that keeps Taiwan as free is trade.
I couldn't get the Treasury Secretary to take a hike in the top rate for individuals, which we know a lot of small companies and medium-sized companies pay that rate, all the subchapter S's and pass-throughs, et cetera. I mean, is that going back to 39 cents, whatever it was, or even above that? And that would go along with Republicans suddenly like tariffs and like raising taxes on corporations.
I think there's more consensus on the taxes. I'm very hopeful that the taxes become permanent. The tax cuts from 2017, I
Like they
supported
are.
them. I would have voted for them to be permanent.
At
I want to keep them
37?
the same, or lower. No, keep them the same or lower. I'd be for lower as well, but I'm not for
The
letting
highest
them go
rate,
back up.
No, you don't want to raise the
But-
highest rate, do you? There's Republicans talking about raising the higher rate.
Yeah, I don't want to do that. The 2017 tax cuts brought the rates down. Let's at the very least keep that. But I will tell you, the whole thing's been muddied up because they want me now to vote to raise the debt ceiling $5 trillion, which is irresponsible. And really, then we have no levers to watch the big spenders. I propose that we raise the debt ceiling 3 months and do it every 3 months and keep voting on it until they behave themselves and quit spending so much money they don't have.
Senator, you are so unique and so independent. You're such an independent thinker on things. Has the administration spoken with you about any of these issues? Because sometimes you agree with them, sometimes you don't. You come at it from your own perspective, and there is no dogma when it comes to you from a political spectrum.
You know, I consider that I still have a good relationship with the president. I love playing golf with him. I've played golf with him a dozen times. I saw him at Mar-a-Lago a month ago. I communicated with him last week. He does communicate with me sometimes in all caps that I need to get together and understand how good tariffs are. But we can have disagreements because to me, there are things in this town that are fundamentally partisan. The impeachments they did were horrific, and I led the fight against the impeachments and would do it again. I supported Donald Trump, do support Donald Trump, but I don't support the tariffs and I don't support debt. And so I have to fight those battles, or who would I be, or why should I be here if I'm not willing to fight for what the people sent me here to do?
I was thinking how smart your dad was. He named you after Ayn Rand. And then you said Atlas Shrugged, but that's totally fake. I'm going to start that rumor now. Wow, what a cool name, Randall. Your name was Randall, and people called you Randy till your wife started calling you Rand. So you can't, don't.
Yeah, that's right.
It's not from Ayn, not from Atlas.
Why change an urban myth when it sounds so good? It's better than the truth. It's much more interesting than the truth.
It's so much. I'm going with it. In fact, I'm going to forget that I even found out it wasn't true. Senator, thank you. From the great state of Kentucky.
Thank you.
Almost as good as Ohio, but it's something to aspire to. See you later.
Coming up next, a couple of big movers in the pre-market this morning, and then we're going to talk market strategy with longtime Oakmark portfolio manager David Hero. Squawk Box coming right back.
Pershing Square founder Bill Ackman posting on X in the past few minutes. Here's what he most recently is saying. Some have misinterpreted my thoughts on tariffs. I'm totally supportive of President Donald Trump using tariffs to eliminate tariffs and unfair trading practices of our trading partners and to induce more investment in manufacturing in our country. I am advocating for a 30, 60, or 90-day pause before the tariffs are implemented tomorrow to enable negotiations to be completed without a major global economic disruption that will harm the most vulnerable companies and citizens of our country. If a country does not negotiate in good faith, then Donald Trump can bring the hammer down. But doing so without giving time to make deals creates unnecessary harm.
It's kind of like, I'm in favor of tariffs as long as we don't really have any tariffs.
Right. As long as we.
I guess anybody could say
Look,
that.
there have been lots of complaints.
You could
about
use
the
tariffs to get
how
rid of
these
other
been-
tariffs.
Yeah, there have been a lot of complaints about how these have been implemented, I would say.
Well, there's some across the board ones too. But
Look, Bill has been, by the way, interestingly, Bill went on a rampage over the weekend
Yeah.
on this issue and was very direct. And then, as you noticed, yesterday tempered some of his comments about
Particularly going after Howard Lutnick.
about Howard Lutnick, and now seems to be tempering his comments again. So, you know,
he's getting some pushback from the White House?
I don't know what's.
Well, you're saying something,
I'm
so
saying
just
the line
spit it
is
out.
moving. I'm
Just
saying the
spit it
line is
out.
moving.
Spit it out what you're saying. I
saying
can't.
the line is moving.
Up next, we're going to talk markets. You always say what you think, but sometimes it's convenient. A long-time Oak Market portfolio manager David Harrop. No, even with me.
If I really told you what.
Squawk Box will be right.
.com.
Well, just over a half hour to go before the opening bell on Wall Street, and we are seeing the market sharply higher. Dow futures indicated up by more than 1,000 points. S&P futures up by about 125. The NASDAQ indicated up by 400 points. Joining us right now is David Harrop. He is Oakmark's CIO, International Equities and Portfolio Manager. And David, why do you think the markets are higher today?
Well, I think some of the uncertainty regarding tariff policy, and the uncertainty is whether someone believes that the tariffs are really going to be a good long-term solution to clear a trade deficit, or are the tariffs being used as a bargaining chip? And of course, I mean, this is bifurcated. It's one way or the other. And the first way to use this as a device to erase a trade deficit versus a bargaining chip, I think was seen as very destructive. And now there's evidence that perhaps it is being used as a bargaining chip.
Does that give you the confidence to think that this is a place people should buy in?
Whether we buy in today or tomorrow, we behave as long-term investors. We sit back, we value businesses based on fundamentals and cash flow streams, and we try to take advantage of moments like this, exactly when there's so much fear and panic in the markets, driving prices of the equities moving in a very different direction than underlying intrinsic value. So whether a particular day, a particular moment in time is a buying or selling period is moot for us. What we really look for is the difference between our measurement of intrinsic value and where Mr. Market prices something every second of every trading day. And it often, of course, provides us with opportunities. One of the things we've seen in the markets over the last decade is the weight of money going into very, very narrow areas, the U.S. and U.S. growth in particular. And I think what we're finally starting to see is some leveling out of this. And places like international and domestic value, which have been ignored over the last 10 years. So I think diversification pays off, and instead of trying to trade every short-term movement, I think investors should look where values actually exist. And where they existed are pockets of the global equity markets that have been ignored over the last decade. And now we're starting to see the first quarter, there was some pain to ignoring value investing. There was pain to ignoring international investing. And perhaps now we're finally starting to see this. And I think this is what investors should be looking at, is where they could take advantage of situations where the market structure was extremely lopsided, and we're starting to see a leveling out.
David, you sound downright enthusiastic this morning, so we will end it on that note. Thank you for joining us today.
Thank you for letting me on my favorite program.
Oh, we hope to see you again soon, David. Thank you. Folks, that does it for us today. We are sharply higher this morning. Squawk on the Street is going to pick that up, and we will see you right back here tomorrow. Bye.
Good Tuesday morning. Welcome to Squawk on the Street. I'm David Faber. He is Jim Cramer, and we're live from Postland at the New York Stock Exchange. Carl's on assignment today. Let's give you a look at futures. Of course, if you've been paying attention, you know we are set up for a far higher open. Bit of a change to what we've been seeing of late, certainly, when we get to the open. But that's still a half hour from now. Let's get to our roadmap. Of course, as you might expect, it is about that bounce and whether it will stick. Wall Street is looking for some reprieve, of course, after suffering what have been the biggest equity losses we have seen in the broader market since the pandemic. Plus expanded Trump tariff threats. Now, China is vowing to, quote, fight to the end. That's a move which Treasury Secretary Bessent calls a, quote, big mistake. And we're also going to keep an eye on the health insurers. Good news if you own them. Stocks are up strongly. This after a larger than expected boost to the reimbursement of their Medicare Advantage plans. We will talk about that, Jim, as well. CMS had a call yesterday at 5:30, sort of explaining the rationale behind it.
Pretty interesting.
But of course, we got to start with the markets. I'm curious as to where your head's at. I've been trying to talk to as many people as possible, of course, both those who are allocating capital and those who are running companies. What's your take this morning, Jim?
Well, I think that those who are running companies are saying, what the heck is going on here? We're trying to run our companies. Suddenly we find that a country that we've dealt with for a long time, we have to just say, wait a second, we're going to put a surcharge on. We're going to pass through. So the issue is who can pass through and who isn't, who has pricing power. It's often like that. Who has scale, who has pricing power. Who can tell the Chinese, listen, we're going to go away, of which then you have out-of-stock parts. And who says, okay, we'll split the tariff. When it comes to money managers, I think money managers are looking at this snapback and saying, listen, just ignore it or use it to get out because tomorrow is decision day and China's not going to blink. Japan will blink, by the way. And I think a lot of people feel that, wait a second, if Japan's willing to blink, then China should, but China's not going to. So when we come in tomorrow, it's going to be, well, China isn't blinking. Let's take numbers down. And numbers down moves stocks lower.
Well, I've heard two different points of view from the, let's call it the hedge fund community this morning, who obviously I talked to a lot, Jim, and I think they're both worth articulating a bit, because one is, and I think that's being reflected to a certain extent in what we're seeing in the enthusiasm this morning for stocks, which is they're going to do deals. It's starting with Japan. We're going to end up with many deals with many of our trading partners, and probably a 10% tariff across the board, but perhaps not as much else. That 10% tariff is going to be a money-raising, revenue-raising opportunity, although, of course, many would say it's still a consumption tax. But the uncertainty will go away. And that uncertainty, which, of course, is plaguing corporate America right now, and we'll talk a lot more about that and what we're hearing from CEOs, will go away. We will not have a recession, and ultimately, other than a trade war with China, which seems much more likely, will be okay. The other side is...
Do you think that China's not big enough and can't hurt us? Or do you think
no,
that,
of course I think
so
they can.
Do you think China... So the big companies pass it through, the Amazon passes through, the Walmart passes through...
Well, I mean, we get a deal with China, Japan. We get a deal with Vietnam. We get a deal, Mexico. You tick them off. Now, how long that takes, I don't know.
I don't know either.
I think the bullish view is it will happen fairly quickly, at least in a compressed enough amount of time to keep uncertainty sort of in a box, so to speak, that it doesn't permeate every decision in corporate America where they're pulling back, which is happening right now.
Right.
The other side is that it's going to take some time, even if we do get these deals, which still remains very much unclear. It's going to take many months. They're going to do them one at a time. We're still going to get in a trade war with China, which clearly seems to be likely, although
I think
perhaps
that's
it won't be.
That's the most salient point.
We're going to have a recession. I mean, it's kind of as simple as I can put it. And what I hear from corporate leaders, and I had a few calls, late yesterday, sort of, I'm sure you have,
yes,
is in the technology industry, watchful position, cautious on demand signals. Short term, things are going to slow down. Right. I mean, that's kind of what I'm hearing. That almost becomes a self-fulfilling prophecy, Jim. What are you hearing?
Data center slowdown.
Yes. Servers, the chips may not be tariffed, but the servers come from Taiwan, a lot of them.
Right.
Servers come from other places.
It's
going to increase cost.
Right. Everything's too expensive. Look, NVIDIA has this 232 military exemption, but that doesn't mean that NVIDIA isn't wrapped in something that
exactly.
So what we're doing is we're trying to figure out, okay, who's wrapped in it, who has to worry. I think this Vietnam thing's very interesting.
Here's the way to think of this: if you're not, you may not tariff the flour and the sugar and the water, but if you're tariffing the restaurant that's making the food, what's the difference?
No, it doesn't matter. Doesn't matter. So if you're Apple, and I know Craig Moffett is a little too negative, I think, about Apple from Moffett days. And
yes.
He's saying, okay, so the tariff's going to be eaten by some by Verizon on the phone,
right?
Some by T-Mobile,
some by the carriers, and then some by the customer.
Yes, some by the customers. So therefore, do their sales drop versus Samsung, or is the universe of people who use it it's not fungible? And then the other thing is that this move by Apple to move to India that won't cut it with President Trump. President Trump wants them to build.
Well, they're not going to build a plant here. By the way, on India, I do have a little bit of insight there.
Okay.
The journal reporting they're trying to move more of their iPhone manufacturing.
Right.
You can see right there. I'm hearing a few things, which is that the Chinese are not going to let them. There's very specialized tooling that they have in high precision, Foxconn has, and they're not going to be allowed to move that out. And to recreate that in India is not an easy thing.
It's not.
Also, there are highly specialized employees who also Apple wants to move, and the Chinese are not going to let them. So the expectation somehow that Apple is going to be able to very quickly move a significant portion of its iPhone manufacturing to India, I think, is specious.
Right. And that's why David, that's why the research is so heavily negative on Apple today.
Right. And then, of course, to your point, I don't hear from anybody who truly believes it's realistic to think that they're going to build iPhones in our country.
No, they're not going to.
No.
I think Apple has said, listen, we'll put $500 billion, maybe more, into our country.
Yes.
And I don't think the president believes that.
Maybe not. Right now, they're not getting. What's going to happen when people are paying, $2,000? I mean, even under the current tariff regime, given what's going on with China, you're talking. How much is an iPhone going to be? $2,000?
Well, I think that if you're
$1,800.
So then the question becomes: at a certain point, Do you believe in everything else about President Trump that you're willing to overlook the inflationary aspects? Do you believe the social aspects? Are they so important to you? Do you believe the commitment he's made to try to cut the budget deficit? Do you believe President Trump and just decide, I'm not going to focus on the inflation? Because that's really been unusual to not focus on inflation.
It has been. I would turn to the 10-year yield and try and answer some of those questions.
It's not going down the way
It's not going down. It's going up. Now, yesterday I talked about what I was in terms of capital flows. They're not coming here. That would seem to reflect it. I can't tell you I know exactly what's going on there. The Fed is in a bit of a bind, isn't it?
Yes, they are. And I think that when we all see these surcharges, we all see you go onto Amazon and it might be Amazon Basic and it might be just out of stock because they're not taking anything from China. It's a tug of war. I do believe that if you have scale like Amazon and like Walmart, I know this piece in the journal today, I think they win. And it's, David, I think what's going to happen is the big guys are going to offer much lower prices. I think Costco is going to be the lowest prices.
Lowest in terms of the higher prices, the lower of the higher.
Yes.
It's not as though they're going down.
No,
from
because
here.
Costco doesn't mark up because Costco wants to make the money.
Right,
from,
and they
from
have
the
a lot
car.
more. They have a lot more leverage with their suppliers.
They've got the most leverage.
Of course,
but
and
of
Walmart
course
does.
they
We
don't
talked
have
about
everything.
that.
But yeah, I think the most leverage. But David, the damage has been monumental. And I
just-
think that that's really important. So
Give
many
it a-
stocks, people
right.
feel the stocks reflect. And a huge
Right.
amount of damage.
Was the move down reflective of the possibility of a real slowdown and/or a recession?
I think it was.
Okay, well then today is justified perhaps because
but
this does embrace the hope that we're going to start to see deals. We've
Yes,
heard
it
from
does.
Secretary Bessent. I don't know what we've got there in terms of lined up in terms of a soundbite we can share from the Squawk Box Crew's interview with the Treasury Secretary this morning. But I think there's an expectation, certainly when it comes to Japan, for example. There's going to be a deal.
There's going to be a deal. They're
Take a look.
very excited about Japan administration.
Exactly.
They're very.
Take a look. Wait, we got
they
it.
like Korea.
We got it. Take a listen.
The president had a very good call yesterday with the Japanese Prime Minister that led to these negotiations. And look, the Japanese are military partners, they're economic partners. We have a substantial imbalance with them, and I'm sure that they are as anxious as we are to get this remedied.
Are we really going to take care of these imbalances? It doesn't seem possible that we are, but we're going to end up with something better. There does seem to be an expectation there's going to be a deal, or hope that there's going to be.
Yeah, I think that Mexico, they are very expecting it's going to be a better deal. Canada, and they're going to be able to trumpet a few days from now. Look what we've done by being really tough. And you know what? The Chinese are going to fold. They believe that the Chinese will fold.
Well, that'll be a big day for the markets as well, if that were to occur. It doesn't appear by any measure right now that Chinese are willing to, but perhaps the damage is going to simply be too large for them
That's why
versus
it's
what it would be for us.
dangerous to stay short. Let's take a stock like Goldman Sachs, okay? Goldman Sachs now reflects no IPO, no M&A.
No IPO market.
No IPO.
M&A.
No
By the way,
M&A.
there's no M&A market right now. This kind of volatility, almost impossible to negotiate a price, let alone the lack of certainty that we're going to endlessly talk about. If you're a CEO, it's just very difficult to do
So
a
what
deal.
do you pay for Goldman? Do you pay? The stock's up very big today. Do you pay 10 times? You pay 11
They
times?
do a lot of trading too, though.
Right. Well, what happens if
A lot of
David
other
Solomon?
things.
I don't know this. What happens if David Solomon comes out and says, "You know what? We caught this one.
They got a Blackstone buried in Goldman. Come on.
They
Remember
sure
that one?
do." And they, by the way, the private equity guys, maybe they say, "You know what? I don't know what you're talking about."
Have you
Things are
seen the
great."
alternative asset managers, Apollo stock price, Blackstone stock price? They
I
have
think
not
Apollo-
been good. And
right,
there's a
but I
lot of
think
questions
that-
there. Private credit, obviously, you increase the default rates potentially. I mean, there's a lot of concern there as well, given what is going to keep growth
I
business
think what
for
you're
those.
presenting in your reporting is a world that is fully reflected in the stock market.
Okay.
So if something good happens, it can go higher.
Right.
If we turn into, let's say China comes in and the president says, "You know what? Another 50%." And then you just really are in the then you're just smooth holy. Then you're just playing the game of 1930s. I don't think it's going to happen. I do think that they want to isolate China. I think that China has to go to each country and say, "How about, will you guys want? We have all this merchandise that was headed to America. Will you buy it? Will you buy it?" And maybe everybody. This is the pain loss theory. maybe everybody falls in line with Trump against China.
Okay, let's find out more about China.
What do we
Because,
have?
well, we have Eunice Yoon.
Oh my God!
Who wouldn't you want to go to? Other than
Amen.
Eunice Yoon?
No, this is my sheep.
China says it does vow to fight to the end and take countermeasures. Obviously, we've been talking about this to safeguard its own interests. This after President Trump threatened to impose 50% in additional tariffs. Remember, we're already at 54%, 34%, then the 20% for fentanyl. Earlier on Squawk Box, we did hear from Treasury Secretary Scott Bessent. He criticized China for the 34% retaliatory tariffs it also announced last week.
It was a big mistake, this Chinese escalation, because they're playing with a pair of twos. We are the deficit country. So what do we lose by the Chinese raising tariffs on us? We export 1/5 to them of what they export to us. So that is a losing hand for them.
Here we go again. A lot of card playing. They love the whole card analogy.
What is it, bridge? What are they playing?
I don't know
Fish?
what they're playing. All right, let's
play war.
Let's get to Eunice. Maybe she knows what card game they're all playing here. Eunice, of course, joins us from Beijing with the latest. Good morning, good night, or good evening, I should say, Eunice.
Good morning, guys. First of all, in terms of China's overall reaction, surprisingly to probably no one, the Chinese decided not to succumb to what they described as President Trump's blackmail, and they refused to remove the 34% additional tariff on American goods by today. Instead, they've been messaging through the state and social media, particularly to two influencers, one who's linked to the state news agency Xinhua, and the other one who's a nationalistic blogger, the possible next steps. So these two folks had listed out 6 measures. So these are to suspend the cooperation on fentanyl, ramp up tariffs on red state farm imports, so those that are friendly to President Trump, ban imports of U.S. poultry, target U.S. services in China, so this includes finance, law firms, consultancies, cut or ban U.S. film imports, and then investigate U.S. firms' intellectual property gains in China. And they cited the Ford CEO recently talking up Chinese EV technology. So in addition to that, the Chinese guided the renminbi, the currency, weaker to its weakest level in 18 months. So that was really seen as a signal here that the government is potentially going to see a bigger than expected devaluation of the yuan to help offset some of the problems that could happen with a bigger tariff hit. But you guys were talking about it a little bit in conversations that I've been having with Chinese suppliers as well as U.S. suppliers. The fact that the tariff rate now could go, as you guys are talking about, 104%, possibly 120% when you count all of it all together. They were telling me that this is prohibitive to business. One Chinese supplier said that they're already looking for other markets, that they wouldn't be able to really sell to the U.S. market. And then one U.S. company whose sources in China said that once Trump had made that announcement about the potential for another 50% tariff, he actually froze all of his shipments out of China. Part of it is because he said that he's just confused about exactly what type of price he should on any of his products. And then so he's worried about the uncertainty, but he's also just worried about what this could mean for his sales. He said that he would be in a position where he'd be losing on every single item that he sells. And even though he said he looked at the U.S. to potentially supply there, or set up a supply chain there, he said that it's just not realistic at this moment. So you're potentially looking at paralysis.
Eunice, the idea of retaliation against U.S.-based corporations that have a lot of business there. We've seen an investigation of DuPont, I believe something else on alumina. Do we get a sense there may be more to come?
I mean, that's the signaling at this point, but in terms of exactly who might be the target, it's really unclear at this stage. One other thing that I want to bring up when you guys are talking about Scott Bessent, from the Chinese perspective, they do not see themselves as a one with a losing hand, because as much as China, as the U.S. China is the one who's selling to the U.S., so it looks as though China is much more vulnerable. On the other hand, it also means that the U.S. needs a lot of stuff that the Chinese actually sell. And that would include pharmaceuticals and other important things. So the leverage actually goes both ways, and the Chinese understand that.
Yeah. Eunice, thank you. Great reporting as always. Eunice Yoon in Beijing for us. We're on track for, of course, a very strong open here. Let's give you another look at futures. We begin trading less than 13 minutes from now, and we've got a lot more Squawk on the Street straight ahead.
Good morning, retail traders. Mic check. Mic check. 1, 2, 3. Mic check. Mic check. 1, 2, 3. Magnificent, can you hear me? Mic check. Mic check. 1, 2, 3. Magnificent, can you hear me? I'm here. I'm here. Mic check. 1, 2, 3. Mic check. Good morning, Richard. Good morning, Mike. Good morning, Randy. You missed out on a hell of a pump yesterday. Oh, the market up 1,000 points already today. Woo! Hey, retail traders. Right now I'm in the process of making some coffee. So SPY busted today's pivot point of 517.25. President Trump scheduled to sign energy-related orders at the White House at 3 p.m. Eastern, April 8th, 2025. I hope he does it in 2025. Now what you're going to have is chasers. People are going to start chasing the market. You're going to get stuck. Somebody just bought 1,000 shares of SPY.
All right, we are looking for a far higher open when we get started with
Far higher.
10 minutes from now. Of course,
Well, I thought you all called Black Monday yesterday. What happened, Squawk Box? You losers. I called you out on it. Where's the recession at? Where's the depression at? Huh? Ooh, look at them. Look at there. 5,800, 5,000, 3,600. They're buying some big blocks, Rob. Paging Rob. Good morning. There's some huge blocks went in there, about 30,000. People are buying up. Somebody's going to get stuck, but I'm going to go into the kitchen now and make me some coffee, go find my house slippers and put them on. And then I already took my piss of the morning. La la la. La la la. We're off to the races, the wonderful races of Oz. Oh my. They were pumping Ford yesterday because of the Great Depression that's coming down. Because. As a trader of 21 years, I find Trump to be probably one of the best business presidents that we've ever had. He's allowing the private sector to do their job compared to the government, which picks and chooses winners and losers. That's a huge difference in what we just went through. The private sector can do better on controlling and spending their own money than what Washington can do with yours. I never did like an economy where you pick winners and losers. Let the private sector figure it out. It's called capitalism. It beats socialism any day. If I was told I had to hire somebody because of their gender or their race, I'd tell them to shove it. Because I'd want to hire the best qualified person no matter what race or gender they were. It wouldn't matter to me as long as they could do the job and get it done, not just show up to work. And I've hired over 2,000 people in my lifetime. That's my rant of the day. As I go into the kitchen, I'm going to make some beautiful coffee. It is instant. The water just got through steaming up. Then I'm going to come back and I'm going to ask Jake Paul to a fight. Boeings just keep going. Like I said in the video, Boeing and Google, Meta, NVIDIA, all the ones that I really made money on last year and this year, Apple is down at the bottom of the list. are going to have nice recoveries, and they're going to happen real fast. Stocks that people pile up in, that they swear to the Bible on, do I make myself perfectly clear? Yes, you do, sir. And CNBC, you can shove it. Because we're taking you off, and we're going to put on Schwab. Oh gosh, it's already 1 minute till. Man, that time went fast. See if I got time to make a coffee real fast. If I don't, too bad. Because I'm going to do it. I'm going to wait for a pullback anyway. Support 519.37. Now what have I done? Get ready for my ding-a-ling to go off. Here I go, down a one-way street, ready to take Spice feet 519.26. So I'll set my alert a little bit above it. They just piled in way too fast this morning. Now we could bounce here or have the continuation. I'm not in no big hurry because of what I made yesterday. I don't want to rush into things here. Black Friday. That coffee. I should have got some whipped cream. President Trump schedules to sign energy-related bill. Google already hit my resistance. 152.01. Tesla, Big Bang. Tesla's gonna go under 200, they said. Bullshit. You can't listen to these analysts anymore. None of them, not a one of them, make any sense. Mark Cuban comes out yesterday, says we're going to have the biggest crash ever. Progressive liberals. Can't you see I'm busy? We demand a beach trade. Uh-oh. Well, there you go on Tesla.
point gap to the upside here. This could be your first area where you do see.
We had a double top on the SPX. So I'm going to call support right around 5184 to hold, or a double bottom, 5184. Tesla's found support so far today at 245. Apple, about Meta. Look at Meta, 546. So yesterday's high will now become support and we'll go off the top of the wick. Rob. Oh. It is election day. Is today election day? Oh, shit. See? Okay, we're at the VWAP. We're at the VWAP. Oh, I'd love to see it pull back here to the 200 today. Actually, we're at the VWAP. Crowd's going wild at the sports arena. I've been demanded for a beach trade. Today's SPY 8th. Are they? They're not very expensive. They're expensive, but not like they were yesterday. They're going to get cheap here in a second. They're kind of expensive. So the 525s on the SPY. Beach baby, give me a call. Be patient. We had too big of a bounce. Prepare ye in the name of the Lord. We're coming to the double bottom with 3 black whores. April 8th, the 520 strikes. The 520s are the 522s. I'm trying to prepare ye for the name of the Lord. Who is this guy? I am Washboardjim. SPX calls, Lotto, scalping, April the 8th, strike 520, see right now they're a little trickery going on here. Should have grabbed them here at 550, 450. Well, I see it come down here and hit this here support level. We're getting ready to squeeze though any moment. We got higher lows. There it went. I said any moment. Did I not? There's some big volatility in this trade right now, so I'm just going to be patient. We could probably end up at a double top, triple top up here. Just bait. Oh, what kind of coffee is that, sir? That's instant coffee, decaffeinated. It's great shit. Would you like to have a cup? Very low volume. People know that we're kind of overdone it right here. Let's see if we can get this thing down at what, 380 or $4. If I felt frisky, I'd jump in right now, but a little too late. Francesca, if you're listening, I got a special, I'm looking at the SPX. How was that mic check? The SPX, the 520s. NVIDIA is strong as double HELL. HELL. 520, yes. But I ain't in them yet. We did did break out of the flag. NVIDIA is way oversold. Oh, look at Tesla. Tesla's at the pivot point. One flag I've never figured out yet. How about yours? See, we're too close to resistance to try to jump in and break it. So I want to try to buy it down here off the 21. And SPY hit my support level, and I didn't catch it. Okay, just be patient. Oh, I didn't even look at LLY in this downturn. Yeah, we missed that yesterday. I should have looked at that yesterday. Damn it. It took off without us. Okay, triple top. That'd have been a $100 contract right there. Let's see what kind of balls they have here this morning. I'm thinking about puts. The 515s. Okay, well, not a good start. Oh, Netflix. Meta's about to hit my resistance. Jim, what'd you do? Okay, now we're at the 9. Oh, see how much they dropped right here? The 520s? Could start a position right here. Dang, look at that, 40 bucks right there. I missed it. That's not cool. Yeah, this is Brandon. I'm going to give you a opportunity here to get in a call before I tariff your ass 50%. Instead of me collecting 10, I might be going after 50. Now, I know you was out cheating with Bill's wife, Hillary. I'll use that as collateral. And I've also heard about you and Nancy, her sleepovers over at your place. So make sure you get that in as you pull back to the 51.9681. You hear me, Magnificent? Look to pick this up off the 21. Okay. I told you it's coming down. Get ready. Find a position at a double bottom. Okay. Take of it. I just wanted one more little down candle. That's all I wanted. Well, there it goes. Now we broke resistance. A little rusty this morning. I should have jumped in that one too. I'm gonna not get lucky no more. Still working at the 21. While I'm waiting, I'm going to take off my shoes. Looks to me like a day where you got to get in and out of these trades. Being very indecisive here. Your puts just got smoked. Ooh. They're pushing it up. There you go. Shit. There have been $200 contract right there. If if I took them crows. Hmm. $52.21, $52.22 is our next support. United Healthcare, UNH. Walmart just had a new high. I don't like being patient, but I think I have to be today. You could lower the calls. We got a double top punk on /ES. Yesterday's high. Look what happened at this Pastor Bob. They had a storm. Look what happened to the tree in their cemetery. And Pastor Bob's Elvis Presley. Everybody thinks he's Elvis. Dadgum. And spike holes are up a couple hundred too. Oh, I got that. Oh, what am I doing here? 520. It's the wrong one. I got to get my head screwed on straight. Okay, well, there's a flop. Here's a pullback. The head and shoulder line. You told me to be careful here. Oh, your hair. Randy, slap him. Slap him, Randy. NVIDIA is back above 100. AMD had a nice little pop. Okay, we're double topping with a new high on SPX. Remember, we got China got to reply to Trump's tariffs at noon. Apple's moving up pretty good. Apple's falling stock, price seen as a buying opportunity, market talk. I thought we were doomed. George. Oh gosh, I ain't took a trade yet. Yeah, I'll be right back. I gotta walk away for a second, readjust. I see maybe kept pulling back to 51.99, 98. Put my chicken soup on. I haven't had breakfast.
$13.8 billion. That's less than 0.5% increase in terms of revenue. For the current quarter, as we said, Delta already cut its outlook. It now expects first quarter revenue. That was, what we're expecting for this. But I will say the company already said the outlook has been impacted by the recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. So the real question will be, we know domestic demand has been soft, but is that really spilling over? For the full year, when Delta last reported, they projected full-year EPS exceeding $7.35, representing 10% year-over-year growth. On an adjusted basis, EPS guidance represented greater than 19% year-over-year growth, and then free cash flow of greater than $4 billion. Now, a few analysts have actually downgraded shares recently, who have called that outlook into question. UBS downgraded to neutral from buy, citing potential challenges in international and premium market segments due to the current backdrop of a weaker economic outlook and then the sharp move higher in tariffs. They think Delta may actually suspend their full-year projections during this upcoming earnings season. Additionally, Jefferies downgraded Delta to hold, expressing concerns over weakening corporate and consumer sentiment. They predict that Delta and other major airlines will reduce their full-year 2025 earnings guidance, so we'll certainly be paying close attention to that. Other analysts have been scaling back their price targets heading into the report, but I should note, Jefferies and UBS are the only two analysts that have a hold rating on shares. Every other analyst that covers the stock maintains a buy rating. The median price target has come down, though, trading around $60, or the median price target is $62. It's trading around $38.60 right now. So on the whole, analysts still see quite a bit of upside for this name, but keep in mind, down 36% so far in 2025.
Yeah, so the concerns are people going to fly? And how are they feeling? Will they have a job? Will they be impacted by inflation or tariffs or whatever? And in the meantime, this stock is well off of its high of about $70. You made the point, a couple coming down from outperform to neutral, but also that most of the houses still have buy ratings. I mean, there's just this morning I see at least five Seaport, Deutsche Bank, Barclays, Wolf, they all keep their outperform ratings and their targets while lower.
Yeah, there's a buy rating. I wouldn't short it.
The overhaul capacity deal that they're
They're
working
nuts.
with Pratt & Whitney and Raytheon. And that's in Atlanta. I guess that business agreement is also helping the stock today. But a final thought here, because I don't know what their guidance may or may not be now, because there's uncertainty.
And I was talking about that with Liz Ann Saunders yesterday from Schwab. She basically said we might get kind of a cloudy picture from a lot of these CEOs that are going to be talking on these earnings calls, just because there's so much uncertainty still in terms of tariffs. You know, obviously we've seen what President Trump has implemented at this point, but he said there's a lot of negotiations, and what impact that is having on just consumer sentiment alone. Consumer sentiment has already been dwindling, so if consumers think, oh no, life's about to get more expensive because of tariffs, maybe they will start to scale back. CEO Ed Bastian already said that people were delaying those summer travel plans, although he last said back in March that he doesn't think we're entering a recession.
You know what I couldn't believe, and I'm going to get to Tim Bigham with the trade, but how Jeffrey Kleintop came on and he talked about so much less travel from Canada to the U.S. and how that can affect our GDP this year. So that was an interesting sort of precursor to a story we may be talking about, whether it's airlines or tourism spending or whatever. Okay, Caroline Woods, great to see you. Thank you. Good talk there on Delta. We continue to follow this story because we have Tim Bigham with us right now. He's going to take a look and trade Delta for
Somebody
us.
pumped it up there.
Some of your thoughts.
Yeah, absolutely good to see you this morning. And taking a look at a stock that is finally starting to find at least a little bit of support after a sharp, to say the least, sell-off. You alluded to the fact that the stock was trading up near 70. Really, to start the year, it's been cut in half pretty much. But finding support down along those kind of August lows from last year around that 37 range. So we'll see if it continues to lift off from here or not. But really just taking advantage of what I think is some very high implied volatility, to say the least, in the overall market, although it's finally softening today, and especially short term in the earnings week here. So this is a vol capture trade as much as a slightly bullish lean. So doing a call diagonal trade, lean bullishly out there, looking for the stock to just maybe grind a little bit higher towards that 20-day moving average after finding support here. But more importantly, capturing big vol by selling this week's out of the money 42 calls, hedging by buying traditional May 40 calls, leaning slightly bullishly, not egregiously so. Plus, I have 4 weeks in the interim to chop wood, as I call it, sell additional premium if need be to defend the trade here. So I just think, the market overall, Delta in particular, probably will find a little bit more, kind of lift off from here, to use a bad pun, but not too much, I don't think. I think at some point stocks will run into some trouble. So the relief rally we're seeing in the overall market probably will be softening soon here. And the airline stocks in particular probably will benefit the most almost from the low oil prices we've seen. Oil just hovering above 60. That's come down sharply. So that'll be a kind of a nice tailwind for transportation and airline stocks overall.
Yeah, it's interesting how you have this lean to the upside. I mean, you're certainly not going back to the $70, but you see some upside. But it sounds like you're also expecting some volatility in the markets overall. But you do see the upside potential at least a bit for Delta. A final quick thought there?
Yeah, absolutely. I'm not looking for a rip-roaring, rally post-earnings, kind of capping it off at 42, so less than a 10% upside move. But I think this trade, like I said, you're able to sell over a 120 IV this week, hedge it with under a 70. I like it on that front as much as anything, and I think vol will stay in the market certainly for the short term. So if I have to re-hedge, I can continue to sell very expensive options, bring down the overall cost if need be. If not, probably profit nicely if the stock does move back towards that 42, 43 area around that 20-day moving average.
So with everything higher today, Tim, how do you feel about the markets? I mean, and the action, the Dow is up 1,400 points. The S&P is back in the green after a crazy day yesterday where it was down 5%, up 3.5%. I mean, we were all over the place. What do you think about this market action today going forward for the rest of the week after the last 3 days?
Yeah, well, see, we're getting into kind of the teeth of earnings season with the, big banks reporting at the end of the week. So we'll see what kind of earnings are. But I think overall still will be dominated by, what comes out of Washington, to say the least. And I think yesterday's price action hinted at a short-term low, certainly a key reversal day to end all key reversal days if you're looking at from a technical aspect. So I think we might see a continuation of a move higher here, but I don't think
Apple's really looking strong
to those all-time highs that we saw to start the year. Personally, I think the highs for the year are in. I said that about a month ago. Continue to believe that just simply because valuations, even given the sell-off, still are not cheap here. Interest rates heading higher kind of perversely as well, too. So just going to be a big range, no change market, I think, for the foreseeable future. So, put on your trader's cap, sell rallies, buy dips going forward. We now have the lows in place. You know where to get out if we break below Monday's lows if you got in.
Oh boy, don't even say it. Well, hey, it's good for bears. I mean, for the folks who are betting to the downside, but I think for those who are long, they don't want to see Monday's lows. Tim Bigham, great to see you of Buy Alerts. Thank you so much, Tim.
You bet. Anytime. Take care.
Thanks. Coming up, we'll shift our focus straight over to the energy space. Some of those stocks, we had crude selling off. It was below 60. Now it's at 61 and change. What's next in the energy space? We'll be right back. Morning Trade Live.
Wait. Do. We're back to the 21 again.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Morning Trade Live. It's time to focus on the energy space. Brian Kessens is with us, Senior Portfolio Manager at Tortoise Capital. Thank you for being with us. So we've seen volatility when it came to crude. We were below $60 on oil, now a little higher. It wasn't that long ago, we were closer to 70. Some of your thoughts on the big picture.
Yeah, thanks, Nicole. It's great to be with you this morning. I think certainly energy has not been spared. The volatility that we've seen over the past week or so since the tariff announcement. It was exacerbated a bit as relates to the crude oil price. To your point, last Thursday when OPEC actually decided, led by Saudi Arabia, to accelerate bringing some production back online. I think what was lost a bit in that decision from OPEC was the real aim is to bring some OPEC countries that have been overproducing for the past couple of years back in line, like Kazakhstan, Iraq, and to some extent Russia. So time will tell, but really net, we would not necessarily expect much of an increase from what OPEC policy was before they're able to bring those countries back in line. Looking at the longer term, for those OPEC countries, $60 oil is not overly helpful to their budget deficits. They need $80, $90, and over the longer term, we generally think that's where crude oil is likely to lead to.
I do want to get to how the tariffs affect energy overall. I mean, you did have OPEC also come on board with some comments as well about more production, right?
Who cares?
Yeah, they're aiming to bring more production to the world. I think to the extent that there is some uncertainty as it relates to tariffs, they do want to give the sense that oil will continue to flow throughout the world. There is no economy really without energy, and energy is led by and large by oil. So they don't want to give the sense that there would be any necessarily disruption as it relates to trade in the overall oil market. So that's a good thing, at least to give consumers some stability that oil will be there.
So the tariffs on the energy sector, there's different parts of energy. Of course, there's infrastructure, there's oil and gas. I mean, what's as an expert in this area, what do we need to follow here when it comes to tariffs?
Yeah, for sure. Tariffs certainly going to be disruptive to the world economy. As it relates specifically to energy, though, and to the U.S., it was noted that President Trump's very pro-U.S. energy. And I think also what was lost a bit is that the idea is we ultimately want to reduce our trade deficit. The thing that the U.S. has a comparative advantage is our energy, and that we can produce a lot of energy for relatively low cost relative to the rest of the world. And to the extent that other countries can enter into longer term contracts, especially for LPG and natural gas liquids like ethane and propane, they can import our relatively cheap energy over the long term to help improve our overall trade deficit. And in fact, we are expecting some longer term contracts to be signed, especially for our LNG, just as a result of the tariffs as part of the negotiations that we expect on.
I thought it was interesting how you said global economic growth will continue to drive demand, long term. I think a lot of folks are worried about demand.
Yeah, we do expect some disruption over the short term here as it relates to the global economy. Maybe we will see a mild recession. We do expect we're going to come out of that at year end. Yet if we look at where energy demand has been longer term over the past 40 years, and the last 42 years, energy demand has grown. And that's through several recessions. It's through 9/11, it's through the 2008 crisis, through COVID. Generally, energy demand just continues to move higher. It's very resilient. And even if we do see somewhat of a softer economy here over the short term, we expect energy demand to grow. And we shouldn't lose sight of the fact that artificial intelligence is going to continue to grow. We can debate on the magnitude of that. But that requires a lot of additional power to meet all of those data.
I'm making lunch right now, but I'm thinking about getting into this
I
thing.
think that a large part of that.
Dropping down one more time.
And then there's dividends.
I really want that 522.18 to hit.
Stocks in this group.
Here we go.
We are. Yeah, if there's a difference in the U.S. sector, U.S. energy sector now.
The
versus
53.50s.
Leverage is a lot lower in the sector. A lot of producers don't have any leverage whatsoever across energy infrastructure or pipeline companies. Leverage is a full turn of EBITDA lower. And companies have free cash flow. They didn't have that a decade ago. And that free cash flow can certainly go toward CapEx, which we expect to continue. But there's unallocated capital that can continue to go toward dividends and share buybacks. Nearly every company across the U.S. energy sector has a share buyback program that they are aiming to use in an opportunistic way. And whether it was the regional banking crisis from a couple years ago, or other pullbacks, or certainly over the past couple of days, we expect that energy companies have been in the market actively buying their shares with the weakness that we saw recently.
And the premise under the Trump administration is more energy production here at home, I guess, you tell me. And in the end,
53.20s or 50s?
Staying close and around the $60 range rather than $70. Where do you see price?
We see prices continuing to move higher. If for no other reason than the OPEC countries need a higher price to meet their budget deficits. So I think they're going to aim to manage the amount of supply that ultimately reaches the market over the longer term toward a higher price level. U.S. energy companies really don't have a lot to, or any individual company can't really necessarily drive the price, but we do see it moving higher. That plus we're likely to see some inflation, which can be helpful for energy prices as well. And then at $60, we do expect some countries, notably some of those OPEC countries that have been overproducing, to curtail some of their production. So generally, we think prices will move higher over the longer term. It won't necessarily be a straight line, but that's the trend that we see.
All right, Brian Tessens, Tortoise Capital. Brian, thanks so much. A good chat here about energy and what to watch for. Appreciate it. Thanks. Coming up, the Chart Master is next. We'll take a look at some of the analyst calls on names like Roth Stores, Affirm, American Express. Morning Trade Live. We'll be right back.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Morning Trade Live. Lots of green today, and we're looking at one sector after the other, and we're seeing a lot of bouncing back, still at a loss after 3 days of selling and volatility. And we continue to chart some of the key names to watch that have been on the move. How about we have Chartmaster now? Jenny Horn takes us through some of the fundamentals. Rick Ducat will take us through the technicals. And we're taking a look at Ross Stores, a name that lately has been doing a little bit better. Jenny is here and will give us some of the details on an upgrade for Ross Stores.
In Ross, with a decent 4% move today, but only adding to the fact that we're actually now positive for the month of April, which is a rarity in this market, of course. But Wells today upgrading shares to overweight from equal weight, while also raising its price target to $150. That's up from $140. Obviously does imply about $17 of upside from where we are currently trading at just over $133 a share. But they also do cite some more defensive natures behind this upgrade, like its strong balance sheet, its free cash flow, as well as these various levers in which they can see sustained profit and loss metrics. Well, Ross Stores, they said, is clearly dealing with more volatility than is typical for their business model. They do see right now today's valuation near bottoms, and they also are expecting much better relative performance amid this slower macro tape. So I actually did a double checking of what the forward PE was right now for Ross. It is, actually relatively cheaper. So to confirm what Wells Fargo is claiming here, trades at a forward PE of just over 20 times, which frankly actually isn't that cheap. But then you look at it compared to like Burlington, for example, trades at 25 times. TJX trades at almost 28 times its forward earnings. So both names that have outperformed Ross within the discount retail space, and perhaps that's exactly why we're seeing this call here to catch up and hopefully gain some of that loss upside compared to its peers, Nicole.
Okay, look, you make a great point that it is a winner now for this month. It's well off the $163 highs. Rick Ducat taking a look at the charts.
Yeah, and it's an interesting technical setup as well, in addition to everything Jenny was saying, because what we can see here is a situation where we have price breaking out above a shorter term trend line that we have in white, going across our recent highs that we saw from late January 31st or so. You can see as well, we did have another downward sloping trend line, starting with those 52-week highs near 163. So we're still a good ways off from that blue trend line, but our white trend line is showing that after a false breakout a few sessions ago, we are starting to push above not only that red line near 132.86 that represents a gap from all the way back in last May where we had a spike upward on earnings here, but we're also pushing above this volume node. You
We're
can
flagging
see, so
out
around
again.
133 is a key area to hold. If we do move beyond it, that will become a support.
I'm still waiting. I'm going to take a good trade eventually. I have watched you become the greatest cook in the world. $53.50s SPX. That's beets. Beets and a cheese thing I made out of my waffle thing. Cheese with a couple. Yep. With pepperoni. Okay, here we go, man. They're getting cheap. The 53.50s. I mean, this is probably dang, these things are good. I'm gonna show y'all on YouTube what I'm eating. That's a cheese waffle right there. Cheese with a pepperoni. See a little pepperoni there? And it's like a chip. With salad, beets. Little crunch. Okay, here we are at 4:30. Randy, prepare ye. Oh. My alert's about to be triggered. $3.80. This is a risky trade, but I'm in it. $3.60 and $3.80. Off the 63. I need a bounce. 330. That. The deck. Oh, you gotta hold it. My average is 357. Okay, it ain't working. Jimmy needs a reversal here, or you're going to have to sell it. What happened to all my shit on here? Kind of not acting right. Well, what should I do? Might have to go in big on this one. think I'm going to add triple down on this one here. Yep, I'm going to have to add on, I think. I haven't sold it yet. Ripped out now. Wish me luck. $190. Oh boy. Magnificent, you're having all kinds of issues with my setup. Yesterday you couldn't hear me, now you can't see my screen. Your karma's catching up. I need 245, please. I hit my second support, so we'll see. Then I just get out and take the loss. There it goes. Just triggered. Come on, man, hold. I need you to hold. Yes. No, I haven't. Yesterday, Florence said she couldn't do something with. We're at 2:15. Keep going. Break the 9. Jimmy wants you to break the 9 and run up to the 63, please. VICTORY, that is my battle cry. Oh, shit. Come on. I'm going to go get my suit now and then come back and see this thing fly. If not, I got to get out of it. I'll be right back. This sucks. I don't know. I'm not liking it. We're at the 200 on the QQQ on the 1 minute. We've got to break the 200. SPY. We got a double bottom on the SPX. So we got to hold this high or it's going to be a nice drop. Well, I thought that was there. Well, no. Everything's out of support right now. Are you in a timeout, Magnificent? Okay. I'm getting nervous. Shit. Well, we just hit my third support on the SPY. Let me look at the SPY calls while I'm playing around with this. The 520s. This kind of hurts.
a little bit so companies can beat on the upside surprise, go figure, right? But we do think that's going to happen again. I think second of all, guidance is going to be very uncertain. Guidance is going to be like, we're still trying to change our supply chains, we're still moving things around. I think some of the services companies are going to be a little bit more optimistic because lack of trading, but still they're going to continue to say, hey, the consumer is weakening, we're watching this. But the one key thing we want to point back to is that this economy has some pretty good firepower. Yes, the economy is going to slow down. That was one of our major themes coming into 2025, the economy moderating. But look at the payroll report on Friday, well above expectation, and there's firepower there.
It was, and that was good, obviously. But the worry is now that, and I don't want to. I am normally an optimist, but if, I'm trying to, kind of. Find some middle place here. So that was good. The market did not take it into account because it doesn't take into account the effect of tariffs and what that could mean on the job market. Do you think we'll continue to see a job market that holds up, especially if the tariffs come into effect?
Oh, it's definitely going to slow down.
Okay.
It will definitely slow down. And unlike you, I'm more of a cautious person. So this is a I'm a cautious person, but that payroll report came in well above expectations. I do think that January, where we saw some terrible job numbers because of the cold January, they had longer than expected flu season, started to come back through. And a lot of the hiring was in more economically sensitive sectors. That will definitely slow down. But let's face it, unemployment rate of 4.2%, jobless claims around 220,000 a week. We still have a pretty good solid foundation. It will definitely weaken, but if it weakens enough, this gives the Fed the impetus to come in and cut rates. And we still think, the markets are pricing in 4 to 5 times. We're thinking maybe 1 or 2 times because of the inflation threat. But if we have a recession, different story. Fed comes in and cuts dramatically.
So you differ on your view on rate cuts than the consensus where it is right now.
Yeah, I think especially Jay Powell speaking last Friday, where he basically said inflation is going to be longer than expected. Right. Tariff uncertainty, and he basically said we are going to let
a bit out of the money right now
before we cut rates, and he's really worried about inflation surging. And I think if we have a recession, the Fed comes in like they did during COVID, like they did great financial crisis, cut rates dramatically.
Okay, all right, Gene. We'll have to leave our conversation there. Thank you, Gene.
Thank you.
That's Gene Goldman, Cetera. Thank you so much, Gene. Plenty more to come on Trading 360. Next up, it's the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat takes us through the technicals. And Jessica Inskip takes us through a look at the trades for TJX, Ventus, and Oracle.
Yeah.
That's next on Trading 360 here on Schwab Network.
It's like they just gave up. Do. Well, I'm gonna have to put another $1,000 in this. We're close to the 200. It'd be nice to get one more candle down before I did it. Jimmy's not too confident right now. $105. I'll be right back. I'm gonna.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to 360.
If we don't hold this 100, I'm going to stop out.
3 stocks, 3 charts, 3 trades. Rick Ducat will take us through the charts, and here to take us through a look at the technicals and tail of the tape, we've got Jessica Inskip, Director of Investor Research, stockbrokers.com. All right, great to see both of you. Jessica, it's good to see you on screen. Love that I saw you in person recently. Jessica, really quickly, before we get a look at your first ticker that you're looking at, can I get your thoughts on today's market action, the rally that we're seeing?
Yeah, so there are so many macro thoughts that I have right now, Diane. From just today's rally, I think it was highly technical. We went all the way down to the 200 weekly moving average, which is something that tends to be a bottom in a lot of major declines. That's where we bottomed out.
Come on, Jessica.
Actually, during the large COVID decline. So that's technical. Now we need to see if this rally has legs. Looking at breadth, I think it was
have
75% up day. Perhaps we want to see a little bit more than that. And then, of course, tomorrow is tariffs being implemented. But today, there's also a scheduled hearing that we have within Congress and the Senate with actually trade. It was already scheduled, and it's so interesting that it's right now, and there's some interesting components that are coming out of that. So what has been said is they're interested in negotiation, but it's not necessarily on tariffs, it's on trade deficit. That obviously was applicable with the calculations that went in, but it's just very interesting to see how that's going to shake out, and I really think we've got another volatile day, even tomorrow. Just so much going on.
Yeah, I think you make a great point, especially because we've been rallying today, but we started coming off the highs of those sessions when the trade rep first started speaking. And we're talking about the USTR, Jameson Greer, speaking before the Senate Finance Committee. It sounds like he is reiterating some of the commentary that we've heard from other officials in the White House, that there are countries that are at the bargaining table, but he also said these tariffs are set to take effect. So in other words, it's like, you know, we're still trying to get clarity on what will happen, and we probably don't know until it does happen. All right, but Jessica, talk to us about your first ticker that's on your list. You've got TJX in focus, parent company of TJ Maxx, Marshalls, etc. Shares higher today. What's behind your views here?
Yeah, actually, I'm pulling back a COVID playbook, if you will. So tariffs are equivalent to a supply chain disruption. So this is a supply chain disruption, much like at that time. And what we learned from that period is companies are very resilient and agile, and they'll front run these tariffs. We see that, like Apple saying they're going to bring 2/3 of the inventory onto U.S. soil. So there's going to be an excess product, and that's Apple's just an example. So companies like TJX, they're obviously not going to be reselling iPhones, but they're going to benefit from that excess inventory that comes up, at least in the short term. So I do think this is going to be a supply chain inventory shift. TJX is absolutely going to turn this into a tailwind, and in the short term, it could help with their earnings and give us a bounce.
All right, let's head on over to the Duke of Data, Rick Ducat. Tell us about what the chart looks like from your point of view for TJX.
Well, mostly during the past few couple quarters here, more of a range-bound type of price activity that we're seeing, where we formed a fairly consistent ceiling at the red line on our chart near about 127 or so, going across those highs. You can see that we did test to the upside a few sessions ago, making some new intraday highs of 128.33. However, we did not log a higher close just yet here. We can also see it, like trend lines are subjective. You could maybe draw this trend line a couple different ways. I tried to go across the closing prices as best I could, going down, starting from that high point that we had around November there. So by one measure, still in a downward sloping trend line going across the highs, but we also have a much more steep short-term trend line starting with these recent lows. Look down at that light green line near about 112. You can see that's been a triple bottom type of price point here for this stock. We also seem to solidify a little bit near that purple 252-day exponential moving average before crossing above our other two moving averages that we follow, yellow 21-day, orange 63-day exponential moving averages. Now we're hanging on above that confluence, which comes in near about 120 with our eye on that triple top type high there that we have to the upside. So that would be the mark to beat in the short term here. To the downside, look for support near 118 or so. That's our green line and our volume profile point of control. And ultimately near 112, that triple bottom, Diane.
Okay, all right. TJX shares up right now, 2%. All right, Jessica, want to give a final thought on TJX before we move on to your next ticker?
Yeah, important component, short-term play. There are some longer-term headwinds that may come up. So this is just looking over to the next earnings and excess inventory, all which could change depending on what happens with tariffs.
Well, we're certainly seeing some more bullish sentiment rise around TJX and others in the discount retail space. But let's move on to the next one on your list. You've got Ventus and Focus. That's a REIT. What's the story here? This one caught me off guard. I hadn't been watching the price action, but I know you've got something to say on this, Jessica.
Yeah, absolutely. This goes into my larger macro view and actually themes that will play out in the longer run. So those being longevity, we have an aging population that needs to service that aging population. The second, of course, is power and energy that we've discussed quite a bit. And then the third, artificial intelligence. Again, a lot of discussion. We haven't talked too much on the longevity because it's a longer trend that's at play. But because of those aging demographics, the demand for healthcare, the demand for senior living, that's going to be extremely important, and that could be a tailwind for the security. It is a real estate investment trust, so it has a strong real estate portfolio, but it's also diverse. There's about 1,400 high-quality facilities, but it's not just in the U.S. It's inclusive of Canada. It's inclusive of the U.K. as well.
Okay.
Favorable supply
so
and
far,
demand dynamics, if you will, in terms of population. And their portfolio isn't only just in living facilities, there's also research that's embedded in there as well. So there's diversification, but it also plays on this trend of longevity.
That makes sense. I mean, and look, it's been outperforming the S&P 500 a year to date, up double digits. Quite a different picture for that compared to the broader market. Rick, what does the chart tell you when you look at Ventus?
Yes, quite a nice move off those lows from almost a year ago. We're up about 57% from that point, near the mark of about 41.45 there. We can see though that we've been enjoyed a fairly consistent uptrend. Our white trend line going across the lows has held firm despite the recent broader weakness in markets there. We also held on at an important confluence with that trend line. You can see we have our green dashed line there near the 62 mark. That was where price bottomed out a few times during its range-bound activity, centered around that volume profile point of control, that shaded area corresponding with that thick red line near about 65. So we have held on at this kind of rather broad supportive area, 62 to 65 or so, and now we are struggling to retake our orange 63-day EMA that comes in near about 65.50 at this point. So a key point to watch heading into the close. If we were to move up higher, we've got another volume node. You can see that second shaded area above current prices, roughly lining up with our yellow 21-day exponential moving average. That area comes in near about 68. That could be a resistance point to consider. Then we've got our double top highs near 71. 71.36 was the intraday high point. That would be a notable area to watch as well. And then, support at the areas I mentioned, 62, and then ultimately down below 57.50, another double bottom type of scenario, Diane.
All right, shares of Ventus up about 1.5%, nearly 1.5% at the moment, gaining some ground, adding to the advance it's already seen year to date. And some people may know them by some of their community centers like Brookdale, Welltower, etc. All right, Jessica, let's talk about your final ticker on your trade list. You've got Oracle and Focus shares gaining some ground today, along with the broader market action.
Yeah, I think I got to quit. Get out of
this one is definitely one of my picks today with the largest tariff risk. It has about 5 to 10% of its revenue in the auto and manufacturing sectors, which means if tariffs hit any of their customers, there could be cuts on spending, and which Oracle could be a recipient of that. So that is a risk. On the other hand, they are in talks and a big component of TikTok. That was extended just another 75 days because of a deal. That deal was suspended
breakout, double bottom.
Tariff implementation and the drama that's with China, but I do think that offers some upside
now or never
to Oracle that's not necessarily baked into the price just yet. So I think that acquisition potential is really a good tailwind that could translate positively into earnings. There's a lot of e-commerce that happens with TikTok, and there's so much there that we would love to get visibility into. So the long-term story there's near-term risks absolutely with tariffs, but perhaps those could be overcome with the longer-term tailwinds that is the TikTok acquisition.
Yeah, look, I've been on TikTok shops before for my niece. Obviously, the young people love TikTok shops. Rick, tell us about although, Oracle is making a move higher today, certainly has been a different story year to date. Take us through what the technicals look like for Oracle, Rick.
Yeah, like many stocks, this has seen a significant decline off of those highs. It feels like it was so long ago at this point. In this case, it was 198.31 in mid-December there. So then from there, you could have drawn a more shallow downward sloping trend line and then a much steeper trend line going across those other highs there that you could see. So then we could consider as well that we have crossed below our moving averages. All three of them are trending downward now. We have broken below our volume profile point of control as well, that thick red line coming in just around 140 or so. And notice as well that right around that volume profile point of control, our red dashed line represents another key gap to the upside. We filled the gap, we broke down below it. So now 140, 143 around that area becomes a resistance point to keep an eye on. The old support has become new resistance. Now we can also see there's a little bit of trading activity at these lower levels near 124 and maybe 116, 117. Those would be the other volume nodes to the downside.
He gets into his charting. Look at that little.
Our 52-week lows come in.
You got a neon too. I got one.
Momentum, RSI, trending lower. We are out of that oversold area at least here, so that's more of a bullish signal, I guess, but still quite depressed prices with a major resistance area to overcome just ahead 140 to 143 or so.
Okay, all right. Definitely maybe overcome that oversold, but you're right, we're starting to see a little bit of fade even in the gains that we're seeing in Oracle, but still holding on to a gain up a little more than 1.5% at the moment. Still broad market action, holding on to some gains, but not certainly off the highs of the session right now. Jessica and Skip, stockbrokers.com, and Rick Ducat, thank you both for being with us. Appreciate you. Coming up next, we're going to spotlight Delta Airlines ahead of its earnings tomorrow as first quarter earnings season starts to trickle in. Trading 360, we'll be right back.
I have to go in big on this.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Trading at Schwab is now powered by Ameritrade.
I'm going to go make another cup of coffee.
The award-winning
see what happens when we get to the 200, if we do.
On Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization. And track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you.
Tom White.
At 12 p.m. Eastern on the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab.
Schwab, a modern approach to wealth management.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and platform chat. Trade brilliantly with Schwab.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're
Experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Welcome back to Trading 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Time now to spotlight Delta Airlines ahead of earnings tomorrow morning. Shares are higher, but have certainly taken a step back this year. Joining us now, we've got Nick Rach, CEO of the Earnings Scout. Nick, thank you so much for joining us this morning. So obviously we're taking a look at Delta Airlines. Earnings expectations have been reduced, first up in part by the company itself. You recall last month they had lowered their projections for guidance, guiding for revenue growth of between 3 to 4%. That was down from their earlier estimate of essentially half. They had previously estimated between 7 and 9% growth. In terms of expectations for EPS, they guiding for this range between 30 to 50 cents. The consensus is more on the lower end of that range. Talk to us first about your expectations, Nick.
Well, that's pretty typical. You know, when they give a range of 30 to 50, usually the consensus goes to like 38, 39. And the company will probably report a little bit slightly above that because the guidance is always conservative. The interesting thing about Delta to us is it's going to be the very first company in the S&P 500 that's going to report a quarter ending in March. We've had 20 other S&P 500 companies, including Walgreens this morning, that reported February quarter ends that count as first quarter 2025 earnings season. But Delta is going to be the first that gives us what actually happened in the month of March. So that's going to be something very interesting to see.
Well, the ticket prices have been through the roof
over the past 90 days after improving over the last year. And certainly we want to hear what the impacts of the increased likelihood of a recession and tariffs will mean for their future business out in the future. We care less about if it beats tomorrow or not, and more about the outlook it gives.
That makes sense, that the outlook is more of the focus, especially when you think about the increasing worries about a potential recession, and then wherever we land with regard to tariffs. What are you looking to hear in particular when it comes to the forecast for Delta?
So what we want to see is that the estimates don't get cut at an increasing rate from where they've been over the last 90 days. So if the outlook starts to really weaken and deteriorate, and what they're saying about future travel and demand from the consumer may be feeling a pinch, that's what we want to see. So we don't want to see the estimates be cut by 10, 15, or 20% or more. If we do, we think that creates a weakening trend for its earnings expectations and justify. This is a stock that's been pretty much cut in half.
I'm not give up yet.
High. So if we could get some kind of resolution on tariffs and we don't go into recession,
if I can get to 51.93, I might be close to even
today, because it's been very beaten down over the last year.
It absolutely has been beaten down, especially when you think about the performance they had last year. Let me ask you this. So, you know, although we've seen, you mentioned the consumer, which is partly a big part of why Delta lowered their guidance. We've seen
I dropped my average way down, but I got a lot.
We've seen the job market holding up. Now, people will say that jobs report obviously doesn't reflect where we are now. I just had a guest on who talked about even if these tariffs do go into effect, that the job market, he expects it to, yes, see some pullback, but not to the degree I think that many are expecting. And then sometimes with regard to sentiment, what we've seen, especially over the past couple of years, in the kind of post-COVID world, even if sentiment weakened, it didn't necessarily translate to consumers pulling back. What are your thoughts on that?
The consumer keeps spending, whether it's on credit or not. But what we want to see is we don't think Delta is going to really report a negative impact over the next 3 months or so, because a lot of people's vacation plans for the summer, the spending business has already been booked. It's more what we're concerned with. What is the fall in the next year going to look like for Delta that really moves it? And probably what we're going to see is a lot of companies are going to have this uncertainty because we don't know what tariffs are going to be tomorrow, a week from today, a year from today, or maybe 5 years from today. So I really think companies are going to give guidance that, or even pull guidance in some ways. And what that will probably do is cause analysts to be conservative with their estimates going forward, and we may see that weakening trend. For outside of Delta, we were seeing weakening in earnings trends for the S&P 500 before the tariffs were enacted. With them being enacted and potentially causing global growth to slow, we think that we're going to see a bigger cut in earnings estimates across the board this earnings season.
Okay, we have a chart up right now with some of the airliners that are in focus. We are obviously seeing some gains today on the board with Delta leading the pack currently, United right behind it in terms of just today's market action. But when you think about the airliners, who do you think is best positioned to weather the challenges that we have in front of us, whether it's kind of full-on tariffs and a trade war to a potential recession? Who holds up the best?
Well, Delta would be one of them. We actually have liked their earnings revision trends minus the last 90 days with the tariffs. But they'll all suffer across the board if tariffs lead to a recession. So none will be immune to slow down in business and personal travel if a recession does come. But relatively, Delta is one of our favorites.
Okay. All right, Nick, thank you so much for your insight on Delta as we get set up for their earnings set to be released tomorrow. That's Nick Rage, CEO of the Earnings Scout. I appreciate your time. Coming up next, the disruptors. George Soros joins us to take a look at Broadcom after the company announced a new $10 billion share buyback program. We'll give us the details plus an example trade. That is next on Trading 360.
Let's go. Not enough. I need more. Well, it didn't get even. I got a lot of contracts, so I just got to kind of play it out. A lot. This becomes mathematical now. I'll probably have to get up here somewhere before I'd come even. Right around there. Gotta break that.
Whether you're an experienced investor or just getting started,
oh shit,
offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Go, go, go. I need 135.
Welcome back to Trading 360. I'm Diane King Hall, live from the New York Stock Exchange. We're looking at developing stories this morning. I want to bring in Caroline Woods, senior markets correspondent. All right, we're taking a look at Netflix this morning. Shares gaining some ground right now. What's behind this move?
Well, we have some analyst action, but I do want to point out, so Netflix shares up almost 4% today. It's not a Meg 7 name, but I always clump it in with the Meg 7.
Yes.
Because it's actually the best performer of that group so far year to date. It's the only name in positive territory. It's only up about 1% so far in 2025 with today's rebound. But it has the best chart over the past 1 year as well. It's up about 43% over the past 1 year. Tesla's pretty close, up about 42% over the past 1 year, but obviously year-to-date chart looks much different there.
Yeah.
So it is taking part in the overall tech rally today, but also getting some bullish analyst activity from Morgan Stanley. Morgan Stanley actually just named it a new top pick in media and entertainment, replacing Disney. Has an overweight rating already and a $1,150 price target on Netflix shares. So Netflix currently trading around 901, 902 right now. Morgan Stanley says they're applying a more defensive lens to their media and entertainment coverage, and that leaves them incrementally bullish on Netflix. They think it will demonstrate resilience in the macro backdrop, which of course we've been talking more and more about, and that momentum in its core subscription business, as well as recent U.S. dollar weakness, should de-risk fiscal year 2025 estimates, even in a softer ad market, which we know is important for Netflix. I should note, JP Morgan actually cut its price target on Netflix. We're looking at that today as well, down to $10.25 from $11.50. Kept an overweight rating on shares, but that's not specific to Netflix. They actually trimmed their price target on 25 companies across their internet coverage based on tariff impact, macro headwinds, potential recession, all the things that we're continuing to talk about. The economists there actually expect a 60% chance of a recession in 2025, and the second half of this year. They think e-commerce, online travel, and digital advertising names are the most exposed. But keep in mind, they did keep an overweight
I like your
rating,
little blouse.
and that's likely because they think streaming subscriptions, as well as cloud and then ride and food, should provide relatively more resilience. So still keeping an overweight rating, just scaling back those price targets. They did say, though, there is no macro immunity in the internet space, only degrees of resilience.
Oh, interesting. No macro immunity.
Caroline, would you get on my yacht with me, please, and retire?
Especially with the tariff headwinds.
Yeah, and I think, though, if you take a look, the majority of analysts are bullish on Netflix. If you take a look, 75% have a buy rating. And what we've been hearing from a lot of these bulls is that, yes, consumers might scale back how much they're spending, but they probably won't cancel their Netflix subscription, maybe because they won't remember to, but also because the content has been pretty good on there, and it's relatively cheap compared to going out. If you're not flying, if you're not going to travel, you're going to sit at home, and you might as well watch some Netflix while you're doing it.
It's true. All right, thank you, Caroline. All right, time now for the disruptors. We've got George Sillis, a senior markets correspondent here with today's company in focus. Broadcom shares moving higher after announcing a big buyback. Tell us some of the details that you're paying attention to here, George.
Broadcom.
Well, obviously, Broadcom has fallen in suit with the rest of the market. I mean, year to date, it's down about 28%. But I think there's a lot of value to be said for this particular name when it comes to the artificial intelligence infrastructure space. They continue to gain traction in their application-specific integrated circuits, and they're combining software along with hardware customizable to these AI hyperscalers. That includes big players like Amazon and Meta. And even ByteDance is also expected to be one of the large customers for Broadcom. Today was actually quite constructive. They're initiating a $10 billion buyback, which is about a 0.7% of their total share count, considering the market capitalization is close to $800 billion. But I think what's important is earnings estimates. You talked with your previous guest about potential estimates being ratcheted down. If you look at Broadcom, for instance, the earnings estimates have actually come down slightly over the past couple of quarters. to be more balanced
What's
relative
that?
to all the growth that they saw last year. So if you look at the forward multiple for 2026 earnings at around 19 times, they actually reduced their top line sales guidance to about 26%. So it's actually trading less than 1 times its 2026 earnings growth. So this may be one to certainly keep in mind, considering, of course, the
Punk, are you trying to work on Trader of April? The Trader of the Month for April?
George, in the context of this news today and how the stock is faring recently, how would you approach an example trade for Broadcom?
How would you do it?
Yeah, so right now the volatility on both the calls and puts are quite high. So I expect potentially
Everything's
for this
freaking
market
high
to
right now
continue
for
at
some
least in the
reason.
Short term. The only challenge in buying
Makes no
outright call
sense.
options is that you're taking a lot more risk because of the volatility embedded in them. So I'm actually going to put on a bull call spread. I'm going to go out to May, expiration. So that gives us some time for this market to settle out because we could certainly see another decline. So with that said, I'm going to buy a 165 call, and then I'm going to sell a 175 call against it. So this is a bull call spread. Altogether, it costs you about $5 a share or $500 a contract. So in essence, break even on this trade is 170 by expiration in the 3rd week of May. And you're outlaying $5 to potentially make 5. So your risk to return is 1-to-1. And that occurs, that maximum profit of $5 if the stock hits 175 or higher. So keep in mind that this helps neutralize volatility, but you don't. You still will participate to the downside if the market does correct based on any.
I'll be right back.
additional headline risk.
I'm going to make my coffee.
So it helps neutralize volatility here.
My gut's kind of hurting for some reason.
Example trade there for Broadcom shares up right now, almost 8%. George, thanks a ton for that example trade on Broadcom. And coming up next, time for our 360 round. We're diving into tech and the impact tariffs could have on the sector. Trading 360 will be right back.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
It's time to look forward
Find the next trend.
from every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. Time now for the 360 round. We're talking all things tariffs and their impact on the tech sector. For insight, I want to bring in our panel this afternoon. We've got Brian Vindig, Chief Investment Officer, MJP of Wealth Advisors. And we've got Ray Wong, CEO of Constellation Research and author of Everybody Wants to Rule the World. Ray, I want to start out with your
Ray
thoughts
Wong.
on the impact of tariffs to the tech sector. Obviously, we've seen this big sell-off recently. You're seeing some regain ground today, including leader of the pack when it comes to AI, is NVIDIA. But they've got significant exposure when you think about the export controls to China. How do you anticipating kind of a shifting of sourcing when it comes to these tariffs?
Yeah, that's a great point, right? We have to look at tariffs as part of the Great Reset. What's happening right now is a complete reset in terms of trade negotiations. The WTO failed to do its job, and what's happening right now is we're going bilateral country by country. And what that means is people that organizations that left China, that went to Vietnam, went to India, are also going to think about resourcing back into the U.S. and what's the cost factor behind that. But all that will get settled as we get to these country-specific.
Well, it's another big loss for me, I think.
The challenge here in the long run is really, what does manufacturing look like in the future? Is it massively automated? What's the human component? What will that cost? These aren't things you can't light up a factory and get it ready like overnight. That takes 3 years, 4 years, 5 years, depending how complex the manufacturing is. And of course, what are the suppliers that are there? But it sets the stage for a shift in terms of how global trade looks.
Okay, so Brian, I want to get your thoughts. Obviously, the expectation is there is the potential for a shifting in how all of this occurs. You're even seeing some conversations, apparently, I've seen this in some reporting from Bloomberg, that Chinese officials or China officials are putting pressure on some Chinese companies who are having conversations about shifting their manufacturing as opposed to continue to keep up their relationships. What are you expecting to happen in the broader landscape, especially when it comes to tech?
Yeah, well, I think because the negotiation process is going to be elongated, it's our view, because the U.S. has waged a trade war on 196 countries at the same time. I think, unfortunately, this impacts the consumer in a couple areas of tech. I mean, first, in the hardware space, where things are manufactured abroad and then come back to the U.S., it takes time to reorientate and reinvest in these supply chains. And so as a result, I think consumer prices on hardware devices are expected to go up. Also, you might see a flow through regarding online e-commerce as well, flowing through some of the major platforms. I would point out, though, semiconductors is one thing that was excluded in the tariff process here. But that's something that I would say is also up to negotiation as well, depending on how especially U.S.-China relations go over the next week or so. So right now we are seeing a little bit of a technical.
Well, I wonder what Buffett's doing with his oil stock.
I would say that some of these names do look way more fairly valued, of course, than where we were at the start of the year. And some of the names that are more durable, like software providers or things in the cybersecurity space, where investment's going to continue. I don't think that those trends are extinguished, nor the innovative trends of AI going forward. So I think it makes sense to continue to be very specific as investors look for value in the tech space relative to all these ongoing negotiations.
Ray, I want to ask you, because obviously there's clearly an attempt at a resetting of trade dynamics, especially when it comes to kind of the U.S. view. But you make a great point, and I've heard this point before, it takes years to kind of build up factories. And then there is also the point that even if they build up the factories, they could be very automated and the job's just done by robots, for instance. Where do you see the potential? I mean, first of all, I guess, do you see tariffs as kind of like a blunt tool? And if so, what kind of levers do you think would actually work better when it comes to a shifting of, kind of how policymakers could position the U.S. in terms of making tech leadership?
That's a great question on tech leadership. And what we're saying is that shift, right? Number one, what's happening is the tariffs bring everybody to the table. The first round of tariffs were very simple. It was China, Mexico, Canada, get the fentanyl off everyone's streets, stop the money laundering with fentanyl from China out. The second one is this is a reciprocal tariffs. What's happening right now is really, let's have the conversation about trade, security, let's have other conversations around foreign relations. It's all happening. Countries like South Korea, Japan, going to be very easy. Countries like Vietnam, India, less so, but countries like China, even less so. And that's really the conversation between Europe, the US, and other countries that are going to happen is really what is fair, what's not, do we get rid of that? Those are the big questions. But back to the other point, the sectors that are less impacted are software. Software is a great sector. Cybersecurity is a great
What's
sector.
that?
AI is going to be less impacted. And part of that is really because there's still going to be massive
Mike, did you
demand once we get out of these conversations. But the
Oh.
reset we're looking for here is not really about where the stock markets are. It's what are we doing about interest rates? Can we drive?
Mike says he's been in a chill zone.
Pay the bet. And that's really why there's 7 things that are going on here. One is kill the fraud, waste, and abuse. 2, get direct foreign investment up, which we did. You saw about 1.8 trillion.
Did you do your research on it, Mike?
A little exaggerated. Tariffs, keeping the fair trade, immigration, making that work, tax cuts, which haven't hit yet, deregulation, which is happening in parallel. All this driving down the interest rates and propping the dollar to get a reset.
Puts are coming in.
American tech. We still have the best higher education facilities. We still have the best innovation network.
Looks to me like I might have to just bite the big finger here.
Basically, the engines of innovation that is required. What's really happening is we don't have fair trade. And I think that's really what's going to make tech better. But we're going to feel pain for the next 3 to 6 months.
Still hold on to it a little longer, but
Okay, well, we're certainly seeing some moves in some of those cybersecurity stocks.
let's go a little bit of shares up here at 110, 1.5.
Hardware plays. We'll have to leave our conversation there today, guys. We're out of time.
But I'm still down quite a bit.
Research and Brian Vindick, MJP Wealth Advisors. Thank you both for your insight. Thank you for joining us on Trading 360. Download the Schwab Network app, available in the Apple App Store. Tune in 24/7 on schwabnetwork.com. I'm Diane King Hall. Stay with us. We've got Fast Market up next.
Oh, yeah.
Schwab Bank Investor Checking.
Can't wait till I get my new glasses.
For investors, named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor
I
checking
don't got my
account is
Kleenex
linked to your
receipt.
Schwab One brokerage account, you can manage your checking and investing
Get that out of
in
my
one
wallet.
convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab
Come on,
Bank
baby.
Investor Checking, the checking account built for investors.
Wonder if Buffett bought more of this.
I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were
Dad.
branches in the area.
He left me
started
millions.
nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren planning for their college
Mhm.
educations.
Yeah, I can hear you.
Someday it'll be their turn.
Punk's on the mic. Man, good to hear your voice. You're gonna do who? Say what you got to say then. You're welcome to get on here anytime you want. Who, Magnificent's not seeing you? Hmm.
So y'all got them from this morning, just that 5200 zone that it's still holding, but your top of the board is going to be the 5231, and that's what it's bouncing between right now. It's stuck between the 5200 support zone and the 5231 orb.
You're talking about the SPX?
Talking about ES. I don't.
Oh, yes.
SPX or SPY. I don't even have those charts up. I only use ES and MQ.
Yeah, I've traded that ES a couple of times.
Yeah, but I use it to trade SPX. So all the contracts I have pulled up for SPX.
Oh, I see.
It respects my ES levels. So
I see. Well, I had that 52.86.92 as a resistance today. And it looks like we just almost exactly hit it there on the 1 hour. On the bodies, but not here on the 1 minute.
Yeah, so that study that I have in that green dotted line and
Yeah.
red dotted line that I just posted, so it's an automated orb study. So you can see the top bottom of the orb is at 5231, which kind of lines up with what you called out. And then 5200 something, you got the 63 stacked on top of VWAP, stacked almost on top of the bottom of the orb, so that's going to be a hard place to break out.
Yeah. Does that, can you share that on a script, or does that have to, you know how to show this? Yeah, your.
Yeah, I posted the script a few weeks ago. If anybody wanted it, put it back in chat if you want to edit your studies.
Yeah, or put it, or just message me it also so I can keep it there. And I'll check it out tonight. No. Not until we find something out, like in a few minutes. If that was 12 Eastern time that Trump was talking about for the China tariffs.
Yeah. The only trade I took today was that first 5200 bounce, and that's just because, like, on my A+ setups, so I only take an A+ setup, or it only counts as an A+ setup.
Yeah.
It's in one of my zones, and on the 5-minute chart, RSI is showing oversold or overbought. And just on that one bounce earlier today, RSI got down to 29 on the 5-minute, and it was in my zone, so that's actually the only one I took. It was like a 35% trade in 10 minutes.
Very good.
But yeah, I'll only call out the A+ setups that are coming up, and that way everybody will be ready for it.
And you can, if you call that out, then people can trade the SPY and the SPX off of it, right?
Absolutely. If
Yeah.
PS bounces or drops, then SPY and SPX are coming with it. And the same thing with NQ.
Do you ever look at the tick time frame when you're trading that SP slash SES on the tick?
No, I don't look at the ticks. I look at the 2-minute to see where the 200 EMA is on the 2-minute, because it respects it a lot.
Yeah.
But the A+ setups, I don't do anything but the 5-minute zone plus RSI.
Well, on that tick, I think I got it set at 100, and 3 times we bounced off the 200 EMA on that. I mean SMA on that, which I'm just, and now we reversed right to it again. So I've traded with the tick a couple times on this and the MES and one other one.
Yeah, I'm still mad that I missed the first drop, because that was an A+ setup, but I was on that stupid work call and I missed it. You can see those big wicks around the 915 mark. It was in my resistance zone. It was wicking hard at the top, and RSI was showing over, so I should have jumped in there. That would have been, God, I think I watched those contracts go from $500 to $2,000.
Oh, yeah.
I hate having a day job.
Years ago, I made a choice. I had to look for something that I could do at night, and my girlfriend that I got back with when I moved back from Hawaii her ex-boyfriend had a janitorial business. So I said, man, what if he let me buy that from him, if he would? And he sold it to me for $10,000, the janitorial business, and that enabled me to go ahead and trade during the day full time, plus work that job.
Yeah. I hope to get there in the next 2 years. Like I said, I've only been trading will be 1 year.
God.
I've been trading for a year, and I've lost a good bit of money on a bunch of stupid strategies, but then I found this one, and this one seems to be, I mean, by far, it's the best one I've ever used, using the orb plus the zones plus the RSI. I mean, it's hitting 85-90%. So
Yep.
I'm good with it.
That's good enough accuracy. It took me a couple years to get it down, and then it wasn't really.
You only get like 2, maybe 3 trades a day on these steady pluses. I mean, it's not going to do it a lot during the day, but yesterday was pretty phenomenal.
Oh yeah. Yep. Well, I got to figure out what you mean by orbs. I've never heard that term used before.
It's an opening range breakout, so it's going to be your first 15-minute candles. You'll mark your top and your low of the first 3 5-minute candles. So this study does it automatically for me.
Yeah, I will. On the 3-minute, it also has been bouncing off the 200 EMA and SMA. I like to compare, like when I get that script, and I'm going to compare it to my charts and see where they bounce off my moving averages. Where the calls are made out, like that orbs or whatever you're talking about.
Yeah, I just posted it in chat, so grab that notepad and then just copy and paste all that script into a new study. Just name it orb.
I got to figure out how to do that.
You just go to your settings,
Yeah.
in toss, and then do create on the left hand side at the bottom, and then you just take everything out and paste in what's in that TXT file.
Go to studies.
And then you should see create at the bottom of the list of your studies.
Yeah. Mine doesn't show that.
Hang on, I'm putting a screenshot in.
Oh, yeah.
So take everything out. So it's going to have a couple of lines of code in it when you do a create. Just delete all of it. And then open up that TXT that I put in chat and paste all of that in there. And then save it.
Go to edit studies. Hey, Mike, you on here? Magnificent. Needs something worked on. I'm trying to get a hold of Mike. I got the new study 1 came up in my little thing. And open interest.
Oh wait, you can share your stream.
Yeah.
Let me watch your stream. Oh, I'll keep it. Go to your little, edit studies.
See, this is what come up. New study 1, and then
Double click that left piece of paper looking thing next to new study 1. The icon right to the left of where it says new study 1. Double click that. And then can you maximize that? Is there a way to make it bigger? Drag the edges. Let's see. Okay, yeah. So you didn't get all the code in there. You only got the first 3 lines of code.
I got the simple opening range.
Yeah, so download that TXT file that I put in the chat, and then open it with Notepad. You'll copy it all out, and I think you just grabbed like the Discord header of what I put in.
Yeah. Download the download thing. Okay. So you want me to erase all that?
Yeah, erase what's in there.
Alright. I don't know.
No, take all that out. So take everything out of there. Even that block that you can close. Backspace all the way out of it. There you go. Alright, now open up that Notepad file that you downloaded.
This one right here. Just download.
Yeah, it downloaded. I think you put it in your downloads folder or documents folder. I don't
Yeah.
know exactly where you put it.
Let's see what it's reloaded again.
Okay.
Okay. Where are we? So go to download.
Yep.
And then come over here on this.
Go ahead and open up that orb.txt that you see right there.
Oh, right there.
Uh-huh. Hit yes. Okay, now we're going to have to go back to that folder. So it was asking you where you wanted to save it. I thought direct browsing folders. You need to go to your documents folder. Or your downloads folder, wherever we just put it. Look in downloads first. Usually where Windows wants to throw it. Yeah, let's open it up there.
Okay, I got.
And then you copy everything out of it. So just do a Control A.
Control A.
And then do Control C.
Copy and paste.
And then put it into your study.
Where now did I put that at?
So Control B. There you go. Now where it says New Study at the top, go ahead and name it like Orb or Smarter Orb. Okay, and then hit apply and okay. Down there, bottom left. I mean bottom right. Okay, there it is. Now I don't know know if it'll mark the days, since the day has already passed. May start marking it tomorrow morning. But now, yeah, it did. So today you're automatically, it's going to automatically from now on mark your orb out for you after the first 15 minutes.
On this one chart.
On actually all your charts.
Oh.
So if you change it to NVIDIA or Tesla or whatever, it's going to mark those as well.
Yeah.
But it's only going to do it for the charts that you apply that study to.
Yeah, that's
So,
it.
yeah, if you have multiple strings and multiple charts, it's not going to do it unless you apply the study.
I'll make sure I got a spare one over here. Okay, well done.
All right, my man.
Thank you very much.
I'm going to shut up and let you have your stream back.
Oh, you're fine. You can get on here anytime you want after an hour. If you ever need to talk about anything. 10-4? Looks like we're pulling back. I gotta make up my loss somehow. China must have said no. We got a new low of the day. I got out of these here things. About $900 in the hole. Let's see if we can try it again. This time I might trade the SPY instead. Give me an F, my magnificent. I gotta figure out why you got. It just don't make sense why you got spanked today on that thing. Yeah, I learned a little bit today. Yeah, I learned a little bit today.
Wonderful company that, is going to go down with the rest of the market, but maybe one of those that recovers quicker.
AVGO.
As smooth it looks on your screen. Remember, why don't you guys show an intraday of either the S&P or the Dow, which will probably give a similar sort of look at how the session has played out. Looks to me like we're almost at the lows of the session.
I think it's the earnings. I think it's
the earnings, and you know what? The Fed is in a really, really tough spot here.
The Fed is in a real tough spot.
Continue to build out AI infra type of environment. Is that a concern moving forward for this company?
I think so, and then also the concern is Apple, which is one of their biggest customers.
Yeah.
And if we are seeing maybe some tension back and forth between China and the United States, and we don't have any further clarity, how confident is Broadcom going to really get for that particular customer, which is their largest one? So I think there's probably some potential risk here, but it makes sense. I mean, this buyback here, I would not be shocked if throughout the whole earnings season you might see a lot of these companies say, hey, we already had a plan approved, or we want to increase that more because our stock's down 20%, 30%, 40%. This might be the best way to
Tesla's pulling back
for now. And so if you're looking at the secular trend when it comes to this company, I think you're right there. They do have a moat when it comes to this business, but I feel
on
like
the 3-minute SPX hit the 200.
Traded into one name. That
EMA.
Honestly, we're probably already going to see some weakness when it comes to Apple sales in general for iPhones. It just seems like that was the trend. We don't see the super cycle type of situation taking place here. I think it makes it a little bit hard for Broadcom to be able to guide moving forward. But nice bounce today and a really good use of capital if you don't have anywhere else to put it right now because of the uncertainty in the market.
Yeah, the CEO stated that when they announced a $10 billion buyback that they're betting on themselves at this point. Just a real quick heads up here, guys. Stocks are cut their gains in half from the highs of the session. We're starting to fail here a little bit, but the S&P 500 still up 1.5%. NASDAQ still up 1.7% at this point, but we're starting to see some weakness here. KG, when you look at this one on the 11% bounce that we've seen over the last two sessions, how do you want to set this up for an example trade?
Yeah, decent little bounce over the last couple of sessions here, but even if you're looking at it on an intraday basis, we are seeing it fade outside of just the broader equity moves that we've seen here. So I'm actually looking at buying a put spread on this name, buying the April 17th 165 put, selling the 155 put, doing this for a debit of $3.45 here. Max loss is going to be $345. The debit pay, max gain $655 with a break-even.
I'm going to name this one after you, punk.
I believe this spread's going for another 40 cents or 50 cents higher right now because the stock has moved to the downside. But this is trying to capture on a little bit of a retracement after some of this move to the upside here. And then also, once again, have being limited risk with that defined debit that is out there. And once again, Tom, this is one of those trades that if it goes in your direction, goes in your favor very aggressively, maybe hits that short strike of 155, potentially looking at taking profits rather than letting it expire. And this expiration is going to be on Thursday, not Friday, because of Good Friday we have as a holiday for the market.
Yeah, take advantage of a move in your favor if you're putting on these trades when it happens, because things can turn.
We got a nice support right here
in the markets right
at
now.
51.15.
April 17th, monthly options expire 9 days. Really short-term positioning here. Buy the 165 strike put, sell the 155 strike put. Again, to offset some of those costs. We've got 345 debit. That's where it was trading earlier. That's what your risk would be, $345 per spread. Break even 160, 155 to the downside, so not too far from those levels. And Kevin, when you look at this KG's example trade here, he made a good point. If you get
That's ascending triangle support.
Say this thing expands, maybe doubles in price or gains 30%. That's when you start having to look to do some trade management on it, just due to the overall moves that we've seen in the market, let alone an individual stock, right?
Yeah, this is an 18 short delta spread is what I have it. Trading a little higher than when Kevin put it in, but the overall market has softened ever so much. So I'm not surprised that it's a little higher. And just remember, break even on this spread is the long option, in this case the 165, plus whatever debit you paid for it. And the risk is the debit you pay for it. So there's you're betting on a retracement here in Broadcom going back towards the 155 strike. Tom, it's already made a couple pennies from where Kevin was looking at it. So this is a trade that is risk-defined. It's got less than one Vega, so you don't have a lot of Vega exposure on this. That's a good thing. But yeah, the risk is the debit paid, Tom.
Yeah, KG, when I look at trades like this, and you talk about the flexibility of trade management on this, maybe get out if the market's open when you can, not when you letting it go through expiration, hoping that it's below 155, is that, a lot of people would say, oh, just buy the 165 put if you're bearish on this name over the next week and a half. That's like a $9 put, as opposed to, which would take your breakdown even lower. You're getting rid of about over $5.10 worth of risk on this position by selling the 155 put against it. So it's not like you're looking for this stock to fall 10%. You just need a pullback of a few percent, for this thing to come to full profitability, right?
Exactly. You're implementing that short leg in order to try to reduce some of the cost to have exposure to the downside here. This is not really an environment, especially when you're looking at a 40 VIX. It's not really an environment that you want to buy just outright short-dated calls or puts, right? If you wanted to try that type of strategy, you might have to go out in time. And if you go out in time, you're going to be spending more money, but you're also going to have a little bit less duration risk. You're still going to have the ball risk out there. So this is just trying to be a little bit more risk-defined. You're looking at the risk-reward ratio for a trade. Even though it might go... that long put, you're also in an environment where we're at historic levels for implied volatility in general, and at some point, which is guaranteed, it will crush. Vol will crush, and if you're on the wrong side of that trade, that could actually impact premiums to the downside just in general here. So you're exactly right. You have the ability to kind of maintain this trade. You don't have to have it really max out. It might be a 1.5 to 1 risk-reward ratio or 2 to 1 risk-reward ratio. It just kind of depends on your profitability level that you feel comfortable with.
Yep, fading, a little contrarian on that $10 billion buyback, but markets have been sinking here a little bit. All right, great look at the AVGO bearish put vertical as an example. Thanks to Kevin Green, Senior Markets Correspondent. Let's take a quick break. When we come back, we're going to be joined by Andy Swamp from Lifefolio for a look at sentiment data in Delta, which has been really negative as far as the stock price goes. That stock's fallen 45% from its all-time highs in just 3 months. Stick around. We're talking airlines when we come back.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop.
Okay, watch SPX here. Okay, dokie, I'm waiting. I want to see if this holds. I might get my money back here soon. Here's the prison guy up.
The global economy, etc., is in a little bit of volatile period right now. But how much do we think tariffs are going to impact our business? Essentially, you have to be expecting a real recession if you think this is going to impact overall travel trends. And so Delta, I think, is, clearly put itself in the driver's seat. They're the best of all the airlines at doing the one thing that people want airlines to do. And the number one, that is get me A to B on time most of the time. Delta is very good at that. The other thing Delta is very good at is providing a premium experience that the client, the customer, can pay up for. And they're doing that. Southwest is so far behind, still has people getting on and picking out their own seat while they're trying to figure out how to board an airplane. Whereas Delta's monetizing almost every seat on the aircraft. And so, best of breed. I agree with you, Kevin. I think that the overall travel trends are pretty good, and with oil down where it is, that's pretty much straight to the bottom line, that savings. And so I agree completely with you.
Andy, when you look at this compared
You just
to
hit support.
we all know that Delta has the best balance sheet out
No, I'm
there.
gonna give it a shot.
CEO Ed Bastian came out just over a month ago at that JPM Industrials Conference and lowered this quarter's EPS and revenue guidance based on softening demand from consumers. We've seen the confidence and sentiment data numbers on here, and this is the best run, airline. They can still cut full year 2025, but when you look at this compared to the competitors, when you guys are looking at your data, this is still probably the top out of all of them, right?
Yeah, it definitely is, and I think at this point, with shares down over a third in the last 3 months, you pretty much got to say it sounds like the market has already priced in a 2025 full year revision lower. I don't think that that'll be any shock if they come out and say, look, things might be soft for a little while. I think the market's already anticipated that. If anything, you might get a relief rally if it's not demonstratively lower. So I think they're in a pretty good spot. If we get any further downside, then I think this is one of those stocks that I wouldn't mind absolutely loading up on for the short term, or for the long term. I think short term, it'll be extremely volatile, and you have to be willing to take that short-term risk and volatility for the next at least 2 to 3 months.
Yeah, you wonder what their guidance is going to be. Do they cut full fiscal year 2025? Or, hey, we're going into summer travel season. Are people booking ahead of time? So they'll give us some data on that, and the impact of those lower fuel costs also will come into play. All right, great stuff. Great data as always, Andy.
Thank you. Have a good day.
All right, that's Andy Swan, co-founder of Lightfolio, breaking it down for us. Kevin, I mean, as much as these stocks rallied into the last 3 or 4 months of 2024, they've given up all those gains and then some in this type of environment. But I kind of get what's going on. As you mentioned, airlines are always highly volatile. The stocks are, even though they've got low PE ratios, single digits for some of these names. But at the same time, consumer confidence sentiment data has been really weak. It just has to be one of those things where people look at this and go, well, maybe I want to take some upside exposure, but man, how do you do that in this type of environment going into earnings, which could flip the script on everything?
Yeah, I mean, here's what I really like what Andy just said. A lot of this bad news is already in this stock, right? They've sold it off so much. The last 12 months, Tom, think where we were in the last 12 months. This stock is down 18% in the last 12 months. Is it from adding capacity? Is it from their guidance? It's hard to say, probably a little bit of both. But man, they creamed this thing. It's down to a 7 PE, Tom.
Right.
A 7. So, I mean, the stock is only trading $37. It's a very inexpensive play here. Doesn't mean it can't go down. Doesn't mean they're out of the woods. The guidance is going to be key. But how does Ed Bastian see the summer and the second half of the year? I think it's going to be vital for Delta.
All right, Kev, you got an example trade for us here in Delta. Break it down for us.
Using the dispersion in the expirations tab, selling a 140 in the April 11th expiration, buying the 115 in the April 17th. All I did, Tom, was the April 17th, April 11th.
Yeah, strikes on this, Kevin.
I'm sorry, what?
Yeah, go ahead with the strike.
Yeah, 42.
Okay.
I just lined up the expected move. I put the 42 call calendar on, Tom. That's trading. It was 40 cents. Now it's 35 cents. So that is just a very short-term move up towards the $42 strike, which is in line, I think, with the expected move. Actually, a little inside, but more in line with the move for the week, Tom, because. Boy, the whole, I mean, I think the chances for a relief rally here are fair, Tom.
Yep, let's break this one down. As Kevin mentioned, the option market's priced in for just a one-day move, $2.80 either way, plus or minus. For the week, for the next 3 days, about $4 move either way. So this lines up with that $4 move to the upside on this 1 week wide bullish call calendar. Buying the April 17th monthly options that expire 9 days, the 42 call. Sell that same strike in the April 11th weekly options that expire 3 days. We've got a $40 debit or 40-cent debit on that. That's your risk. $40 per spread. Trading a little bit cheaper than that right now because
it didn't hold
at this point. But that debit you pay is your risk. Now you're shooting for the 42 strike, but there's probably
options are still high.
Or a range in there between maybe $39 to $40 on the downside, and then all the way up to maybe $44, $45 on the upside, where you can remain potentially profitable on this one. Inexpensive way to get some upside exposure to Delta going into these earnings due to, as Kevin mentioned, that vol dispersion, which lowers the price on this. You've got some assignment risk on that short option going into expiration over the next 3 days, so keep that in mind. The idea here is it goes up about that $3 to $5 from these current share price levels. You just don't want to move to the downside. You don't want the stock to sit where it is, and you don't want a 2-3 standard deviation move to the upside on this one, because that's when you get hurt. But you do have a decent range to remain potentially profitable. All right, good look at the call calendar there in Delta Airlines, but let's take another quick break. When we come back, we're going to take a look at Netflix. The streaming stock is positive this year, but is down still about 15-16% from its all-time highs that we saw in February. Stick around.
Apple's now in the red. That'd have been a good short with that China news. So YouTube China missed its deadline with the tariffs. It's going to get ugly. I'm going to see what Bob is doing. Yeah, Bob is down to $100. Well, I wish Trump would kind of low. $96, 97. So next support for Baba. Oh yeah. Do.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more, all crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Fast Market here on the Schwab Network. Before we take a look at Netflix, we need to get a quick market update because stocks have given up almost all of the gains today. Don't turn your head, you're going to miss something. S&P 500, the benchmark, now up only 0.8%. The Dow Jones Industrial Average, more than cut in half those gains. Still up 450 points, still in the green, up over 1%. NASDAQ 100 only up 0.8%. The NASDAQ 100 was up over 4% earlier in the session. So yeah, a big whacking here on some of those tech names that have been doing well. Russell 2000 small caps now negative. Russell was up nearly 3% earlier in the session, now down 0.4%. So don't take your eyes off the market. Things change quickly in this choppy, thinly traded equity market. All right, let's talk Netflix. Named a top pick at JP Morgan earlier today. The stock, I mentioned it was positive on the year. Well, the downturn in the market, we're down 0.6% so far in 2025. So it's given up some of those gains, but being rather resilient in the face of the equity pullback. Let's bring in George Tillis, senior markets correspondent here. George, when you look at this name, you know, maybe it should be doing better than the overall market, right? It's not immune from a downturn in the equity market. We've seen that, but maybe it's a little bit of protection. A lot of people don't like to give up their Netflix, right?
No, I mean, I think if you look at the price action, let's just call it flattish over the past, at least year to date. It's slightly to the downside, just depending on how the market's doing on an hourly basis. But yeah, I think if you look at Netflix, it's still holding up really, really well. Obviously, it's been down on a year-to-date basis alongside the market, but it's nowhere near some of the major decliners we've seen in the mega cap names and the Mag 7 names, and even really some of these artificial intelligence names, which many of them are down 30 to 50% in some capacity. But I think if you look at Netflix, it really comes down to, you know, where do you actually put this stock in the discretionary bundle for consumers? And, you know, there's probably going to be some pullback in travel and leisure, maybe in some e-commerce areas, but I think it comes down to the price of the service relative to other items that people spend money on a monthly basis, and it's not that much. So in essence, I think this is a stock that is relatively more immune, not necessarily completely immune to the market calamity we've seen as of late, and potentially a recession. I mean, JP Morgan has about a 60% probability now of recession, but they're actually still constructively bullish on Netflix. They did lower their price target to $10.25 from $11.50, but they do talk about the nature of Netflix's business, which is a little bit more immune to the other areas that people may end up cutting back on, which are more sensitive to changes in purchasing power, maybe even more sensitive to changing economic conditions from an employment standpoint. I mean, if people are unemployed, they're probably going to be wanting to watch movies. They're probably not going to be able to afford travel. So
not
that's
me.
in essence what the call is about with this name.
George,
no stock, if the last week or so has showed us anything, no stock can avoid a global sell-off, right? It captures every single name out there. The question is, what stocks will recover if we've hit our lows or if we're at or near our lows? You know, this is a name that is clearly the leader in a sector of the U.S. economy that the world seems to be migrating towards streaming and away from linear TV. That every year, every quarter, they get better at their business than they were before. Now starting to get the last hurdle, which is live programming and live sports, into their programming, George. Is this just a good company getting sold off with the rest of the market, and therefore when the market recovers, this will be one of the outperformers?
Yeah, I mean, I think you just got to look at it in the nature of this business. I mean, this is a streaming content provider. I think the live sports business is growing. It's been a little bit expensive for them to do so, but I think it's going to pay off in the long run. And I think the market conditions also speak to the dominance that Netflix has as maybe a more defensive stock in this market. I mean, obviously it's still down year to date, slightly to the downside. It's not immune to it, but I think if you look at the technicals too, even the pullback, the stock still is holding its 200-day moving average. You can't say the same for the S&P 500 or many of the other, large cap or mega cap names we talk about. So I think if you also consider the context of the earnings estimates, even if they're revised to the downside, which many companies may end up doing so this quarter, because there's always going to be an excuse to do so. And I think right now the exogenous reason, because of tariffs and the pullback we've seen, may create an opportunity for companies to revise their guidance to the downside. Netflix might also do that as well. But you also have to consider, the offset in EPS guidance might be manifested in a better outcomes for digital streaming business going forward, particularly in places like Europe, which they're growing, the Asian markets also, and it's becoming a global namesake brand. I think if you look at also the elements behind its forward multiple, around 28 times next year's earnings. Historically, it's around 43 times, but they continue to grow their profit margins, and I think that's important for this underlying business.
Yep, their total subscriber is now 302 million, but they're going to stop. They report earnings next week. They're going to stop giving those numbers on earnings. You have to take that into consideration. All right, great stuff. Thanks to George Tillis, senior markets correspondent here, helping us break down Netflix. And Kevin, they reported nearly 19 million added subscribers last quarter. That was more than double what was expected, and that was probably due to the Tyson fight and then also the 2 Christmas games where you had people subscribing to get those games. So maybe it's better that they're not going to report subscriber numbers anymore, because you expect those quarter over quarter to be down pretty significantly. But that being said, as George mentioned, it has broken its 200-day moving average flat on the year in 2025, still down about 16.5% from those all-time highs. So I looked at a strategy here, Kev, and this is one of those strategies where, hey, the stock can go lower, I can still be profitable, but it's still a neutral, the type bullish type of strategy where I can collect a big credit. We talked about this yesterday on the show, this type of strategy in this type of environment where you're seeing big swings in the market, where you can give yourself a cushion to the downside before getting hurt. So I'm buying a broken wing put butterfly to the downside for a credit. So buying one of the April 17th, this expires in 9 days. Buy one of the 870 puts, sell 2 of the 860 strike puts, and then buy one of the 820 strike puts. Collecting a credit, I've got $6.50 credit on that right now. That would take your break even down to $843.50 to the downside. It's trading $8, and that tells you what happens when the market moves the way that it has. Netflix has moved down over $2 from when I looked at this before. But if you collect that credit of $8 or $6.50 on that one, it takes your risk below the 820 level, where it's going to be over $2,300 to the downside here, Kevin. So, Kevin, I look at this.
Zim's at $11.99.
Volatility. You're giving yourself a cushion to the downside. Even above 870, if it just goes above there, I still get to keep a big, fat $6.50 credit or more potentially on this type of trade with that kicker right at or near that 860 strike, which is where I'm short 2 options.
Yeah, it's interesting. You're short a $40 put vertical, long a $10 put vertical. The margin on this is $3,000, reflecting the difference between the two, right? Because if it goes to 820, the most you can lose is, you'd make 10, you'd lose 40. That's why you've got $3,000 in the margin. But you're doing this for a credit, so it's not even that much. So, yeah, you're looking for a move on the downside here towards 860, but this is a put vertical, or a put butterfly, that is long deltas. So it's got no upside exposure, and you'd actually, based on your delta, you'd rather have it go up.
Oxy's getting close to my support.
In between, towards that 860 strike, you could put it on for credit, take it off for a credit, Tom.
Oh, yeah?
But right now, you'd rather have it just sit here or go higher.
And that break even of $843.50, if you collect $6.50 credit, that's about 5% below the current share price. But this is one of those strategies, as you get closer to that earnings event, maybe that's when you want to put it on based on where the stock is at that point going into the results. So good look at the unbalanced put butterfly for credit there. All right, that's going to wrap it up for us today here on Fast Market, but stick around right here in the Schwab Network. Next Gen Investing is coming up next.
Gonna make me some tea. I'm gonna figure out what to do.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had
Dad.
a Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me.
I get over there to Mexico for 856. And the return flight's $9. God, 1,500 there. 8 a.m. I can't do that. It'd have to be that one. It's $970. Get me to Mexico and back on Dow. And I can upgrade first class. $972. That'd be $1,800. $1,900. Woo! Goodbye. AMD is giving back all of its this morning. That's probably not good news for. Ooh, look at that. Well, I don't have to do much trading today until the end of the day, and then we get the bounce.
Like we don't have a lot going on, and all of a sudden
New low,
super busy,
AMD.
just glued to the headlines and wishing for the days of maybe a more quiet market.
No, it's funny you say that. I'm not sure if you saw the post I made. That I think it might have been Friday afternoon on X, but I essentially said that sentiment. I was like, it's funny how markets, when it's calm, all you do is you long and you hope for some action and volatility. Then when it comes, all you want is for things to settle back down and get back to normal. So it's always a be careful what you wish for when it comes to financial markets. And it's always this pendulum that swings so far one way or the other. It's like there's nothing going on, or it's like it's everything everywhere all the time going on. And it's just
take a little break.
And it's so much that you don't even know what to do. And that's what makes this so fun.
That is what makes this so fun. And I will say that from my own personal, maybe investing trading standpoint, a lot different than how we cover, of course, these markets, because from a coverage standpoint, it is a lot of fun to always have news to parse through. But within that news, we do have a lot of analyst calls today, actually a lot focused on the tech space that we'll be diving into today throughout our show. We'll kick things off, as always, with upvote and downvote. We will be charting and trading those names. FOMO today, we are talking Apple, which is at least right now still higher on the session, and also just finished out its worst 3 sessions since 2001, losing about 19% over that period. So hopefully this news that they are going to start rethinking their supply chain is going to provide some well-needed upside for Apple shares. We'll also be looking more into the various Medicare stocks, which are all having a pretty decent session today as a result of some news we got from the Trump administration. We'll also be diving into American Airlines with a downgrade to sell today from Goldman Sachs, and the airlines have been taking it on the chin a bit today. American Airlines not exactly getting the sentiment from the sell side today and lower on the session here.
Yeah, and there's a lot to get through. I do want to get to the movers, but I do want to read the headline that I'm seeing that came across the wire about 5 minutes ago, and it may explain why you did see the Russell flip pretty firmly red and why you do see S&Ps and NASDAQ.
MRVL, I haven't looked at that one.
It does look like, and this is quoted as official or U.S. official, U.S. is moving forward with 104% tariffs on China, I believe, as of midnight.
You idiots.
Coming up the next day. So we'll see if there's more developing there or if we're getting more facts of that. But that is the headline.
Marvel's pulled back big
here and point to for the market's weakness here intraday. Let's get to some of those stock stories. We will, of course, update headlines as we see them and as major market moves happen. We'll go ahead and we'll bring those up. But we'll keep the show going as well. I mean, we're still green on the session, so unless something drastically changes, I don't think we'll pivot off it too much. Let's go to Meta. Price target cut. These upgrades, downgrades. So we oftentimes, when it's quieter, we focus on, is it a buy, is it a sell, what is the price target? In volatile macro-driven markets, Jenny, I actually find the reasoning far more interesting, as it gives you an idea of whether or not you believe in the story, because you might have to have a little bit more patience in a market like this.
I totally agree, especially this note from JP Morgan, which was regarding their 25 tech names. So they're reducing their estimates, multiples, and price targets across 25 tech names, and specifically the internet world. Now suggesting
I gave him one.
Chance of a recession in 2025, and for, of course, the U.S.
He had to get on his knees, but I gave him one. I gave him an A+. Didn't I? Magnificent. Get on his knees. Magnificent even been sanctioned today and still give a good call. Ain't that right, Magnificent? I hope China I hope China gives us tariffs of 200%. Oh, them damn Americans, Chinese are stubborn people, man. You can't push them around. They'll do a kung fu on you. We made China? You think so? China! I'm the Mexican Mando. China, yay. I'm going to make my tea and I'll be right back.
Was up 7.5% from the preceding quarter. And Apple was the single biggest contributor, which actually bought back about $26.5 billion worth of their shares. So $10 billion, not too shabby, a big number. And I think that the hope
Apple dropped below support.
That we'll see this trend hopefully continue, as right now companies have had a willingness to shell out cash for AI. And I think that the idea is if the health of these companies continues, we could see buybacks, but there's a lot of unknowns there right now.
Oh, I don't know if this is a good buy or a bad buy in the grand scheme
Okay,
of
we're
things,
about ready to hit support on
reading these
SPX.
stories after the
What time is it?
sold off and not when it's at all-time highs. So the fact that they're saying, hey, look, you're going to throw our stock out with everybody else, and you're going to give us an opportunity to rebuy our shares
I'll be right
at a
back.
price that we feel is a good
Can't believe I got stuck in
I
that piece
love
of
that they're
crap
kind of putting
today.
their, money where the mouth is and betting back on themselves with this story, and perhaps doing so in a way that is actually buying some value as opposed to just continuing to churn at all-time highs. S&P's almost unchanged, so keep our eyes on that. Let's talk AMD. AMD has flipped red. It's down 1.6%. This is a downgrade note, though, so you can maybe link the news to that as well, as why it's been a little bit of an underperformer throughout the session. But the stock down 1 2/3% here as AMD continues to have a pretty steady downtrend.
I know, look at that chart, and that just speaks to the fact that there was no real election rally, no real end of 2024 rally. I mean, I know that this name at least saw some momentum towards the end of last year, but it has been a pretty consistent and pretty gradual move to the downside, unfortunately, for AMD. KeyBank today downgrading shares to sector weight from overweight. No price target given, saying they have increasing concerns about the sustainability of the company's China AI business, as well as increasing risk they see to gross margins given the potential price war with Intel. Further, they also say that right now AMD has limited opportunities to gain additional share versus Intel, given the progress in which Intel is making on its 18A, which is basically its new chip making process. So while AMD shares are relatively inexpensive, semiconductor stocks, they say, rarely work with risk to these gross margins.
Intel's at 18
When was
something.
the last time, though, that we read a note that favored Intel in any capacity over AMD? That's why this was so interesting to me.
Yeah, it's like a blast from the past.
It's like 2010.
Literally. And when you look at that, I think it goes to show that at some point, these stocks get so beaten down, it's just a matter of relative downside at some point. And so Intel, much perhaps closer to what the market feels is fair value, given its performance, but it's not like AMD's performance has been all that much better over the
SPX.
years.
Let's see if it holds here.
In terms of relative to its highs, it's certainly significantly off them. 50% decline over the last 12 months, 24% decline. AMD, we give so much kind of flack to Intel for struggling over the last few years when
Gosh, so
semiconductors
freaking
have been
high.
such a standout within the marketplace. AMD is down 24%
I don't get it.
on a 3-year time frame, and it was like one of the winners. So it goes to show there's been a lot of value taken out of these names.
There's been a lot. I mean, AMD was at one point seen as the second horse in the race between them and NVIDIA, and that is no longer the narrative. I mean, at least as far as our coverage is concerned.
For context, NVIDIA is still up 271% in 3 years. So even with the pretty steep sell-off you've seen there, it didn't do anything to dampen the enormous 2-3 year gains.
Yeah, that's also a good point. And that NVIDIA is still well off of its lows too, whereas like you have Intel sitting at 52
I'm gonna
lows
take a
today,
trade.
AMD just about 5% off lows hit yesterday. But moving on here to Netflix, our last name today. Netflix has actually been somewhat of a point of resiliency, and quietly so, as we're only down about 1.9% on the year. I know we've pulled back 17%, so arguably in a pretty steep correction territory right now, but still a name that chart looks a lot better than a lot of the rest of our tech coverage. Morgan Stanley actually named Netflix as a new top pick in media and entertainment, which I knew you'd love, Alex, because all these top pick lists always have various factors that I guess warrant these names to be added, but this is going to replace Disney, which they says applies a more defensive lens to their media and entertainment coverage, which leaves them incrementally more bullish now on Netflix. They do argue Netflix has demonstrated this relative resiliency in a weaker global macro backdrop, really arguing that momentum in its core subscription business combined with its recent U.S. dollar weakness and right now de-risking of these 2025 estimates they believe should really see this name actually continue to perform well. So they have an overweight rating, a just over $1,150 price target, yeah, exactly, on Netflix, and say that this is
Give me 340.
So Netflix higher today, giving back some of that in real time, but has been able to outperform the rest of the streaming world quite well this year, last year, and right now subscription and its streaming growth still dominates everyone else in that market.
Yeah, and I really love your point about its kind of relative resilience. I like to look now, I always kind of pick points in time that I think were significant. And you talked, of course, beginning of the year, still clinging on to some gains. You talked about it relative to the highs, but I went back to November 4th, the close before the election. So we've talked so much about this run-up to the election and the give back, and many of the names are trading lower than where they were before the election at this point. Not Netflix. Netflix is up 17% still from that moment. So it really has been an outperformer, not just in streaming, but as tech in the stock market across the board. So I hadn't realized that. I'm glad you brought that to my attention. And I think you should pay attention to those kind of signals that the market's giving you, because there was indiscriminate selling the last few days. And the fact that Netflix has hung in there better than its peers, and its peers being tech in general, I think you should pay attention to that.
I agree, and I think this one has been added now to our watch list here.
I will,
because
Alex.
It's not a Mag 7, but it's been performing far better than the Mag 7. So looking a bit more magnificent than the Magnificent 7 group of stocks we've come to know and love. But we will be stepping away from Netflix. We'll be diving more into Broadcom as well as AMD, looking at two names in the semiconductor world. We'll be looking at the technicals and some example trades of both those names. Stick around, we'll be right back.
Bouncy poo off my support. $5,200s. We're getting right back down to my break it.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions.
That's to break the 21.
Complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Next Gen Investing. It's now time for our Chart Master segment. Today we are looking at the technicals in both Broadcom as well as AMD with Rick Ducat, of course, our Chart Master. Rick, walk us through the chart here. We'll start off with Broadcom, which had some positive news of the share buyback today. And so shares I say this so cautiously because the market's turning over a bit, but we are still firmly higher, at least in Broadcom here. So we'll start there. Walk us through this chart.
Yes, an interesting recovery for this particular name here. And what we're seeing with the chart, first of all, is that we're down like 35% or so from those 52-week highs that we saw near 251.88. And from there, we established a kind of a top ceiling area near about 248 or so. Price made a stab at overtaking those levels a couple times, but then we transitioned to those two white dashed trend lines pointing downward, giving us this downward channel type shape. You can also see that our longer term blue trend line has been broken. Price also has fallen below all three of our moving averages that we follow: yellow 21-day, orange 63-day, purple 252-day exponential moving averages. So they are all turning downward here. This suggests, the trend has indeed shifted to the downside. But there is a potential bright spot here. You can see our green line there at the bottom near about 135. Price held on above those lows. We did not even actually test them. We came close, but not quite. So that's a notable point to watch to the downside. Another potentially bullish signal here. We can see the RSI, our measure of momentum, has been trending downward for a while. It was also in the oversold area. Now out of the oversold area and rising above that longer term red trend line there. So an interesting situation to be sure if the price breakout does continue, Jenny.
Okay, so speaking of this breakout in context of the longer term picture here, what are you watching when you zoom out? And for a lot of these tech names, things look better. A lot of times they don't, frankly. So what are you watching when you zoom out and look at the big picture?
Sure. So first, let's continue looking at our 1 year, 1 day chart with our volume profile and standard deviation channel studies. What we can see here now is that there's a significant potential resistance point pretty close to where price topped out today. We've got our point of control, that thick red line near 172. Then we also have our yellow 21-day and purple 252-day exponential moving averages pretty much right on top of each other at about 175 or so. So 172 to 175, that's the area to beat if price can manage to break out of this downward channel to the upside. To the downside, we've got our ultimate recent lows here, 134.9, our green line there. But that's also the site of a volume node just above. So an area of heavy trading around 140. That could be a potential foothold in this name if things do continue to deteriorate, if things don't go quite the way the bulls are hoping here. And if we take a quick look look at our 5-year chart, our last chart here as well, we can see that we did break out of a longer-term upward sloping trend line. We broke below our solid blue line, which is our linear regression line, our line of best fit based on closing prices on our weekly basis here. So that's now our resistance point. That same confluence, the trend line and the linear regression line and the volume node that all take place at the same spot near about 165. That's the mark to beat, Jenny.
Okay, yeah, and so this name, I mean, thankfully still hanging on actually to a pretty nice move here on the session, even though well off of the peak, of course, of today. But now when we look at trading this name, just for example purposes, of course, Alex, walk us through the thinking here. I mean, leaning into the fact that we're making a nice move today, but again, this name has not been immune to some of the pressure of the overall market as we pulled back pretty substantially here, now down about 32% nearly on the year.
Yeah, we found an area in the marketplace where buyers were comfortable to step in, but that didn't mean the selling was over. We're back to unchanged here on the session overall, and so I think it goes to show that this volatility is maybe here to stay, and we might be more range bound. So I looked at a range bound neutral strategy that sells volatility in Broadcom. It's a May expiration, gives a little bit more time, allows this to be a little bit wider of a spread from those two short strikes, and also it's still risk defined. And of course, it avoids earnings as Broadcom's one of the late earnings season names. So it's the May 135, 130 put vertical to the downside and the 190, 195 call vertical to the upside. If you can collect $1.75 on this, your max profit would be $175. And then of course you'd have the balance of that $5 wide spread left, which is $325. So with this particular trade, you want it to stay within those bounds being 135 to the downside and 190 to the upside. And of course, as time goes on, if this is towards the middle of that, you would expect, don't know for sure, but you'd expect that that would slowly decay over time as volatility would erode. But most importantly here, risk defined, 133 and a quarter, 191.75 is the break-even point on this particular strategy. So if it stays between those, then you have a chance.
Okay, now shifting gears and looking at the name that has been a bit more of a pain point of the two, just relatively speaking, of course, that's AMD. So Rick, walk us through AMD. AMD stuck out to me in the sense that it has not caught any of the love, or momentum of what has been moments and pockets of upside for tech. Unfortunately, it has been a slow churn to the downside, really since about October or so of 24.
Yeah, and it's funny because at once it seemed like it was the darling child out of the group, and now it's the one that seems to have performed maybe near the bottom of the group. Just like you said, the least amount of love, I think, from the market here. Nevertheless, as we look at our price action, we can see a longer-term downward sloping trend line there in white. Our channel, our two accompanying trend lines, has overtaken the more gradual downward sloping trend line, starting with that high point near about 187 or so from back.
We're back to 340, 350 here.
The trend has accelerated to the downside.
I got up about $1.30.
Moving averages, the faster have crossed below, the slower they're continuing to
$1.40,
suggesting the downtrend is still in play here. Nothing is really showing that we're seeing any kind of reversal,
break back up.
bottoming out. You'd be looking for perhaps sideways consolidation for the moving averages to calm down and
just don't hold them, we'll stop out.
Sideways. So, I mean, we tested a downside breakout from a downward sloping channel yesterday. We made new 52-week lows. RSI still is presently oversold, and it all happened on volume spikes, on relatively heavy volume.
Bitch.
So the picture right now is a little precarious, I guess I might say, based on this stuff, Jenny.
Okay, and obviously also has been lowered today and pretty substantially, actually now down over, actually 2%, not to add pain here to the narrative. But long term here, is this giving you any more sign of optimism or just strengthening the unfortunate downtrend that's picking up momentum here?
Yeah, when we try to look for potential support, probably that's what most of us are more worried about right now, would be support rather than resistance. We can see that where we are right about now, we are pretty close to the
Nope,
minus
they're not happy
standard
again.
deviation channel. That comes in near 85, one standard deviation below our linear regression line. You can also see that we are near that the lower edge of that channel. That's also a support area right near 80 or so, the lower boundary of that channel there, that white dashed line. Pretty close to that standard deviation channel as well, so perhaps a bit of a supportive confluence there. If we were to move to the upside, though, potential resistance may be found at the 21-day exponential moving average, our solid yellow line there. You can see that it also lines up with a volume node. The only real volume node of any node near current prices comes in near about 99 or so. So that could be one area to watch. And if we were to switch over to our longer-term 5-year chart, well, I mean, the picture looks a little bit different here. And from this view, we are quite close to our -2 standard deviation channel, as well as our volume profile point of control for a much longer time period. So
I took a little bitty nap there in my chair.
The 82 mark, and our standard deviation channel, the -2 channel, would come in near about 77 or so. So these could be some key areas to watch. However, also not really that great that we broke through our green line there at 94, kind of a double bottom from back in 2023.
Okay, we're getting ready to squeeze.
So, I mean, we could be near a supportive area, but the move downward seems kind of rough so far.
It does. It absolutely does. And today is no exception to that. And this narrative now favoring Intel over AMD just shows the way in which the market sentiment has
Intel over AMD? You gotta be kidding me.
But we so appreciate it, and great look into the technical insights. Rick Ducat, of course, our chart master here. And now we go to trade this name very quickly before we go. Alex, walk us through your thinking.
Yeah.
Okay,
so
if this don't work.
This is just a name that's on its butt. Obviously, there's not a lot that's exciting about it at the moment. But if you do think that the overall market could bounce back and AMD could be dragged along, perhaps you want to do a bullish strategy. Looking at a call diagonal spread, risk defined, and something that can perform okay if the stock does work its way back up into the 90s, let's say, over the next few weeks. So not asking for it to turn into a winner over the last few years, but just bounce back, with the overall market here. So April 25th, 90 call being bought, selling the April 17th, 94 call, $2 net debit or thereabouts, $4 widespread, $2 debit, so no theoretical upside risk. Best case scenario, move towards 94 into that April 17th expiration, which is next Friday.
Yeah, and AMD seeing some, I spoke too soon. I was to say seeing some reprieve from the pressure, but unfortunately not the case today. But now coming up next, we will shift gears and look at a name that is definitely trying to make a comeback after seeing its worst 3-day stretch in now 24 years. That is Apple, with shares now down about 3% on the session here, adding to the
I fought the trend and lost.
We've seen the stock now on the year.
Dum 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 dum. Well, my support line didn't hold. If it gets back up there, I might try it again.
Is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Welcome back to Next Gen Investing. It's now time for FOMO. Today we are talking Apple, which is down about 3%. Unfortunately, not seeing the favorability I was looking at the top of the morning here, but joining us now to discuss more about some of its supply chain and production right now that's attempting to be reworked alongside the tariff narrative is Caroline Woods, of course, senior markets correspondent for the network. Caroline, walk us through the news we got with Apple, of course, regarding India and some of the reworkings of this company, which frankly, they need to figure out a way to be more efficient when it comes to iPhone 16, which has already been a bit of a disappointment, I think.
Hey there, Jenny. Yes, I was going to talk about Apple's rebound attempts today because shares were higher heading into this hit. But as you said, they've turned lower, down more than 3% right now. And that's due in part to the fact that, as analysts point out, that it's one of the most exposed tech companies to a trade war due to its reliance on China, which we know is facing at least 54% tariffs. Now it sounds like 104% tariffs. So I mean, very steep, tariffs implemented by the White House, and clearly is weighing on shares once again right now. It's only April 8th, and shares are now down more than 20% in this month alone. So it's been a rough stretch for Apple. Of course, Apple has been trying.
And Apple was your favorite trade.
China for years.
They pumped Apple. See, I didn't like the fact that they were pumping Apple so much. You remember the way I talked about it. To me, it's one of the worst ones, but just because I know it so well, I hardly ever traded it until we had this last little run. But we're at, we get to 150, like I said yesterday.
His tariffs are about 26% right now. That's just a short-term stopgap, though. That's not a long-term solution, according to this Wall Street Journal report. It's, an attempt to kind of wait and see while Apple tries to get some exemptions from the Trump administration. We know they got an exemption from tariffs in the first Trump administration. No signs that they're going to get one in the second, but we know that that's the hope there. According to the Journal, Apple sees the current situation as too uncertain to upend long-term investments in the supply chain, which is, of course, centered around China. So, this is important because the iPhone makes up 50% of Apple's revenue. And, if prices go up or Apple has to absorb those costs, the higher costs, it certainly could affect Apple's balance sheet. That same, there's a Bank of America analyst, actually, that talked about the impact there, because they said Apple was on pace to make about 25 million iPhones in India this year. Normally about 10 million of those would supply the local Indian market, but this analyst said if Apple were to redirect all of those Indian-made iPhones to the US, it could meet about 50% of American demand for the iPhone this year. So would make a dent, but obviously wouldn't cover all of it. That same analyst, though, looks at Apple's sharp sell-off that we're continuing to see today as actually an enhanced buying opportunity for investors to own a high-quality name, and actually points to Apple's PE ratio, forward price-to-earnings ratio, of about 21 times as a key inflection point. It says Apple has typically booked gains in the 12 months after an event that narrows its price-to-earnings ratio. So, it's still looking at this actually as a buying opportunity. Does say it's possible that the risk of tariff escalation with China could pose a more severe threat to Wall Street's consensus estimates for Apple, but points to the fact that they have options to mitigate some of that downside risk, including potentially shifting production to India, increasing prices, changing the pace of product releases, and supply chain efficiencies. So that's India. Now, Apple, of course, has pledged to invest some $500 billion here in the U.S. over the next 4 years. That move was seen as a way to kind of placate President Trump. We'll see if that actually comes to fruition. But Dan Ives was out with a note saying that, it would take 3 years and $30 billion to move even 10% of the supply chain from Asia to the United States, and that would be the end of $1,000 iPhones. He said it would be $3,500 iPhones if they're made in New Jersey or Texas or another state. So it doesn't seem like a very good option here, but we know they are investing here in the U.S. as well.
Oh, really?
Yeah, and I think that is such a great point about the cost in which it's going to be to move these operations. I feel like this is something that, I've just been reading some of the commentary, parsing through X, and I feel like that's something that's so massively overlooked. And of course, it's just estimates, but that's such great context for why it's going to be so expensive, even if we see these companies eventually move back to U.S. soil in their entirety, which I just don't know if that will ever happen to that extent, but we so appreciate it, and great insight as always, Caroline Woods, senior markets
back to 360.
And so now, before we look at
try it again.
Alex, I know there was some news we wanted wanted to look at here?
I got back in at 320.
So much has changed in Apple that you could still look at similar strategies. We were going to look at a short put vertical, but the prices are so different now. The example wouldn't even really make sense in real time to look at. But I still think a lot of the things we talked about yesterday could make sense, which is low basis, high volatility, risk defined, which could lead you to, if you want a neutral bullish strategy, a short put vertical. But Press Secretary Levin,
Okay, one more try.
went through, kind of reiterating tariffs expected to go through, no delays. These China tariffs with that additional 50% that was announced today, totaling 104% expected to kick in overnight tonight. And then
God.
what I was reading that I think really put a little bit
Trump, come on, get over it.
pressure on Apple is there was a comment that the president thinks the U.S. has the workforce to make iPhones onshore. So you guys were discussing, Jenny, about whether or not Apple might have carve-outs or exceptions. I think the market's reading through kind of that sentiment and saying, no, there's not going to be exceptions this time. Like, there might be some short-term pain. Apple's lost a third its value. I don't know if it's the first or the only, but it's lost over $1.2 trillion in market cap. So, to my knowledge, it's either one or two. Maybe Microsoft has also lost that much, but it's lost over $1 trillion in market cap. That's historic.
That is historic. And I mean, even the fact that I know we've had a pretty brutal couple of sessions now, I mean, just over the last three, but worse than 2001 illustrates how bad this is even for Apple.
Yeah, no, for sure. And when you look at that, like, why do you invest in Apple? Yes, it's an important company. Yes, it has AI. Yes, it has these growth aspects. But this is seen as a place of stability for portfolios. Down 30% in a year, that's in less than, year to date. Mm-hmm. That's not stability, that's crash.
Yeah, I mean, and gosh, now about 32% off of highs, so well into what would technically be bear territory here as we pull back obviously over 20% from those peaks, but we're still off lows by 7.5% to maybe end things on a more optimistic note. We'll leave it there for FOMO, but now coming up next, time to talk some of these health insurance names that are some of the biggest leaders of the S&P 500 today after we got some positive news out of Washington and the Trump administration. That story and more when Next Gen Investing returns.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Nicole Petalides, live
Nicole.
from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network. I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
We're now at 440.
Welcome back to Next Gen Investing. I'd now like to welcome in Diane King Hall, the host of Morning
Let's
Moves,
break the
to
50,
discuss
please.
the best performers in the S&P 500 today. And leading the pack is Humana, CVS, and United Health. I mean, the greatest fact to me of all is the fact that CVS
I was up on that last one, but then it didn't work out.
order as the best performer. Who would have thought, Diane? So walk us through what's driving the upside today.
especially given the performance that we saw last year. So essentially, it's a new script.
I need to make $960 today.
We're seeing shares of Humana rally, shares of CVS rally, shares of United Health rally, and this comes after this essentially a lifeline from the government saying that it will continue to support Medicare to the tune of $25 billion. So that's a big boon for these insurers, and you can see the market really reacting with a bullish sentiment, especially given that there was the expectation that you wouldn't see that, and definitely not at that level. So they're going to be supporting the Medicare Advantage payments. It's an increase on a percent basis of 5.1%. That's more than double what was expected. The expectation was a little more than 2%, which was what was proposed earlier this year. So the extra $25 billion in federal payments essentially changes the landscape for these healthcare companies and health insurers, especially considering the difficulties they faced last year. A lot of them really had, there was concern around them because margins had taken a hit. Seniors were using just more care than expected, so that really
we're at the 63.
And shares had essentially, if you go back to 2023, had been
this was a resistance.
Estimates had been slashed for all of these. So there's some new life around these. It shows that the Trump administration is being viewed more friendly to Medicare Advantage than the previous administration was, and so the market sees this as a pro-insurer move and pro-growth when it comes to that sector. Guys?
Yeah, big moves across the board. Earlier, you had the market alongside it moving higher. It was adding fuel to that fire, so not surprising to see a little bit of a give back.
Okay, now this is another resistance here.
Pivoted a little bit, but appreciate the update. Diane King Hall, always a pleasure. We're going to shift gears here. We're going to talk some digital assets and kind of the surprising resilience amongst this space as we welcome our next guest. That's Alicia Painter, the co-founder and COO of Botanics
550
Labs, is here to help us discuss what's going on here. You know, we have to draw a line in the sand somewhere. So with some people, that's going to be the highs, and they're going to say, oh, it's had this drawdown. Others are going to talk year to date. I went back to the day before the election. Bitcoin is up 14% since that.
580.
So you cannot say the
Go,
same
baby.
about the S&P 500. It's down 11%. Why do you think it's been able to outperform going back over the last few months, Alicia?
That's a great question. I think at Botanics we've seen that Bitcoin has remained stable and even outperformed traditional equities as well as every major digital asset over the past few months. And if you look at the reasons for that, it's because Bitcoin has really established itself as a safe haven asset compared to the US dollar. So if you look at the impact of tariffs over the past week, Bitcoin has actually outperformed both in terms of price action as well as realized volatility compared to any
$6, baby, yay.
And it really establishes itself as a safe haven in comparison.
So is there any, I'm curious your thoughts on that, because right now we're all looking for, I think, the safe haven and this volatility. And so with this name's exposure to some of these names that are seen as like proxies,
$7.
decent amount of holdings, and like
Thank you.
Strategy, for example, or some of these various entities, do you think then there's a risk of that, or you still maintain that this is definitely a risk-off asset here?
I think the fact that realized volatility of Bitcoin has actually been better than NASDAQ and that equities means that there's long-term bullish sentiment, both with Strategy as well as other corporations that are venturing into corporate Bitcoin treasury. So that is an industry-wide trend, and that is why you're seeing this long-term bullish sentiment. If you look at just the price action over the past week, I think Bitcoin is down around 7 or 8%, whereas the rest of the market is down considerably more. And that's because a lot more traders, institutional, as well as retail, are holding on to their Bitcoin. And I think that is symptomatic of Bitcoin's status as this almost reserve digital asset and positioning itself as a digital gold and as the foundation of a new global financial ecosystem.
Yeah, let's expand on that, Alicia, a little bit, because I do, this is where my question was going to go. You know, this whole talk of de-dollarization, I always think is a little bit overzealous. This idea of a BRICS currency seems to come up every 5 or so years, and then it doesn't really catch on. That said, with the ramping up of geopolitical rhetoric,
that helped out a lot.
Trade at the moment with tariffs.
If this doesn't hold 5, I'm getting out of it too.
We're looking for somewhere else to settle transactions or means of
you got to hold this trend line.
Transaction. perhaps a Bitcoin. If I was a Bitcoin bull, I would be positioning this asset as that. Do you feel
right now
there is a kind of a proving point that needs to happen here for Bitcoin,
right
or
there.
is this just an opportunity
Hold
for more widespread adoption?
I think it's both. I think it's an opportunity for widespread adoption, and the ETFs really
Who is
heralded
this?
that. They were able to de-risk
Whoa.
and legitimize Bitcoin and really help it
Hello.
transcend legal, regulatory, institutional,
My name's
as well as
Jim.
cultural hurdles to mainstream adoption. But the next wave of Bitcoin's
I love
adoption
you.
and growth is actually going to come from increased utility. So imagine Bitcoin as a unit of currency, being able to trade with Bitcoin, lend, borrow against your Bitcoin, earn yield on that Bitcoin. That's really going to help move that forward, and that's what we're doing at Botanix, is really building that platform for a Bitcoin economy. And I think that's what's missing in order to really get it over to the next level of widespread adoption and really position itself as a viable asset alternative to the US dollar.
Okay, and right now with the new administration expected to be definitely a friend to crypto, and I believe that so far they really have been, as we've seen already, SEC lawsuits dropped and various things that have been favorable to the crypto environment. I mean, so far, are you happy with the progress we've gotten out of the White House, or are you hoping for more of this deregulation and hopefully an even easier crypto environment, frankly?
Absolutely. I think the two things that the administration have brought have been very valuable to the digital asset sector. First is obviously they are very friendly to cryptocurrency as a whole, and that's been just great in terms of really helping to foment that sentiment, and that is also what's helping this long-term bullish sentiment in Bitcoin and digital assets as a whole. I think the second factor here is increased regulatory clarity. I think one thing that's been missing in the United States over the past few years is a lack of regulation. So with repealing SB 121 and a lot of the other measures that are being passed, I think that is a catalyst to really propel digital assets and Bitcoin forward over the next few years. And we're really grateful for that increased playroom to really help enable this.
Yeah, it does seem that at least some of the decisions are legitimizing the space a little bit more maybe than other regulatory decisions have. But you talk about this sort of secondary economy building up through a Bitcoin or other digital asset ecosystem. If you were to kind of game theory this out and think into the future, do you think that takes hold first internationally or here in the U.S.? Or does it kind of come across the board as one, just slowly but surely over time?
So historically, what we've seen within digital assets is that all of these instruments find more product market fit outside of the United States. Because if you think about it, the number one use case of digital assets and Bitcoin, right, is access to better assets. And one of the most demanded assets outside of the United States is the US dollar. And that is why you see more payments use cases, more tokenization use cases, more lend borrow use cases for digital assets outside
about
of the United
320
States.
again.
So that's what we've seen, and that's probably what's going to happen. But I do think with this increased regulatory clarity, there's a huge chance for institutions as well as builders in Bitcoin and crypto to really take advantage of that and build these businesses in the United States and be able to work with all of these international actors to really spur that adoption forward. However, I do see the emerging markets really leading the way as they historically have been in terms of helping leapfrog that initial digital assets adoption.
Are you in it?
And I love this perspective. And honestly, it's been a while since we've been able to talk about some of these safe havens within the market. And so I think great perspective there and some definite optimism, well needed on, of course, this Tuesday. So we are so thankful. Thank you so much, Alicia Painter, the co-founder and COO of Botanix Labs. Now coming up next, it's time for Under 30. We are talking American Airlines, which is the latest airline right now facing a sell rating and downgrade. So we'll discuss more what's driving shares down over 5% coming up next.
American Airlines. Maybe the fares will drop so I can buy some tickets. I need you to break back up to the upside. 3 black crows. Cheat, 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 cheat.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more, all crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Man, Intel looks cheap. I'm back to 380 on them. I still have two of these.
Extra investing, it's time for under 30. Wouldn't be under 30 without George Tillis, and it also wouldn't be under 30 if we weren't checking in on American Airlines. How's this stock doing? I feel like we come back here about every week and a half or so, and the story doesn't seem to change that much. But what's going on?
Well, I mean, I think if you look at what Goldman's call is, I mean, we've been talking about this this very issue with American. I mean, obviously it's down about 5% right now. It's back below $10 a share, and this is, of course, the largest out of the carriers like United and Delta in terms of sales. But,
yeah, I don't understand why it's so cheap.
Or the sales growth of the company, or the size of the sales doesn't really matter. It comes down to the flexibility from a financial standpoint. There's obviously a couple things going on, more than just a couple things. Let's put it that way. Tariffs are creating uncertainty. Discretionary stocks are down. Travel stocks, leisure, all to the downside.
We're at a year low.
You name it, facing some headwinds. But the problem with American, this is what we've been talking about as a legacy carrier relative to the other two major players out there like Delta United, is its balance sheet. And this is essentially exactly what Goldman Sachs basically has said in their call. They took their target of American Airlines from $16 to $8, and they actually have a sell rating on the name. And frankly, they talk about the
I think they're nuts.
Component to the business, the balance sheet, which is constraining their ability to generate free cash flow. Then you throw in potentially now earnings estimates that may be revised down, and then of course that becomes a challenge for the equity. And that increases the actual leverage ratio relative to debt. So it creates an
I like swinging this baby.
You've got a lot of debt, which in this case it's over $35 billion. With equity that's very small, around $8 billion. It's a tremendous amount of burden. And that burden is going to get worse, or can get worse, when your sales growth goes down and your pricing power becomes affected because of macro conditions.
And so, George, we talk about American so extensively, as Alex somewhat joked, but we seriously do. So I have learned now the extent of their balance sheet woes, that unfortunately, until they rid themselves of debt, they have their own issues that they cannot rid themselves entirely of for the foreseeable future. So, I mean, for this reason, does your narrative find, do you like some of the other airlines because of the fact that they have less debt right now and have less, just of a more healthy balance sheet, is a better way to put it? Or does this entire space right now just due for some pain because of the overall macro narrative?
Yeah, okay, so if you want to look at American and you tie it into the other legacy carriers like Delta United, obviously American's got some challenges that are idiosyncratic to its own business. I think all three of those have been challenged because we're moving into the time of year where actually crude oil typically now moves higher, and so does jet fuel price. And that puts pressure, at least in the first half of the year, on the airline. So the entire group has been sort of down, and then also added because of the tariffs is creating a problem. I think one of the airlines we've talked about that looks interesting is Southwest, because that company's story wasn't necessarily a debt issue or a revenue issue. It really came down to an operational efficiency issue. So that is one to certainly keep in mind in this market, because it's already been down significantly, even compared to its 5-year price levels, and there's a lot of story behind that stock in terms of operational efficiencies and improvement. That's a domestic carrier, and again, they don't have a lot of sensitivity to overseas markets, changes in the dollar, and even travel demand going overseas, considering what's happening with the geopolitical risk. So that's something to keep in mind, and I'm just giving you my 2 cents on, one of the airlines that I think is interesting at this level. Let's just put it that way.
And it's always opportunity cost, though, George. If you're looking to make an investment, it's not just, we're not fund managers here. We're not limited just to airlines. That's always the thing, too.
Well, AAL is at a 3-year double bottom. To me, this is really overdone, but and they're saying $8. We had $8.50 yesterday or last week. We have an inverted hammer. Some of these stocks I'd really like to buy and go long in. This would be one of them, but he said they were still hugely in debt. Nothing makes sense about that at all. Being American Airlines, unless they're paying people too much money. I don't know. Looks to me like I'd want to buy it, but shoot. I can't with the market conditions the way they are. We got a double bottom on the yearly too. Huh. I don't know what to think. Well, you remember that talk there a couple of years ago? They were wanting to come up with a new currency. China, Russia. Wonder if we're going to hear that in the news here lately. I'm still in these 2 calls. We need a breakout, please. They're at 340. It's losing depreciation. So I don't know, I might sell them here, even the last 2. Unless we break out and hit that resistance line. Come on, baby. Should have sold them all at $5-6.
An ounce of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
p.m. Eastern Time. We're coming to you live from the New York Stock Exchange. So glad you are with us. It's already been a wild week on Wall Street with lots of volatility and going over that on change line more times than you can count. And we've seen that even today. We started off with a rally, and that's fizzling some. We'll go through that. In the meantime, we have a big show for you today. It's Technical Tuesday. Kevin Horner of Charles Schwab will take a look at the S&P 500, those key levels to watch there. Also, Intel and Apple. Of course, you know, Apple had the worst day since 2020. We'll break down also the March stacks report that Charles Schwab has, gaining the insight on the Schwab client activity over the past month, what they were buying, selling, some of the trends. We'll have that for you. And of course, our panel is ready to talk all about the banks. We'll have on Friday, we're really kicking off earnings season with a lot of these banks, and our panel's ready to talk about some of those names and what to expect. In the meantime, here's a look. We had seen the Dow and S&P up about 4%. The NASDAQ was up about 4.5%. We've lost a majority of those gains. So the S&P now is up just over 1/3 of 1%, holding the 5,000 mark, 5,082. We'll ask Kevin Horner about that. NASDAQ 100 up 0.5%, so it had been up about 4.5% for the NASDAQ. You can see right now up 80 points. The Dow was up 0.75 of 1% and gaining 266 points, which on a normal day you would say, hey, great, but not when you looked up and saw it up 1,300 points, right? Maybe you were excited if you're bullish. And the Russell pulls back, small caps down now. Oil and gold are mixed. You have gold up almost $26. Oil's at $60.05. That is down. The VIX moves higher once again, 47.84. The 10-year bond yield 4.25, and Bitcoin 77,455. So we're back to some risk off and back to some of the safe havens. That seems to be certainly the story. Kevin Hanks, host of Fast Markets here on Schwab Network, is here with me now to take away his looks from the market. Look, I mean, you had to expect that some people would be selling into the rally. They've done some of that. We're also a headline-driven market, and the small business optimism report was not too optimistic.
Yeah, here's the difference. There's a divergence going on right now, Nicole, between the soft data and the hard economic data. We're going to get some hard economic data later in the week when we get CPI and PPI, but another sentiment data, the small business optimism out of the NFIB comes in down 3.3 points to 97.4, falling below its 51-year average of 98. The uncertainty index decreased 8 points from February's second highest level of 96. Here's what the chief economist William Dunkelberg said. The implementation of new policy priorities has heightened the level of uncertainty among small business owners over the past few months. So again, it's that soft data, the sentiment data, that seems to be hurting the overall market, even though the hard economic data, like we got on payrolls, like we'll see this later this week in CPI, that data seems to be coming in well. But right now, the sentiment data, not so much, Nicole.
Understood. At the same time, while we did see some good news throughout the day, AMD downgrade. Tell us about that.
Yeah, AMD down, KeyBank. Analyst John Vin downgraded AMD to sector weight from overweight without a price target. The firm has increased concerns regarding the sustainability of the company's China artificial intelligence business and sees increasing risks to gross margins given the potential price war with Intel. So a little bit of hesitancy and a downgrade here on AMD from KeyBank analyst. Nicole?
Yeah, so cutting into the gross margins, the market share story, the competition from Intel. When Intel was struggling, it was good for AMD, but now Intel has been doing a little better, not so great for AMD. All right, thank you. It's great to see you there. Oh, I just had one more quick question. Big picture, your thoughts on the turnaround in this market. I mean, there are folks out there saying it was a bear market rally. I mean, what do you make of it?
I think that you're naive to think that this market was going to go straight up and never be any choppiness. When some people are telling you to lighten your exposure in any rallies. So I think This is the definition of volatility in choppy markets.
Woo!
We opened up high, we faded back down. We were actually down on the day. Now we're rallying back up as we get late in the day, Nicole. This is your textbook volatile markets. There's buyers buying the dip, there's sellers selling the rally. Makes for real choppy, volatile markets. But traders, they love it, Nicole. This is the best type of trading market.
Not for me today.
The S&P on Monday, 48.35. You definitely have to hold that,
400 points from where we are now.
Yeah, exactly. Look, we're off the highs of the day, but you are seeing folks selling into strength, and that's just how it is right now. As far as the sectors, I'm seeing a lot of red, but there are still sectors that are in the green. Financials, utilities, communication services, tech. It's interesting to see the different sectors that are holding on. We're going to be talking about the banks later because we're going to preview some of the earnings. A final thought, Kevin?
Yeah, right now this is a very mixed market. You've got 5 sectors in the S&P 500 higher. You've got 6 lower, Nicole. So what started out as a rout to start the day is turning into more of a mixed market. But we've got about 2 hours to go here. So there's still a lot of trading to do today. Right now, this market looks very mixed in terms of its winners and losers.
Thanks. Great to see you. Thank you so much. So the market loses some of its strength today. More talk about more tariff battle, especially with China. We'll come to all of that. Lots to discuss with you. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Let's take a look at the bigger picture. Tom Plum is with us, CIO, Plum Funds, and manager of the Plum Balance Fund. Thank you so much for being with us. Of course, we're talking about deadlines.
I don't understand why these options are so high. I guess I'm just not used to it.
China had
Seen it like that.
Today to lift its retaliatory tariff. Now the U.S., the White House saying 104% tariffs. This will go
Usually I
just
can
after midnight tonight.
be just 4 or 5 notches out of the money and buy them for $4 or $5.
Whatever you want to call it. In the meantime,
That ain't the case
markets jumped up
this week.
4% plus and then sold off. Some of your
I gotta go way out of the money to trade them.
Obviously, the business-friendly Trump administration has caused a lot of uncertainty, and uncertainty means that people don't do anything. They wait to try to see what's actually going to happen. And on top of it, it's potentially creating some significant supply chain issues, almost same, only different cause that we had in 2022, which led to a pretty significant stock market decline that year.
So look, the VIX right now is at 48.33, has been moving around. I mean, we had talked
Walgreens.
about down about 20% this morning, but it's back to where it was because it shows there is some nervousness and fear in the market, right?
Right. I mean, there's no question that if any measure you use that we're oversold, but oversold doesn't mean it's going to bounce back up. But what we did see this morning is that there's the potential for catalysts to see a reversal of this decline that we've had so far. But you still need certainty, and it's going to be very volatile as people try to figure out what the actual scenario is going to be for their businesses and for the markets and for trade, all these different issues that are overhanging us right now. But we expect a lot of volatility, and it's also pretty clear that you don't actually see a bottom until after the fact.
Understood. It's hard to know when you actually clock in that bottoming and the bottoming process. I mean, would you say we're in the bottoming process or not yet?
I'd say we're in the bottoming process, but of course that doesn't necessarily mean that we couldn't go lower. But I do think that what we have seen is some remarkable companies that are now at reasonable prices, and prices that probably a year from now, maybe even 3 months from now, you'll think would be very attractive, and they would have been great entry points.
So at this point now, I know you're trying to pick some stocks. First of all, were you buying today or selling today?
We bought a little bit today. We were buying a little bit yesterday. Again, it's hard to talk about a company like NVIDIA, for example, and saying it's underappreciated when it's the third largest company in the S&P. But, trading at 20 sometimes earnings, lowest level that it's probably ever been, company that's really fueling the digital revolution, all aspects of it. We talk about artificial intelligence, but there's so much more to it. We do know that there's going to be some component issues. There's going to be some sales issues on who is allowed to buy their product. But still, if we're 40-50% revenue growth this year and profit margins over 60%, 20 sometimes earnings, I think it's pretty underappreciated right now.
So there is opportunity in tech, as you just noted, with NVIDIA, because that's under $100 still today. The recent high was $153, so it shows how much it's been beaten down. What about names like Visa, MasterCard, JP Morgan? Those are three names that you're watching and or like?
Well, actually, we bought some JP Morgan yesterday. Visa and MasterCard have been long-term holdings and will continue to be. But if you think about it, when you can buy JP Morgan, still the best financial institution or one of the best bank-based financial institutions in the world, at 12 times earnings, I think you're going to be fine.
Just take it easy, right? Over trading.
Worst case scenario, maybe a recession. But even a recession will probably get them to skate through because they're the strongest bank in the world. When you look at Visa and MasterCard, they are the digital financial tools that are necessary for all the types of transactions that we have, from people to business, to people to people, to business. There's still so much unmet need there. And again, you take Visa, 55% gross profit margin, consistently double-digit revenue growth and high teen or at least mid-teen earnings growth. MasterCard a little faster because of some of their exposure to other businesses. But these are companies that you're not going to be sad that you own today, and you're not going to be sad a year from now.
All right. Visa, MasterCard, NVIDIA, and JP Morgan. Tom Plum, CIO, the Plum Funds. Great to see you. Thank you very much. This is Tom.
Let's have a nice close.
To the red. All right, folks. Look, if that's the downside, you're happy. And of course, traders.
That's what we're waiting for, ain't it?
That's for sure. Coming up, Options Corner. Tom White is standing by. He will join us to highlight unusual options activity from the day, how investors are looking to trade on recent news of Marvell, Las Vegas Sands, and American Airlines. We'll be right back.
Now, if we have any Chinese people in here, we do love you. We love you very much. In fact, I'm going to show you someone that I love very much that writes me back and forth a lot. Her name is Dan Dan. And let's see if the first video pops up where I watch it constantly. No, it's not up. When I want to relax.
The watch list, time for Options Corner, where we analyze unusual options trades that we're seeing throughout today. We welcome in Tom White, host.
Oh, somebody got robbed. I was robbed in my new house. Oh, I got to watch that. Put that on a little bit later. He's my millionaire friend. This is the first video I watched ever. Oh, it's not on YouTube.
Effect at midnight tonight. China's going to be up to 4%. So that's definitely dented the bullish theme here earlier on in the session. But you can expect this volatility to continue.
Done, done. It's so cool when that car rides up through there. This makes me relax so much. As one let's have this market reverse, yeah. Get ready. I'm getting ready. I'm gonna buy 2 options at 51.50, yeah. That's one. There they did it. They successfully did their dance.
What if your roof could pay you back? Sounds.
That's the kind of roof I want to put on my house. We keep holding up this support level. Now we've got a snake with a breakout, pull back, double bottom, higher low. We break to 63 and we'll say go, go, go. And I want to change this to the 5150s. We have a wedge. Snake with a wedge. If we come down one more time, that'll be number, well, that should be 4. Prepare ye in the name of the Lord. I think first time I watched her video was about 4 years ago. I wonder if they're going to pile back into Apple. That was her baby for months. If you can count to 4, you might make a little bit more. Okay, I'm getting ready to, this is going to be another risky trade. I'm not in it yet, but if we touch this here and hold, I'm going to jump in it. Right about now, I think, would be a good spot. So, Let's give her a shot. $2.30. Nobody join this with me unless you want to take a risk. It's at 220. Break it. Not working. I got a hold right here. Okay. 1.90. Well, come on. About ready to stop out. Triple bottom right there. If this doesn't hold, I'm out. Boom. God darn, $3. 4. Yay. Okay, get out. Heck yeah. Woo! Magnificent. A plus, baby. Now I'm way above my loss for the day. It does qualify for an A plus. It does qualify for an A plus. Good. The court will approve of my appeal. At least a little A plus. That was beautiful. I got lucky. Francisca, could I have a piece of cake? She's not here. Oh man. Yankee, yabba dabba doo. Oh, you got it too, Richard? Damn good job. You took the risk with Bobo. Okay, Richard gets an A plus. He had a better entry. Man. Well, I was down 900 this morning. I was down a lot more than that, but I weaseled my way out to being a negative 900. Now I'm up, and I'm very happy. I don't want to over push it. Oh, he stopped out at 80? Very good. Well, this one could have been just as dangerous. No, they didn't work out for me, not the first ones. I scalped them. I bought the dip, but I couldn't get out even. And then it dipped on me again and I sold them. I had a lot. I had about $4,000 in the trade. So it wasn't an easy trade at all. It was an F. But it bounced up a little bit when I bought the dip and I got out, and it cut my loss almost in half. I was down about 1,700 on it. So that was a bad trade. I thought I had the reversal, but no. I didn't read Magnificent's writings. Now see, we're back down here again. So, playing with the devil. What's up, Miss Titellini?
Watch list.
We're back at support again. I did call it right though. I said if we pull back to that 3. The market's in the red. We're more or less flat. Hey, Randy, did you ever put a metal shingle roofs on?
Trading the trending names every day. I'm Tom White, host.
Randy, you ever put metal shingle roofs on a house? I might have you order me some wholesale. What kind would be the best for me to put on? I'm going to put it on a little shed. A little bitty cabin. A 1-room cabin. 10 by 12. Oh, extremely expensive. Oh. I didn't want to hear that. Stone-coated metal roof tile. These ain't too bad. $6 a piece. Well, that's from Alibaba. I don't know about that. They're all from Alibaba. Well, are we going to do this again? We got 20 minutes to close to power hour. And we're squeezing again. It's either going to break here to the downside or it's going to break to the upside and we'll go to the 200 this time. Oh, stock gods. Should I jump in this trade right now? Let me know. Should I move up the option price? Oh, stock gods. Take it to 5,100 and buy one? Is that what you're telling me? Buy one contract. You sure? Oh, stock gods. Oh, stock gods. Get ready, Jimmy. You can do it. Right now they're at $6. Oh, my mama. Okay. Here we go. Again, I say don't take the risk with Bobo. We're getting ready to buy this at $5.80. We broke below support. Nope. I wait. I got to get it back above this trend line. Oh, no, hold on. Let me get my... Okay, get ready. Nope. Come on, stock gods. Okay. See, it didn't hold that support. Okay, I got it. There it is. Another falling wedge. $5.70. I missed it. Damn it. I was going to buy it. Okay, here we go again. Oh, shit. I'm on 580. Oh, my. There it goes. It hit 580 and I tried to buy it just for a second. Well, there's $8. Wow, that would have been a nice trade. If you can count to 4, you might make a little bit more. If you can count to 3, you can trade with me. There's 840. I'd been out of that trade. I should have bought it. I had a chance to buy it at 550. Well, what do we got here? I have used ones called Decra. Oh yeah, them would work. I can buy them at Maynard's too. Free shipping to store. I wouldn't need that many to do a lean-to of a 10 by 12. Lean-to roof. I got to build a little bitty cabin up on my property so I can sleep in it. Next to my house. 1334 piece. Well, I missed that trade. I had to redraw it. Once I redrawed it, I see I'm still in the safe zone. This still could be a good runner. Could have got it there at $7. I got my first feeling of being old this weekend at church. I went to a Bible, so I was invited to this Bible study by this lady that had Parkinson's disease, and I didn't know it. They were having a free dinner. So I went in there, and everybody was about 80. They were all old people. A lot older than I was. I didn't know how to handle it. I mean, I handled it great, but I was definitely the youngest one in the room of 37. Industry sell off season highs. They weren't no season high. Whoever wrote that headline. Session high, excuse me. That I agree. Okay. Well, if we go down to number 5, we might take a nosedive. So Washboardjim's debating if he should take this trade. We got 9 minutes to power hour. I had a chance to get it at 660. That last trade really did me right. I should just leave it alone. There it is, 670. I can buy one contract and take $100, $200 loss if I have to. Okay, get ready. I'm getting ready. Getting ready. Try and find it as cheap as I can. Damn it. I had 620 there. I tried to get it at 620. I'll wait. We might get another chance. This is the 5100 strike, and we want to try to get low $6. Maybe even if it don't hold that 9. Hello, Miss Titolini. I mean, Totolini. I don't know why I keep saying that.
You know, in
Okay, it's coming back down for Bobo. 630. Get ready. This is a risky trade again. $6.30. Thank you very much. It's either going to break or bust. See, now we're below the 9, so it's not as looky. Grab one more. About to the point where I got to sell it if it doesn't bounce here. Yeah, it's not going to work. $4.20. It got to $4.10. I have $1,050 in it. That's it. Come on, baby, break. I'm bearish right now because I'm under my moving average. Okay.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support.
Can I get a job at Schwab, please?
And in-platform chat.
And work with next to Caroline?
With Schwab. Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Morning Movers brings traders the biggest headlines
Come
to start
on.
the day, from volatile overnight swings to the earliest
Well,
analyst calls. Get your
I don't think it's
watch
gonna
list
work.
ready. 8 a.m. Eastern. Morning Movers only on Schwab Network.
One minute to power hour.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Still a believer? Who, me? Not really. I'm still in it.
Good
But I don't know.
afternoon. It's 3 p.m. here in New York. I'm Caroline Woods, live from the New York Stock Exchange, and this
I was just
is
talking about you,
Market Options.
Caroline.
We have an hour left in the trading day, and it's been quite the day. Let's take a look at where markets stand. We're seeing mostly red across the board. The Russell 2000, the worst performer today, down about almost 2%.
Always
actually
clean.
2%
Retail
right
traders.
now. Huge reversal for
May I
all
help
of
you?
the major.
This is a recorded line. You're live on YouTube. This is a recorded line. You are live on YouTube. And I'm in a trade that I need to get out of. Well, right now, it's not looking good. We're still in the zone, but ENPH I haven't looked at it in a while. Let me see what the price set's at. Now, Richard, I said this was a very risky one. Ooh, ENPH is cheap. Well, they weren't kidding about sell-off. Ooh, I like it. Yep, I don't think it's going to work. We're at the bottom of the channel now. If I was to add, it'd be right here. And I'd have to get 4. I'm a great guy. And when it comes to taking high risk, everything's telling me to sell it right now at a loss, but I'm going to just hold on a little bit longer here. Yesterday I had an extremely great day, but a couple weeks. It usually takes me a couple weeks, but today yeah, this is not.
Continue to propel Apple at least somewhat higher. We're now pacing for a pretty substantial decline over the last 4 sessions as as of at least yesterday's close, that we had seen it actually lose 19%. Its worst 3-day stretch since 2001, to speak to the magnitude of the repricing we've seen in Apple shares. They are planning to ship
That
more
depreciated
iPhones
big time.
to the U.S. to avoid these high costs that will be affiliated with Chinese-made products, according to the Wall Street Journal. The move does come, though, after the new tariff package, of course, is continuing to raise duties.
90-day low
make more
on Apple.
Friction between us
I got
and the US,
165.11.
China. But the tariff on goods could increase Apple's hardware costs for an iPhone 16 Pro by $300, which is the base case. We actually see some saying it could cost upwards of over $3,000.
Oh, bullshit.
Experts are warning that this could make the device less competitive in the U.S. market, but Bank of America did actually highlight that Apple
They're still too
is already
expensive.
on track to manufacture 25 million iPhones in India this year. About 10 million were intended for use in the Indian market. So thankfully, for the case of Apple, they've already begun manufacturing pretty substantially within that region, but not to the extent in which China right now is important to them. You just can't deny that narrative that China right now is a major component of their iPhone sales. So this does make right now the flagship product, I think, a bit of a concern of what now sales will look like going forward. And I've been saying this a million times, but what the concern is for Apple is we really saw momentum shift following WWDC. We saw so much enthusiasm tied to this super cycle, this massive upgrade cycle that many were calling for, that now not only is that completely challenged, but they're going to have to incur costs to relocate all of their operations, which is not cheap by any means. And even for Apple, which is one of the most, I believe, if not the most cash-rich companies in our entire economy, it's not exactly what you want when you have a stock that's exposed to so many of the major indices and also so many of the institutional trading we see. So Apple's been working to expand its manufacturing footprint in India for years now, but what we do know is they're trying to at least...
Just about 2 or 3 weeks ago, they've been pumping Apple the hardest they could. And I was right. I said, they're wrong. They shouldn't be pumping this stock. Now, I'm going to start pumping this stock when it gets down to support. But it was way overbought. Jimmy's still in this thing. I should have sold it a long time ago, but I didn't. I love you, Caroline.
Another $350. But if, production did, end up here in the United States, I saw a Reuters report earlier, or headline earlier, that President Trump said he thinks that we can produce iPhones here in the U.S. Dan Ives, who, is still an Apple bull who has gotten less bullish, said if we want to make an iPhone in Jersey or Texas, it's going to cost $35.
It is not.
And obviously, it would take years to get to that point. So I don't think that's what we're hoping for either. But it seems like Apple's still holding on to hope that it will get some sort of exemption. Not seeing that reflected in the share price.
Well, the way you're talking, ladies, Apple's using slave labor. Is that what you're saying? Who would buy a company that uses slave labor to build phones? Huh? I'm just asking.
The green there.
Even more amazing than even just today's session, which they've been able to somewhat skate by relatively better maybe off than some of these other companies, but it's been these names outperformance. Like CVS just closed the S&P 500's first quarter as the best performer. And I could have guessed what the best performer was. Not a single person guessed any of these insurers. So it goes to show that we were not anticipating such momentum in a name like CVS or United Health Humana. But favorable news that right now, or at least seeing this nice day, because the Trump administration did announce it will be substantially increasing the payment rates for Medicare insurers next year, generating what they said was more than $25 billion in additional revenue for the industry and doubling the proposal we saw back in January. So the rate now It will be increased to 5.06% compared to the 2.23% that was earlier proposed by the Biden administration. So this even overshot the most optimistic of expectations from the street. Many did say that this raise is because of the rising costs, and frankly, right now it being so expensive for these critical services in this efficient and accountable manner. But the Trump administration did stick with a Biden administration policy change that does limit certain billing practices that have boosted some of these payments to Medicare Advantage insurers. The change was being phased in over the last 3 years to be completed by 2026. But the agency did reject some suggestions from insurers to pause the process. So combined with the rule as issued last week that withdrew the Biden administration's proposal to cover drugs for obesity, I think that this does provide at least a really nice catalyst for these names going forward, as there was a very mounting concern about the difficulties ahead with the fact that the long profitable Medicare business had become a pretty big drag on margins and share prices. So hopefully seeing some upside continue, although these names have been, at least in the case of CVS, has been an outperformer on this year and definite need of it, because we're still lower actually, 8% over a 12-month basis, but higher now, 53.3% on the year. I never would have thought I could say those words, Caroline.
Yeah, it's a pretty impressive move. United Health and Humana, the other two best performers on the S&P 500 today, both up about 10% so far in 2025. So certainly bucking the overall market downtrend for this year. And of course today with the S&P 500 now down about 1.3%. We'll leave it there. Jenny Horn, thanks so much for kicking off the show with me.
Thanks, Caroline.
All right, now I'm joined by Jim Masturzo, CIO of Multi-Asset Strategies Research Affiliates. Jim, thanks so much for joining the show.
Thanks for having me.
All right, so give us your take on today's market action. It seems like this is a market that wants to rally. It's tried, but it's failed once again. We still have, call it, 45 minutes plus in the trading day, but anything is possible. Just doesn't seem like it's going to happen at this point.
Sure, definitely doesn't. It did look like there was a little bit of buying the dip early this morning, pushing things higher, but obviously that's not holding. Not completely surprising. Coming into this, we've been talking about equity markets being overvalued, or when I say coming into this, just say coming into this year, and really just looking for a catalyst to kind of light the flame, and tariffs tended to be the thing. And so this pullback is not, unexpected. You never know when, but where markets were trading after the mag.
Yeah, I got two contracts
to much more normal
at 525.
Okay, so it's not surprising because of
And I'm
stretched
at
valuations,
115.
but at this point we've seen quite a considerable sell-off. So would you say the market's more fairly valued at this point, or do you think that there needs to be more selling to get there?
We think it's getting close, but probably still a little bit rich. Coming into
Very rich.
into the year, and we tend to use the CAPE ratio. As
Still think stocks are rich?
We were trading at about a 38. We think 28 is probably fair value. Right now, we're somewhere in the 30, 31 range. So getting pretty close to fair value, maybe a little bit rich. Again, I think coming into the day, there were a lot of folks thinking they wanted to buy the dip. For us, we think there's probably a little more dip to come.
Okay, so how would you look at it if we do get
That's
a
what
bounce
Mike said
that
yesterday.
doesn't fizzle out before the end of the day? Is it a bear market bounce? I mean, the S&P 500 is 19%
Well,
away
frick.
from the 52-week highs, so not
I
quite
guess
at
I
that
lost
20%
this one.
threshold anymore. Or would it be the start of maybe something bigger?
I don't tend to think it's the start of anything bigger yet. Want to, one day in this market with the uncertainty that's been going on, the VIX, up to, in the 40s, peaked out at 60 the other day. There's still a lot of uncertainty, so I would not be rushing to buy at this point.
Okay. All right. You also think the dollar is overvalued. It's under some pressure today, but fill us in there.
So interestingly enough, if we had this conversation in January, tariffs were supposed to be bullish for the dollar, and we've seen anything but as the dollar sold off, for most of the year. A lot of that driven from, uncertainty. Tariffs are on, they're off, they're on these goods. We don't really know the rates. A lot of that uncertainty has actually worked against the tariff narrative and pushed the dollar lower. The dollar's been on a spectacular run for a decade. So the idea of of a pullback again. Not completely surprising. The catalyst in this case of tariffs is a little bit more surprising, but we had the dollar about 25% overvalued, coming into the year, and I think the administration and others see it similarly.
Okay, so you're saying it's that was at the start of the year, so it's down, call it about 15% from there. So this is it still needs to see some weakness to be fairly valued, is what you're saying.
That's right. We're getting close, and things never get to exactly fair valued, so we might end up a little bit high or maybe even a little bit low, but we're definitely getting closer.
But a weaker dollar is a good
this
thing
ain't gonna
for
work.
multinational companies, right? It doesn't necessarily reflect that, especially when you take a look at big tech, for example. We know that the strong dollar had been a headwind, though. So why aren't we seeing that as a positive catalyst?
Well, I think right now there's just so much uncertainty and so much is driven now just by risk on versus risk off, and investors not sure where to go. And so I think once the dust settles a little bit, we'll see a little bit of what you're talking about. But right now it's just a little bit too early. As we've been thinking about it and talking to our clients.
We're so close to support.
To outside the U.S., there's the weaker dollar, which has been a headwind for so long for non-U.S. investments, now is starting to become a tailwind. And so there are a lot of opportunities. We tend to talk about the S&P a lot, but there's a lot of opportunities. It's a big world out there.
Okay, so tell us about some of these international investment opportunities.
So we've been talking about Eastern Europe for a long time. Poland's up 18% this year, and that's after a 12% pullback that's happened over the last week. We still think there's a lot of opportunities in Eastern European countries that were far undervalued coming into the year. Even things like South America. I know there's a lot of tariffs going on and tariff talk around.
Can we talk?
And copper in particular. When we think about this on a secular basis, the need for these minerals, the need for increases in batteries and EVs and all of those things, that the technology revolution is not slowing down.
Yeah, it's not
gonna go
good.
away just because we have some tariffs in the short term, or even if they extend into the long term. At the end of the day, we still need those things. South America, Chile in particular, is a fantastic opportunity for those sorts of minerals.
Okay, and how do tariffs impact those investment calls in your mind? Obviously, the European Union has, a 20% tariff tacked on. Does that change your view if and when, we continue to see these in effect?
Only around the margins. And again, we don't really know where the tariffs will fall out. So at this point, overreacting to what the numbers are today, I think is a bad move. We want to keep our eye on the ball of where we're going, not necessarily where we are right now. So look, as things start to settle, we'll adjust our calls appropriately. But the undervaluation in these places, we think is still more than enough to offset some of the tariff talk.
Jim Masturzo, CIO of Multi-Asset Strategies Research Affiliates. Thank you so much for your picks and your insights. Really appreciate it.
Thanks very much.
Coming up, we'll dive into the world of thematic ETFs, and our next guest company just recently launched 3 of them, and includes stocks on the international front as well. Market on close. We'll be right back.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren planning for their college
good bounce.
educations. Someday it'll be their turn.
If I don't break the 9 here soon, I'm going to cut this to a bad loss. And I'll be about even for the day. A little red.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Dumbass.
Welcome back to Market on Close. I'm Caroline Woods, live from the floor of the New York Stock Exchange. Let's talk thematic ETFs and how they fit into the current market environment. Let's welcome in Robert Forsyth, Managing Director and Global Head of ETFs at Lazard. He joins me here at the desk. Thanks so much for joining me.
Thanks for having me.
All right, so Robert, congratulations. You just launched 3 new ETFs here.
We did yesterday.
At Lazard. So I do want to kind of break those down, hear what the holdings are, why they're applicable for right now. But before we get to that, just want to get your sense of this market right now, because it's a roller coaster, a lot of whiplash, and unfortunately a lot of red.
Yeah, a tremendous amount of uncertainty. I think it's gonna probably be some time before we find our footing here. We look like the market caught a bit of a bid earlier today, but that's obviously unwound as we got closer to the close. I think if we look back before all the tariff announcements a couple of weeks ago and into the prior quarter, the market environment seemed to be rolling over already. We had a trade that had been tied to all the performance in domestic equities, which was kind of the Mag 7 large concentrated allocation in domestic equities. But that had rolled over, and you start to use European equities and international equities. Breadth was improving, dispersion was increasing, correlations were breaking down. And from Lazard Asset Management's perspective, that was a great environment for active management. All this volatility recently on the back of the tariff announcements, correlations all go to 1 as everything falls. But when the dust settles, I think we find ourselves back in a position where we saw previously, where active management can start beating some of those beta allocations that were so tied to the large mega-cap names.
And not just active management, but I could understand, or one would assume that ETFs might be a bit more popular in this environment, because it's really hard to stock pick when there's a lot of uncertainty and a lot of names that were once high flyers selling off.
Yeah, completely agree. We've seen massive inflows into actively managed ETFs specifically. ETFs across the board continue to see inflows. Some of our highest volume days and periods of volatility across the ETF landscape. Launches of actively managed ETFs are far outpacing those of passively managed ETFs. 8 out of 10 of the ETFs launched, 80% of the ETFs launched year to date have been actively managed. It's still only 10% of the asset base of the overall ETF industry, so $1 trillion, give or take, in actively managed ETFs relative to $10 trillion in passively managed, but it's growing at a much faster pace. So at the second half of last year, flows into actively managed ETFs outpaced the beta versions at 30% of flows, and year to date we're seeing 40% of all flows going into actively managed ETFs. So 10% market share, capturing 30 or 40% of the flows is a trajectory for success.
But what about thematic investing? Because it seems like that had kind of fallen out of favor. Maybe I'm just thinking more of the ESG plays and such, but the biggest theme obviously has been AI, and any way to invest in that. Not so much the case in 2025.
Yeah.
But is there still an appetite for thematic ETFs?
I think you're right. I think ESG investing did obviously result in some flows coming out of thematic portfolios. But thematic investing is by no means dead. I think it's actually the way of the future. When we look at it, we've conducted surveys on this subject. Younger generations prefer to invest alongside thematics and trends in the marketplace relative to style box investing or even sector investing. So we think this is a wave a wave of growth in the future, especially as we get this generational wealth transfer from boomers down to their children and children's children. We think that thematic investing is going to catch a bid and see some success going
Yeah, I
forward.
always hear about this transfer. I'm not sure if it's hitting my pocketbook. But to that point, let's talk about these ETFs. One of them is actually Next Gen Technology,
That's right.
TKY, Techie. I should note all three of these are higher today, so that's good news for you amidst the selling. Talk to us about what you mean by next gen technology. Obviously, younger demographic maybe, but what sort of names are next gen versus the tech that we think about?
Sure. So Next Gen Technologies, or ticker Techie, as you mentioned, is a really experienced portfolio management team. They've focused historically across automation, robotics, and AI. This portfolio is focused exclusively on the AI tech stack. Okay. When we say the AI tech stack, that's hardware, semiconductor production, data centers, cloud computing, things like that, all the way through to AI applications. So all the new apps that are being developed off of this tech stack will also be included in this portfolio once they're listed on an exchange.
So what are some of the biggest holdings there?
Well, you're going to see some of the hyperscalers are going to be there. You're going to see NVIDIA, obviously, TSMC, Taiwan Semiconductor. It's an important point, actually. Taking a global view to what's happening in AI is really important. If you look at some of the domestic allocations or kind of US-centric portfolios, you may miss out on TSMC.
Okay, yeah, interesting. So that is actually up about 3.5% today, despite the fact that the Mag 7 all in the red. So some diversification there potentially. Next up, I do want to ask you about the equity megatrends ETF themes, THMZ as the ticker symbol there. What are the megatrends that you're referring to? I'm assuming there must be some crossover with AI there.
There is a little bit. So one of the AI themes that we capture in the megatrends portfolio, as you said, ticker is THMZ or themes, is AI agents, right? So agents that are born primarily off of kind of the AI tech stack, as I mentioned, that are focused on things like getting you dinner reservations while you're on vacation, booking your entire vacation out.
Probably be another red day tomorrow.
A couple of details about where you want to go, how many people are there, you're bringing your kids or you're not. This agent can kind of book the entire trip out on your behalf. Other trends that we have within this portfolio, things like identification of companies that have invested smartly from a CapEx perspective in improving automation and productivity. So a lot of manufacturing companies that are focused on reshoring and gaining greater control of their supply chains, having to invest in automation and robotics so they can improve the manufacturing, knowing that it's going to be so costly to bring employees back from overseas. The focus of this strategy across the board is really from a fundamental bottom-up perspective. We use our global reach of research analysts to dive really deep into individual companies. We conducted over 4,500 meetings with management of the companies in which we seek to invest last year. And through those meetings, we've identified, where tech CapEx is being deployed, where R&D breakthroughs are likely to exist, and we've used that deep analysis to identify where there's trends across industries and across geographies, and that's the foundation of the megatrends portfolio.
Just quickly, how do you invest in those AI agents? Because obviously you can invest in Alphabet, they have Gemini,
Yep,
there's
that's right.
Siri, who's not really an AI agent yet. We're waiting
Copilot.
for those. So is just some of the normal names that we're used to talking about?
It is, but it's expanding rapidly, especially as you see more and more products being brought to market.
Okay. All right. And then finally, the other ETF actually centers around Japan, Japanese equity, JPY.
Yes.
Tell us why.
Absolutely. So Japanese equities, we think, are at an inflection point. We think the Japanese economy really kind of turned the corner a couple of years ago, coming out of a decades-long deflationary environment. They're now seeing a couple of years of moderate, sustained inflation around kind of the 2% threshold. We're also seeing kind of a strengthening consumer. Wages, we just got the wage report out of Tokyo a couple of days ago, was really strong again. It takes time for that to flow through demographics, but behaviors are changing. So if you thought about a Japanese consumer in a deflationary environment, there was no impetus to purchase, right? You thought you can get it cheaper a couple of days from now, a couple of weeks, a couple of years from now. Now that we're in an inflationary environment, there's an impetus to spend. And as wages are growing, that spending is likely to occur. At the same time, you're seeing a tremendous amount of shareholder value creation for Japanese equities. Incentives for dividend payments, for buybacks, for CapEx are all improving and at multi-year highs across the board for buybacks, dividend, and CapEx. So we think this is an appropriate time for a discrete allocation in Japanese equities. Active there, however, tougher.
Oh boy.
You need a bicultural team, a local team that can go deep into the marketplace.
Almost like a day wasted today
And why
for me.
focusing on that, other than the fact that you're
Yeah.
active managers? Why specifically do you want to be active for Japan?
Well, I think again, there's going to be winners and there's going to be losers. If it's consumer companies, if it's financials, if it's staples versus discretionary, making those bets is going to be really important.
I was taking a look, 24% tariff on Japan.
Yeah.
Does that change where you're investing?
Not necessarily. I mean, we're investing all locally, so I think the analysts are going to kind of take a stock by stock view of how the tariffs are going to impact one company versus the other. A lot of it's going to have to do with where people are importing versus exporting, where their supply chains are. But again, another reason why you want to have the research analysts conducting that work.
All right.
Yeah.
Well, we really appreciate it. Thanks so much for joining us.
Thanks for having me.
That's Robert Forsyth, Managing Director and Global Head of ETFs at Lazard. All right, coming up, Options Corner. Kevin Green will join us for the levels he's watching into the close. More Market on Close coming up next.
Da-da-da-da-da-da. Oh well, one of them days for me.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
I got a reward available. What's that mean?
Welcome back to Market on Close. Time for Options Corner. Kevin Green, Senior Markets Contributor, is here. Kevin, thanks so much for joining us. And I thought we were going to have some good news to talk about, at least based on this morning's action. But the S&P just falling apart now, down 1.6%. Every sector in the red. What levels are you looking at going into the close?
Yeah, Caroline, obviously we started off really strong here today. We had around almost 96% of the stocks in the S&P 500 in the green this morning, but you did start to see it fade here a little bit. And actually this morning we kind of highlighted two areas of focus here. The 5250 area was kind of our intermediate area of resistance. We did break through it, but once again, we just were not able to kind of close above that level. And then we started seeing a fade. And a lot of this fade that we are seeing is not only just news driven, but something that really does happen in these type of erratic markets. We have very low liquidity, price can change on a dime. And if you don't really have enough buyers in place or just sellers in place to really try to backstop some of the trends, it can become a little bit difficult. And that's really what we're seeing. But we're testing that 5,000 level right now, sitting at about 49.75. getting close to getting outside of that band here. And if we do see a little bit more of a sell-off here, I'm not sure if we're going to get to that 4,800 that we talked about earlier this morning, but it could get fairly ugly into the close, knowing that we have some potential overnight risk taking place here. So kind of looking at the levels just on an intraday basis, once again, 5,000, anything below that might be a little bit of an issue. And if we do see a little bit of a bounce, or the market on close order is actually
5,000 was the one I said a while back.
Sellers in the market that are really trying to potentially cover their positions or what have you.
Same as 500 on the SPY, but
looking at 50 as that area for us to try to hit. But right now, the trend looks like
we went below it today.
Be able to recover at least to that 5,000.
498.47.
Earlier this morning, we just had a situation. This is the E-mini S&P 500 chart. You just had a situation where we had in the morning, but you started seeing volume starting to tick down just a tad bit, even on up candles. Then we had a reversal candle, and we had this bearish divergence on the RSI, basically RSI making a lower low, and then that's where you kind of saw this market kind of start to flush to the downside, and now we're at aggressive oversold levels here. So it's an unfortunate situation, but this is exactly what happens, and I don't even want to call it a bear market yet, but this is exactly what happens when we have these type of corrections. A lot of false signals both to the upside and downside, and unfortunately this is what we call a bear trap today, or bull trap today. This is where a lot of long buyers that got in early on kind of got caught off guard here, and that's probably why you're seeing aggressive selling to the downside.
All right, a bull trap in an S&P 500 is now down 19.3% from the highs, so very close to that bear market territory. You talked about the overnight risk, Kevin. Obviously, there's this midnight deadline for President Trump's tariffs set to go into effect, 104% on China. Seems to be holding firm, even though there's negotiations happening with more than 70 countries, according to reports. Do you think it's going to be a crazy overnight session as well?
The only one that really matters right now, Caroline, is China. You can talk about 50 countries and 60 countries. No, I mean, yeah, they're going to have a little bit of an impact, but no one really cares about, and sorry for this, no one cares about if we are able to create a trade surplus with Cambodia or anything. No one, you really need to have the EU as a conglomerate, a trade deal there. You need to have Japan, which seems like that's probably the most likely one to finish first. And then you need to have China. And you can say all you want when it comes to the rhetoric, but China is a major trading partner with us, especially when you're looking at retail goods. You can even take the manufacturing and industrial side out of it. Just the retail space itself is going to have a meaningful impact here. And so the market, even though we had an elevated VIX at around a 40, 45 VIX earlier today, it seems like we were kind of discounting the China exposure. And I think that's probably what the market's also fearful of right now, is that we will see 104% tariffs on China immediately. That is going to have a massive impact when it comes to the economy, not only here in the United States, but around the world here. So that's something to really try to be mindful of. And I do believe that we will see some fireworks here overnight when it comes to that. Now, maybe they do make a deal. Maybe they do pause these tariffs. Who knows? We've seen crazier things happen in the past here. But if we do not see any type of resolution as we start tomorrow morning, and if we do see retaliation from China overnight, that's where it gets a little bit more interesting to the downside here.
I almost want to swing a call.
Okay, and what levels?
They're probably too damn expensive.
Because I do want to remind you, you said we're closer to the end of this than we are to.
They're still high.
Losses, I thought.
Yeah, closer to the end means 60% of the way there. I mean, you still got 40% of the way to the downside here. I'm looking at around 46.50. Seems like a decent value area if we do not get a credit event that creeps up into the market. You start seeing a lack of liquidity within the credit markets. I think all bets are off there, Caroline. That's where you have more drawn out bear markets. But if we don't have that type of an event, 46.60, 46.80-ish, that 50-month moving average on the SPX, I think is actually a really key area that we have seen some buyers really step in the past when we have corrections or even bear markets. Now, that's what I would look for. I'm not saying that's an overnight level by any means, but that's kind of the longer term technical setup that I'm kind of being mindful of right now.
All right, 46.80, a long way from where we are right now. Kevin, final thoughts as we head into the close? Still have about 22 minutes before that bell rings.
Let it ring.
I would just say, if you're a trader, you got to be very, I continue to say, be very tactical.
We'll be right back.
Right? If you're going to find areas to buy into, nibble just a little bit. You don't have to deploy all of your capital. You don't have to call a bottom here, especially if you're a long-term investor. And you're going to have to be able to change on a dime as the dynamics change. And unfortunately, we're probably going to live with this type of news flow for the next 3 to 4 years, Caroline. And so if that's going to be the case, we can't get married to one ideology, and don't let politics cloud your judgment. I think that's another thing as well. You can have as much support for somebody or against somebody as much as you want, but let the charts speak for themselves, let the fundamentals speak for themselves, because that's how we make money in this market.
All right, is Dramamine publicly traded? I think we need to invest in that. Kevin Green, thanks so much. Coming up, we're joined by the president and CEO of HPE, Hewlett Packard Enterprise, to discuss where AI technology is heading and to give the latest update on its potential deal with Juniper Networks. Market on close, we'll be right back.
Believe me, when it comes to investing, you'll love Carl's.
Nike at 52, that'll hurt. China will hurt it too.
Is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on.
$31.
Can do.
Look it out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market
Ding, ding,
with
ding.
the Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Market on Close. I'm Caroline Woods. It's time to turn our focus to Hewlett Packard Enterprise as the company is approaching its July 9th trial date for a government challenge about its $14 billion deal to acquire Juniper Networks. To hear more, let's welcome in Antonio Neri, President and CEO of HPE. Antonio, thanks so much for joining the show.
Good afternoon, Caroline. Thank you for having me.
It's great to have you. All right, I want to talk about the deal. I want to talk about AI, but of course, I also want to talk about tariffs. That's really what's on investors' minds right now. That's what's moving the markets today. So tell me, Antonio, what's the impact of tariffs on your business? And are you seeing any of your customers have to pull back or talk about potentially pulling back because of this uncertainty and because of, a newfound appreciation or potentially an old-found appreciation for cost?
Well, Caroline, the headline is fundamentally immaterial. And it may be surprising, but here are the facts. First of all, Hewlett Packard Enterprise does most of the business outside the United States. In fact, more than 60% of our business comes from outside the United States. The second fact is that HPE has a very large presence already as a manufacturing vendor in the United States. And that obviously gives us flexibility. And the third fact is obviously under the USMCA, there are exemptions related to our products based on the content and the value of the transformation of that product when we build it, for example, in Mexico. So when you add it all together, the impact is actually immaterial, and we have ability to mitigate much of that. However, that's a point in time today, and obviously...
What did Ford do today? They were pumping Ford.
Continue to monitor this, but the good news is that we as a company We are well positioned, and we continue to bring more manufacturing to the U.S. based on our capabilities.
So just to confirm, you're saying it's immaterial at this point with the tariff rates as they are right now?
Correct, and that's based on the guidance that we provided at the end of our Q1 results in February. So as the new tariff became, online, let's say a week or so ago, and tomorrow obviously is an important day, that incremental impact is actually very small to us.
Okay, all right. And speaking of guidance, as you said, you just reported your results in March. You did offer your full year.
They were pumping Ford yesterday. Look at it now.
Again until June. But I'm curious to get your CEO.
We're getting real close to my support.
A lot of analysts are saying we won't hear much in terms of outlook from tech CEOs this earnings season because the landscape is so cloudy. There is so much uncertainty about these tariffs. Do you think that will be the case?
Oxy had a new
I'm
low.
not sure about Caroline. Obviously, we were at a given point in time in a position to provide some clarity. At the time, obviously, we deliver a very strong performance.
Bargain hunting time.
Where we grew revenue 17%.
XLM's under $100 bucks.
We delivered the guidance on EPS. But at the same time, we had some challenges that we had to manage ourselves. And based on that point in time, plus what we knew about the tariffs, we provided a guidance that today stands. And so I'm not sure what the other companies are going to do. We're going to learn more in the next 4 to 6 weeks. And obviously we are now closing our quarter. But as I think about that early June, we have more clarity about where we're going from here. What really excites me, honestly, is the fact that demand is still out there. And demand specific for the products where HP brings unique innovation to address the concept of AI, hybrid cloud, and fundamentally the core infrastructure, which starts with networking.
So even though companies have to be more, focused on costs, you're saying demand hasn't been dented. So tell us what investors need to know about really the state of AI technology.
Well, I don't think it's just AI. I think is across multiple.
I'm seeing a correlation punk in with these trend lines. It's kind of like a Darvis box in a way. I know how to trade them, so I should have fun with this. I've been going through a lot of little charts looking at it. Darvis, all it is a horizontal sideways pattern. If this thing had any sense, it would have held right there at 46 CMG, 47. Chipotle. I ate there one time and did not like it. Maybe my second trip would be better. Ooh, Target's at 87 bucks. Some chick was pumping this the other day. That's interesting. They lowered the price target on it to 100 from 120. Evercore. $82 here. Trust Security. So they might have it right. Actually, might be one.
Is going to deliver tremendous.
We have 11 minutes left, and I can't wait for this day to be over with.
Okay. Antonio, BlackRock's Larry Fink was quoted yesterday as saying that the CEOs he talks to think we're probably already in a recession right now. Economists tend to disagree with that statement. But you think we're in a recession? Do you think
No.
we're heading there?
Well, I'm not an economist. I can tell you from an IT perspective, from an IT spend perspective, we are not. I think it's fair to say that everyone that learned from the past, whether it was COVID and the challenges navigating that issue, it required more IT, not less IT. And therefore, IT will continue to be, in my mind, from what I see. And remember, I spend more than 50% of my time talking to customers. I'm in Houston today, and I have more than 50 partners here with us. They all see IT as an important lever to navigate this uncertainty and be ready for when potentially the market recovers and takes off again. Now we're going through that uncertainty, but I think IT is going to be fairly resilient.
All right, well, we really appreciate your insights. Antonio Neri, President and CEO of HPE. Thank you so much.
Thank you, Caroline.
Have a good one.
I will.
Let's close out this market session and get the big picture from the team at Charles Schwab.
I will have a good one.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 6 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome back to Market on Close. I'm Caroline Woods. Just a few minutes left in the trading day. We have about 9 to be exact. It's time for the big picture. Let's welcome in Colin Martin, Director, Fixed Income Strategist, Schwab Center for Financial Research. Colin, thanks so much for joining us.
Hi, Caroline. Thanks for having me.
So we've talked a lot about the equity market so far on this show, Colin. So bring us up to speed on what we're seeing in the bond market, because stock's selling off, but it doesn't seem like that money's going into bonds.
No, it doesn't look like it. It's been a weird couple of days when you look at the action with the stock markets versus the action with the bond markets. When you see this sort of stock market volatility, especially this late day, price decline with stocks, usually you see that flowing into safe havens like U.S. Treasuries. But we're seeing U.S. Treasury yields pretty much, holding steady for most of the day. And I think it's really interesting, the dichotomy we're seeing with the S&P 500 down, 10% or more since when the tariffs were announced, but intermediate and long-term Treasury yields are at or higher than the levels they were back in the middle of last week. So I think that's really interesting there. I think there's a few ways we could be looking at the stock market. Clearly is pricing based off of the concerns that we're seeing due to tariffs. If the tariffs as scheduled,
blah blah blah,
for a while, that's a bad thing for the economy. It should slow growth. It could boost inflation. That's not a combination we're looking to see. But we've gotten some concerns or some comments from Fed officials that they're not as aggressive as the markets are in terms of expectations for what the Fed may or may not do over the next few months. And Fed officials today, again, we got San Francisco Fed President Mary Daly talking about the Fed funds rate being in a good place right now. Last week, despite the market turmoil, Fed Chair Powell said that the Fed is not in a hurry to cut rates. So I think it could be reflecting that a little bit, that yes, there is a very uncertain economic outlook right now, but the Fed might not necessarily cut rates given the uncertainty and given how inflation is still relatively high.
How disappointing could that be for this market, seeing as it's pricing in 5 rate cuts this year?
I'd say that is pretty disappointing, or would be pretty disappointing, Caroline. I'll hedge that by saying I'm not a stock strategist or analyst, but the idea that there would be no Fed put, I think, would be concerning for stock investors. So that could be an issue as well, because again, we're getting these comments that the Fed is making it pretty clear that they are in no rush to cut rates. I think that can change though. I mean, right now, as it stands here in early April, the economy from the data we've seen, continues to do okay. The labor market was relatively strong based on the results we got last week with the non-farm payrolls report. Yes, we
5
saw
more minutes.
tick up a little bit, but not at levels that are too concerning. If that were to change fast, if we were to see the unemployment rate start ticking higher and maybe get to 5%, which would be admittedly a very big jump from where we are right now, but if we were to see that over the next few months, that would be concerning for the Fed, and then that's probably what would result in them cutting rates as aggressively as the markets are expecting. But they really need to see that in the data before they start cutting like the Fed funds futures are implying right now.
Okay, so there's the dual mandate. You talked about the jobs side of things, but then there's the inflation side of things. We do have CPI and PPI out later this week, but similar to the jobs data, which was backward-looking and didn't necessarily include the Doge cuts, do you think that the market could potentially shrug off those two reports because it wouldn't include
We're still above the
impact
200 on the weekly.
Yeah, I think so. I mean, right now we're in this kind of weird economic environment where the data we're getting doesn't really matter that much. So yeah, so when we get the CPI report, it's going to be very backward looking. It's likely to show that inflation remains sticky. But as I mentioned before, if these tariffs remain in place as scheduled, then that can keep inflation sticky or risk re-accelerating. So I don't think the markets are really going to move too much based on the economic data in the near term. It's really going to be comments from Trump and the White House and various officials about what the plans are, if any deals are being cut. And until we get more clarity there, the economic releases will probably take a back seat.
Yeah, and there's no shortage of headlines coming from the White House to keep us busy, that's for sure. I think, though, you talk about kind of what the stock market is reflecting. What does a 10-year yield at 4.26% say to you?
No, that suggests that the Fed is not going to cut rates as much as the markets are currently pricing in right now. It also could be pricing in the idea that this is just a negotiating tactic and some of these tariffs get rolled back. I think that's the big question right now. Because again, we are seeing these very different movements with stocks and bonds right now. And it's an unanswered question of who's right and who's wrong. Because if we look at what's happened over the past week, if in a few days or a week or 2 weeks time, the tariffs are rolled back or reduced significantly, a lot of what we've seen would likely be reversed. We'd probably see Treasury yields move a decent amount higher. Given that we're back at around 4.25% on the 10-year, I don't think it would move significantly higher, maybe the 4.5% area. But it could be, pricing in the idea that maybe it's not as bad as expected. So there's a lot going on right now. And
yeah, there is.
Just all the uncertainty we're seeing out in the markets.
So, Colin, just finally, what's your advice then to bond investors right now?
Yeah, our advice is to not do anything too crazy. We still suggest our up in quality bias, and from a maturity or duration standpoint, we're suggesting just an at benchmark maturity or duration. That's average maturity is around the 6 or 7 range, in line with the U.S. aggregate index. We're not suggesting investors go too short, meaning all in cash. We're not suggesting they move to long-term bonds because there is a lot of risk to both sides in terms of yields rising in case these tariffs get rolled back, or yields falling in case they stay in place and we see a recession sometime soon. We're also, still pretty cautious on credit right now, because when you think about high yield bonds, bank loans, they tend to be highly correlated to the stock market. So if we get this stock market volatility, we could see some more weakness there. But if this continues, it could present opportunities down the road. So we're paying attention to high yield bonds right now. If we see spreads rise another 50, 100 basis points or so, we think it could present a more attractive entry point.
Okay, we'll leave it there. Colin Martin, Director of Fixed Income Strategist at Schwab Center for Financial Research. Thank you so much. Coming up, our closers panel joins us to recap the trading day. Market on close. We'll be right back.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time and more time learning. Trade brilliantly with Schwab.
Alrighty, well, that's it. I'm sorry I did a poor performance today. I sure did. I just kind of wasn't into it for one thing this morning. After yesterday, I was kind of excited and I didn't want to blow it, and it looks like I did blow it. Puts would have been the day today, that's for sure. So, I felt putty this morning. I talked about it. I wish I would have went ahead and went through with it. Because I said we were open too high and had too big of a gap up. We're still at the bottom. We're still above the 200. So we're still bullish until we break that 200. Just this week we went a little bit lower than last week. So I'm going to take it easy, not think about this market, come in tomorrow with a new brain. I was a little red today on that last trade, kind of got me. But I was about even, so I'll make it up tomorrow. I always do. A lot of times I make it up 4 or 5-fold, but tomorrow I don't know if I want to be that brave. We got to see what happens with China, how the market reacts. I don't like 104% tariff. I don't know if that sounds good to me at all. If I had connections with Trump, I'd say, man, you better back off. You're not being too bright. It seems like you can be a better negotiator than that, instead of just forceful. But I have to live with it. My money's safe. I think everybody should have thought about that 3 or 4 months ago, because we were up so high. I mean, we're still not even in correction territory. Like that one guy was saying today, things still look a lot real frothy. As PE ratio pertains. And I want to thank you, Punk, for giving me that script. I'm going to use it a little bit and see if I can figure something out with it. If you're still in here. And we're going to get on out of here. Watch it tomorrow. Let's not get too crazy in trading. Just wait. This is a time where it's headline driven and timing is per everything. It's not like it was when I was going through them. Boom, 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 boom. Average 6 to 10 trades a day and winning every single one of them. It's nothing like that right now. We've got to be more bearish and defensive and not take as many trades. Wait for the right setup. Today I was pointing out very risky trades. Every one of them I took was a very risky trade. So I wanted to make that clear when you're trying to follow me in a trade or something. And when I say risky, that's something you probably do not want to take. And I think I'm going to go ahead and go and relax and watch a couple videos. I got to watch my millionaire, what he got ripped off in his move. He owns like $20 million worth of watches alone. Maybe more than that. Probably about $100 million. And I'll put that link here. He's a fun guy to watch. He's pretty normal guy for being a multi-millionaire, billionaire. He has a big, huge jet. Real fancy cars. So, we'll catch you all later. Thanks, everybody, for sticking in there.